Okay, all right.
Muted.
All right, okay. All right. Hello, everybody. Hope you're doing well. My name is Jeff Gibby. Today, we're going to be kicking off the Online Trader Summit. It's good to see you. I said, I hope you're doing well. It's been a little bit of a crazy market, as you probably were aware if you didn't watch it yesterday. But what a good time to learn. So let's go ahead and get everything kicked off today. Thank you for coming. It's good to see you. As we go, we try and make this event as interactive as possible. Make sure you're asking questions and interacting. And if you're watching on YouTube, give us a like and a subscribe. It helps a great deal. So for me, I'm going to read this legal disclaimer that I've only read maybe 3,000 times, and then we're going to introduce our guests and we're going to get going. So today's demonstration is designed to instruct you on using Metastock and the accompanying software plugins. It's not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by only investors who are at the risk in trading. Yes, I forgot it. It's only 3,000 times. Metastock shall have no liability for any investment decisions based on the use of the software, any trading strategies, or any information provided in connection with the company. So there you go. I do want to say we do have a couple sponsors today. We have Stocks and Commodities Magazine. They've been a sponsor for the Metastock Online Trader Summit for a number of years now. It's a great article. Hey, if you're watching on YouTube and you want to get a free issue, go to metastock.com/traders-summit, fill out the registration form, and make sure to check the box that says, I want a free issue. But it's a great magazine. We appreciate this sponsorship over the years, and they really, really do a great job too. Also want to thank our other sponsor, CMT. CMT is a great association. Actually, Tyler is part of the CMT. I'll let him tell you a little bit more about that, but they've been supporting us for a little bit now. And they actually have a symposium coming up in New York that we'll probably talk about at some point today, but you can find out more about them at cmtassociation.org. Of course, we're Metastock. We'll talk about Metastock all day. I'll actually do a whole hour on it. But one of the things that I'm really proud of is for 29 years in a row, it's been rated the #1 software in its price category by the readers of Stocks and Commodities Magazine. So let's go ahead and get started, though. Our first two guests today is Alex Cole, Tyler Wood. They are very, very entertaining to watch. Actually, I think they're some of the two most entertaining guests that we have. They do a really, really good job. Let's get them in here. Let's get them going. So let me go ahead and do this and this and this and this. And hey, guys, how are you guys doing?
Hey, Jeff, good morning. It's a lot earlier where you are than it is for us.
Yeah, it's still 8. I've been up for a little bit now. Okay, I can see all of you. Let me go ahead and give you the screen here, Tyler.
Fantastic. There we go. Let's do a little screen sharing, shall we? Let me know if that's coming through. If you can see those conquering uncertainty in choppy markets charts.
It looks good. You guys both look good. I'm gonna get out of the way. Your turn.
Contrary to popular opinion, I'm not sure if this does look good, but Alex and I are sporting the beards. It's still wintertime, upstate New York, but thank you all for joining us on this Saturday morning, April 23rd. And what a right thing to do when we've had a difficult trading week like this. Markets have been highly volatile. You want to step back. You want to appreciate the discipline of doing some market analysis when you're not driven by the fear and greed of what's happening in the marketplace, but instead step back and think about your process and think about your tools. So this is a low stress moment. Grab your cup of coffee, get your notebook. Alex and I are going to talk to you really just as a conduit of everything that we have been taught by some of the best fund managers, sell-side research analysts, and institutional traders over our careers in the last 20 years. So let's dive right in. We're talking about trend following, but we're talking about trend following in a regime where the markets have been particularly choppy, where things are not trending in one direction. You might have gotten involved in the markets in 2020 or know people who did, and it seemed like anything they bought went straight up, right? That was a perfectly trending market. And what we're doing right now is chopping around. We've got a lot of rotation between the sectors. And Alex and I are going to talk a lot about current market events. But first, we just have to set the table about what we mean by trend following. We've got a quote here from John Henry. This gentleman might be familiar to you if you've ever read the book or seen the movie Moneyball. And the whole concept of that story was going in to disrupt the baseball recruiting process. It used to be that they would go out and they had a certain feeling about a pitcher. They just really, they knew the pedigree of this guy's family, and he was going to be a big hitter just like his dad. Well, that's the narrative. That's the emotion. That's what we believe might be the case. And as investors, we have to separate ourselves from our beliefs and think about what's really going on. When we say quantify, we're not talking about building a black box and algorithmic trading. Don't worry, Alex and I are not going to try to teach you how to code in Python over the next hour. But we do want you to help yourself objectify what's really happening versus what you are afraid of happening or what you hope will happen. Fear and greed can be really disastrous effects on your portfolio, but you can use that emotion in the marketplace, the irrationality of other investors, to capture trends and to get out quickly when things become volatile. So we're talking about John Henry because he was born on a soybean farm, got into the commodities trade in the early 80s, had a very successful career as a trend follower because he was just following price, and he gave himself an objective set of rules that helped him compete against all of the other traders and investors and CTA funds that were out there. So we've learned a lot from great trend followers. Stick with me here for just another minute. We're going to get mathematical for a second. I promise this will be this will not be painful. But when we say behavior limits gains, there's something very specific that we're talking about. We know that it's more painful to lock in a loss than it is to capture a winning trade. And therefore, as traders, we tend to lock in our winners quickly, right? We want to recognize that we were right and we chose the right stock. And when something is trading against us, just by show of hands, why don't you all raise your hand if you've ever had a trade that then became an investment? Don't worry, this is an online event. We can't see you. But if you've ever had a trade that suddenly became something that you were going to hold on to because you just knew it was coming back, you had a high conviction, and maybe it was down 5% against you, and you were just sticking with it, and then it was down 10%, and maybe 15 or 20 or 50%. Right? We don't know what that future holds, but it could be really disastrous, which is why we want to cut those losers quickly. As soon as we've recognized that it's out of a trend, we want to get out of that trade because we don't know what the future brings. And we're going to talk about a lot of examples where that exact scenario happens. All right, so trades become investments. We want to remove that subjectivity and we want to follow our rules. Now, GoNoGo charts are going to help in two ways. And this chart on the right side of your screen is showing us the two factors that make up your profitability as a trader over time. One is the percent of winning trades, and that's on the bottom on the x-axis here. The other is your profit ratio. So when you choose a winning trade, how long can you stick with it? Can you get those outsized gains from your winners, and can you cut your losers short? Now this curve right here shows us where the break-even systems are. You're profitable anywhere out to the right side. So we want to push ourselves into that very profitable right horizon. But what we're learning here is that you might be right in picking the security that's going to trade in your favor 1 out of 5, only 20% of the time. That means you are wrong 80% of the time. But you could still be profitable as long as those 20% of winning trades are 5 times larger than your losing trades. And when Alex and I first got into this business, we sat with institutional PMs. It was shocking, actually, to hear them speak about how strategies get implemented. And Alex, I know you learned a lot really quickly at your time at Bloomberg.
Yeah, I remember one of the first meetings I had once I became a sort of a technical analysis specialist at Bloomberg was with a trader who he said, "Look, I only aim to be right 50% of the time." And I was falling in love with technical analysis. This was probably 15 years ago. And I thought, what do you mean that, I've been reading all the books and I was so excited. And he said, but, I cut my losses and I let my profits run. I usually have a 2-to-1 risk reward ratio. And so my wins are twice as much as my losses. And then he took me aside afterwards and he said, but listen, to be honest with you, I think technical analysis helps me be right more like 70% of the time. And I'm like, okay, I'm back on board. And that sounds good. But the point remained that, as if he was right half the time, he was happy because he made twice as much on his wins as he did on his losses. If he was actually right more like 70% of the time, and you're pushing the profitable systems on the bottom axis there towards the right, and you're winning 2 times for every loss, then you're really starting to be profitable. And so it was an eye opener, because I thought, well, what do you mean you can be profitable if you're wrong, half the time or more than half the time? But that is absolutely the truth. And you talk to big hedge fund managers all over the place, and they will say that risk management and staying in a trade that's working, but managing the trades that aren't, is more important than anything else, to some extent.
And so what Alex and I have found, taking what we've learned from the institutional space and talking to self-directed investors, individual traders, folks who are working on shorter time frames, is that they spend a lot of time focused on their edge, their strategy. They're looking for that silver bullet indicator that's going to, help them pick the right security every single time. And they're a little less focused on their trading discipline and how they can be a patient investor when something's in trend, right? To resist the urge to lock in a gain after it's made that first 20% upswing. If it's gone up 20%, it's likely to go up another 20%, right? An object in motion tends to stay in motion. Same thing we've learned on the downside. People who go into bottom fishing scenarios for a stock that's down 70%, most likely thing after it's lost 70% of its value is that it gets chopped in half, and we've seen that over and over again. So we're gonna talk through GoNoGo charts and the ways that they help you analyze the market, pick winning trades, but also talk about how you can use these tools to improve your trading discipline. So let's dive right in. Anybody seen a chart like this? Heck, I've made a chart like this, right? All of us do this. We get enamored with technical analysis. We are amazed by the men and women of Wall Street who help discover, refine, and invent these tools. And each one is telling us incredible information. We want to add it on the chart. We want to add another one on the chart, and another one, and another one. The problem is, even with institutional investors, and Alex and I, when I first started at the CMT Association over 15 years ago, that was what I was coming to understand from the best money managers out there. Is that they had a rules-based discipline. They had a checklist, which meant multiple indicators on their charts. And when all of those indicators confirmed that a security was entering a trend, that's when they knew to buy. And then they had the same checklist when those trends were violated, when their rules were broken. That's when they knew to get out. That's a very responsible way to invest. You have your checklist, your rules, you use them the same way every time. You do not deviate from your strategy. The problem is with that checklist, and it can get long, you add more and more indicators to your chart. You deliver analysis paralysis to yourself, particularly if you're newer to technical analysis. You keep adding indicators to the chart, and suddenly there's enough lines on there to convince yourself of whatever you want to believe. And that's where the emotions come back into play. If there's too much going on in your chart, you can convince yourself, because indicators can be redundant and at times even contradictory. So we want to eliminate that, and we want to simplify our charting to keep our focus on price. So Professor Alex here, who I've got the great pleasure of working with for over a decade. He and I used to teach the internal hires at Bloomberg, do some seminars on an introduction to technical analysis, as well as Bloomberg clients. And then years ago, we started working with John Wiley & Sons. The CMT Association selected them as our publisher for the official curriculum for the Chartered Market Technician exams. We'll talk more about that this afternoon. But they needed a subject matter expert. They needed a professor of technical analysis to help with all of their CMT training programs. And I said, have I got the guy? So Professor Alex, why don't you talk to us a little bit about how institutional investors might build a chart with multiple indicators that would tell them when a security gets into trend?
Yeah, and hopefully, if anybody is working through that program, they're not sick of my face and voice yet. I think there's about 110 video lectures out there.
Yeah,
it's a very, very comprehensive, great program to really give yourself the absolute jump start in technical analysis. But yeah, and what you mentioned before was really the analysis paralysis, or the overcomplication of charts, is really something that's a problem across all of the industry, and depending what your role is. It's not just somebody who has a good checklist that makes the chart complicated, but like you said, maybe somebody new to technical analysis, or maybe a technician who's working as a sell side research analyst that's struggling to explain what they're seeing to the buy side. In all different areas of technical analysis, overcomplicating the chart can be a problem. That's what we've found. But for right now, we'll quickly walk through just how somebody might go through the process of trend identification. It's arguably the most important skill that we have in technical analysis. If you can identify a trend, then you can absolutely make some money on the majority of the move, right? That's what we're all looking to do. We're looking to trade in the direction of the trend. And if you can do that, then you are going to be successful. Now, it's simple, but it's not easy, right? That's what we like to say. The concept is a simple one. Find the trend and follow the trend, but that's not easy to do, especially when your emotions get involved. So what might we do first? Well, the first thing we could do is just visually identify, is the price moving in a discernible direction? Are we seeing higher highs and higher lows? In this case, the chart's moving from bottom left to top right. Okay, we're seeing a trend. But if we were on the left side when this was starting, how do we identify the beginning of the trend? Well, we'll look for that first higher high or that first higher low. And then we'll want to automate that because we are all about removing subjectivity. And the way you could do that is with something like the Donchian channels, which is going to look back at a time period and assess whether the current price is the high or the low for the period. And if it's a new high, then that red line will move up. If it's a new low, the green line will move down. So you can see price setting new highs, stepping up through the trend. After that, where do you go from here? Well, you might throw something like Bollinger Bands on, right? Bollinger Bands, if you're familiar with technical analysis, we know that there are several ways to trade Bollinger Bands. The most common ways are, if the bands are narrow, we trade in the direction of a price break. If they're wide, we trade in a more mean reverting kind of fashion. So if we're looking for a trend, the beginning of a trend, we're going to try to find a situation where the bands are narrow and price breaks out in the direction that we're seeing the trend form. So you might throw Bollinger Bands on there and have a look to see what price is doing. After that, probably if you've been doing technical analysis for any length of time at all, you'll be throwing something like a moving average on a chart. Now, when I was working at Bloomberg, we didn't even count moving averages as a technical indicator. When we were trying to identify clients that were really technical oriented in terms of how they approach their investments, we didn't even count that because everybody looks at the moving average. But it's inherently valuable because when we see price above a moving average, we can really confidently say that price is higher now than it has been over its past however many days, right? That's bullish. That's definitely a bullish situation. And then we might throw volume on there and see if volume confirms. Volume being the first sort of confirmatory indicator after price, used by Jehal's Dow way back in the beginning. But if we're seeing a new high on the Donchian channels, we're seeing Bollinger Band break to the upside, we're seeing price above the moving average, volume is high, MACD now perhaps confirming by moving above its signal and above the zero line, right? Now we're starting to stack up all of these things in our favor and put the weight of the evidence on our side and say, somewhere over there in that left side, where we're sort of hovering that pointer around, probably just a little bit to the right of that, or somewhere in there, we're saying, yeah, okay, all of these things now are lining up. First, we saw a Donchian channel high, but then it corrected. But then price got above the simple moving average, and then it broke out of the Bollinger Bands, and then we saw heavy volume, and et cetera, et cetera, et cetera. So somewhere in there, we're saying we're fairly confident that we're seeing perhaps the beginning of a new trend. So that's a sensible, logical way to step through a process that will give you an intelligent framework within which to launch any investment. But the problem is if you can see already on this chart, it's starting to get a bit busy, and you might struggle then to look for support and resistance levels, to look for key price levels, to look for trend lines, to look for highs and lows, to see the market dynamics playing out in that price action. So it gets complicated quickly.
It gets complicated quickly, and I'm sure all of you have already understood that trend following is by nature a lagging indicator. But when we're using this checklist, that's even further drag on your entry point, right? So how many of these indicators do you want to wait for for confirmation? How late do you identify that, yes, indeed, this is a trend? And then you make the decision to get in. You wait for the confirmation, or the divergence of all of these indicators to know when to get out. That becomes very subjective in the hands of each individual trader. And as we said before, the emotions start to take over. Well, yeah, we're below the moving average, but I didn't see volume confirmation, or we haven't crossed below the second line of the Bollinger Band. All of those little devils in your head start ringing off, and you don't make a trade decision, right? So again, we're talking about that x-axis on the expectancy formula. We want to pick winning trades. We want to identify when the trend is in our favor. But then we also have to control our trading discipline, and for that, the solution is GoNoGo charts. Alex spent a very long time developing these tools and all of the computation that goes behind the individual price chart. And so what I want to walk through really quickly is just, you can see already that this is a very simplified chart, but in fact, it includes much more information than what we saw on the last screen. And we want to capture all that information. It's incredibly important to us to know where the moving average is, where the Bollinger Bands are. We want all of that technical information, but we do not want it to clutter our chart or to confuse our analysis. And certainly we do not want to impact our trade decisions with analysis paralysis. So when we see these colors, pink and purple are telling us we're in a no-go. So if you think about a shuttle launch, right? Are the conditions ripe to put a rocket in space? Maybe the weather's not quite right. Maybe the ground conditions aren't there. Maybe we've got some headwinds coming at us. Either way, we've got a strong and weak form of a downtrend, right? So purple bars are telling us we're in the strongest overall conditions of a no-go downtrend. Pink means the weaker form of a downtrend. We transition through these amber bars. That's a level of neutrality, a composite blend of all that technical information. All of those indicators are at their neutral level. Therefore, the market doesn't have a direction. And Alex and I have been fascinated by the life and work of Jesse Livermore, a man who's a fascinating read. But he had a great saying that said, there's a time to go long, there's a time to go short, and there's a time to go fishing. Meaning, if you are a trend following investor and the market is showing you that all of the inputs are in neutral, we don't know what direction, it's just choppy, sloppy, and messing around, let your trading account go. You don't need to overtrade when the conditions aren't in your favor. That's the point of that quote. But when we strike these green aqua bars, that's the lighter form of a go trend, right? All the conditions stacked up, the weight of the evidence say this has entered a trend. And when it reaches these blue bars, we know it's the strongest form, the most favorable conditions for a go trend or an uptrend. And that was really the point of all of this. Technical analysis is a way to visualize market data. Well, data visualization is really helpful to the human mind because we can see patterns, we can understand a lot of information quickly when it's visual. But the problem with technical analysis as a data visualization tool is that suddenly the data becomes overwhelming because we have too many tools on our chart. So we got to simplify, got to make that an elegant piece, but we still want to capture all the information. So moving right along, for those of you who are Metastock users, that GoNoGo trend indicator is there and available for you for free. Alex and I are very proud of this work. We've seen a lot of new traders and investors, as well as professionals, find a lot of success in these tools. We want to share it, but we're going to ask you one favor. When you start using this, let us know how it works. Shoot us an email. Tell us what you're trading, what your time period is, how you found this helpful. What else are you using? Maybe you have a strong fundamental discipline. That's fantastic. You understand the value of the companies that you're investing in. You know what they do, and you know why you're investing. But you control your risk. You make your trade decisions using price, and hopefully GoNoGo charts can help you with that. So Alex, on Metastock, they can just add this by applying a template, the GoNoGo trend indicator, correct?
That's right. Yep, it's as easy as that. Right click, apply template, and it'll be there. Fantastic.
Now, we know that price is most important. That's the most important indicator to us. When I first started at the CMT Association, Ralph Akampora, who many of you might be familiar with, he's the co-founder of the Chartered Market Technicians. He pulled me aside and he said, Tyler, the most important indicator we have is price. Everything else is a derivative. If you're stranded on a desert island, you need to know the price action of the securities that you're trading. That's the most important. Everything else is secondary. And Mark Abraham, a very successful trend-following investor, says ultimately it's the dollar-weighted collective opinion of all market participants that determines whether a stock goes up or down. This consensus is revealed by analyzing price. And over the last decade, I've heard so many incredible authors and speakers, practitioners and money managers at CMT conferences and events talk about how supply and demand relationships show up in price, right? That closing bar on a Friday afternoon settles what something is worth at the end of that week, what everybody agrees on as the final price to close trading when we're talking about equities here. And that, to me, just speaks volumes. That's all of the emotion. That's all of the belief. That's all of the fundamental analysis. That's all of the macro conditions for the economy, all piled into one agreed upon price. So we know that fundamentals drive all long-term trends, but we know that we can trade on price. That information is accurate. It's never restated. It's not an estimate. And you can get much more information from the markets than you can from companies in corporate America. So good job to you all being here, learning about technical analysis on your Saturday. Let's keep moving right along and maybe do a few together. How's that sound, Alex? All right. So if we're looking at trend conditions alone, let's just take a look at the S&P 500, the SPY ETF of the index. Where are we at the end of yesterday's trading, Alex?
Yeah, so this is been a very, very interesting couple of days. Really, since the beginning of the year, S&P struggled strongly since the beginning of the year. We saw that heavy no-go correction as prices moved down, making lower lows and lower highs. We tried to rally into a go trend, but really couldn't sustain it. And what we've seen over the last week or so, and then the last couple of days especially, is very volatile trading and a return to no-go. Now, what's interesting about this is that, as you said, the close is so important, right? And so when we do technical analysis, if you want to be really aggressive, you can certainly take a position or take an opinion as prices are moving throughout the day. But whatever your chart is that you're trading, most technicians will use the close, will wait for the close to see, did the close break above an important level? Did the close break above a moving average? Because as you said, the close is that agreed upon price at the end of the day, what people are prepared to buy and sell the security for. And the reason I bring that up again is because on Thursday, during the day, the penultimate bar here, that was a go bar still. It was an aqua bar right around lunchtime. And then into the afternoon, we really saw it tumble. And so that's one of the things that we like about using the GoNoGo charts. It's continuously calculating, and those inputs are being measured all the time. And you'll see it change as the bar is moving. You'll see sometimes on a volatile day, the color change. When it closes, it's, of course, it's locked in. It's never going to be revised. The closing price is used in the calculation. But it was a very interesting day, but just going on what you were saying about the close there. And then right now we're in a weak no-go trend.
Now, as Alex was saying, these are daily bars. So what we're looking at on this chart is the end of 2021. We came into 2022. And let's, if you can, just rewind your mind, right? We rallied in a historic fashion off of the 2020 COVID lows. 2021, still a pretty strong year, full of rotation for sure. But the market was up. That's the second year of a bull market. We get into the start of 2022 and we get a no-go bar. Now, the rules-based discipline that Alex and I believe in, that we use, says you just get out. You can always buy back in, right? But the weight of the evidence, the composite blend of all those technical indicators, the checklist is telling you, get out. Trend's over. The trend is broken. So let's just say this is a isolated no-go bar, and we're back into trend, right? It was a head fake. It's, you know, a bear trap. Well, that's great. We buy back in, right? We can buy back in higher, and we can capture the meat of the move for a trend that continues here. But what we have done by following our rules, right, because nobody knew what the rest of the first quarter was going to look like in 2022, we just avoided all of that downside. And if playing short is part of your game, you can use GoNoGo Trend to capture moves to the downside and short the market, knowing when the trend has continued to be in that downward motion. Same thing here. Buy in on a go trend, we're out on a neutral. Now, what we talked about at the beginning with the expectancy formula means that we can handle a small loss, no problem, right? We're basically out right where we got back in. What we cannot afford to do to our accounts, for our clients, for our firms, is take a huge loss. We cannot handle that 40% drawdown. That's career suicide. That's the end of the trading account. That's where we have to protect ourselves against risk. So by following the rules, again, not forecasting what's going to happen in the future, but just reacting responsibly to what the market's telling us. So these are daily bars, but as we know from Charles Dow over 130 years ago, there are multiple time frames to the market. Charles Dow, being a nautical man, compared the markets to the seas, and he said the primary trend, the thing that's unflappable, this is driven by the macroeconomic environment. This is GDP growth for the nation. These are the underlying fundamentals of the companies that are producing goods or shipping goods, in the case of the transports index. He said the primary trend is like the tides. This does not change. You can count on that, and it's a very durable trend. So we got to understand, what is the primary trend that we are trading around? Is there a bias to the market to the upside or to the downside? Then the secondary trend, which he compared to the waves on the surface of the ocean. You see the secondary trend push above and come below, and push above and below that primary trend. Technical analysts have understood this multiple time frames aspect and profited greatly. So if you can understand the bias of the market and you can trade that secondary time frame, right? That secondary trend means that you're taking entries on the dip, you're exiting as we become overbought and overextended from the primary trend, and over and over and over again. We know markets mean revert. And then the minor trend, the third period, this is the ripples on the surface of the water. And for many, that shorter intraday period, that's where they've found their niche, and good for you. What's important about this lesson here is that any technical indicator worth its weight is going to work the exact same way on any time frame. So that last chart was a daily chart. Alex, let's dive into something a little longer term. Let's take a look at the weekly chart of the S&P 500.
Yep. So this is the weekly chart, and you can see that rally through 2020 all the way through into towards the end of 2021, where we started to then struggle. We saw no-go bars, we saw a couple of amber bars, and you see now a lower high in place. And of course, this is all really like popping off the chart because there's nothing else on the chart but price, right? So we see that lower high, and now we see a no-go bar on the weekly chart. So now we're starting to say, okay, daily chart, no-go, weekly chart is a no-go, and has been in a no-go really for 5 or 6 or 7 weeks there. And then you might say, okay, let's go down a time frame. Depending on your role in the industry, maybe you're a savvy individual investor, or maybe you're a trader working for a PM, whatever it is. You know, the larger market bias that you said, that primary trend is now a no-go. So if we're going to now trade around the direction of that no-go, the daily is also a no-go. Maybe we go down into a shorter time frame to find a sensible entry, or to make sure we're trading in the direction of the trend. So if you go down to, this is actually, sorry, a mistake, that's a 60-minute chart. And I think I have a 2-hour chart label up there on the top. This is a 60-minute chart. You step down, and now you're saying, okay, well, we know the overall trend for the past 6 or 7 weeks is a no-go. The daily trend is a no-go. Maybe we don't look for goes on this shorter time frame, because that's going against the time for the overall trend on a larger time frame. So maybe we're only looking at participating in the no-go trend that we're seeing, and so we look for no-goes on the shorter time frame. So there's been an opportunity in the last couple of days to enter a no-go, and there's certainly been an opportunity in the last couple of weeks to take advantage of that larger time frame no-go trend, the primary trend that's in place. One thing just to know is that for everybody on the call, this might be different for you. We work with people that trading 1-minute E-mini charts, right? Mm-hmm. So your primary trend may be the daily, or maybe even the hourly, right? And then your the secondary trend may be the 15-minute, and then maybe you look for entries on the 1-minute chart. So the beauty of technical analysis is that it is fractal by nature, and any good process should work across all time frames and all securities. So we're talking about the weekly, the daily, and the hourly. We work with some long-only fund managers that are all about monthly because they're rebalancing every quarter. So it really depends on your investment style and your own risk appetites.
Absolutely. Well said, Alex. We're not here to tell you what time frame or what your risk tolerance should be. These tools are universally applicable. And I have to say, Jeff Gibby and friends, you have brought a fantastic audience to this conference. Vinod, I see you in the chat, and you're asking the exact right question. Is this just for equity indices? What if I trade individual stocks? What if I trade commodities? How about cryptocurrencies? The fact of the matter is, any technical indicator worth its weight is going to work across all time frames, and it's going to work on any publicly traded security. Anything that's got liquidity. We don't use GoNoGo charts on the private art market yet, but we'll talk to you in the next 20 years about how we can figure that out. Alex and I are students of the market, and we have loved and appreciated all the works of John Murphy, who is a CMT charter holder, past president of the organization that I've spent so much time with. But we've also studied the works of Marcos Katsanos, who's in the CMT curriculum, about quantifying the relationship between markets. Now, this next section, we're going to talk about GoNoGo trend across all of these asset classes. And I want to just say that if you are an equity-only investor, no problem. Maybe you're not trading commodities futures, but there is information in the commodities markets that will help you with your equities trading. Same thing with the credit markets. We have to understand what's happening in the inflationary regime that we're in. We have to understand where government treasury rates are at. And all of that is going to affect what plays out in the equity markets. In particular, what sectors of the S&P 500 are going to be relatively outperforming on an absolute basis. So, Alex, let's do a quick round robin. Same thing, daily charts, GoNoGo trend only across all the asset classes.
Yeah, and this is to your point. Just you need to be aware, and it gives you a sense of, like, if your requirements are to be invested in the equity markets, okay, but perhaps knowing that commodities have been the story of the year would steer you in the right kind of equities, right? So really quickly going around here with something like the GoNoGo trend, you can throw up a multi-chart layout on Metastock, and you can quickly get a sense of where to look, fish where the fishes are, which I know you say all the time, and it's a great quote. So on the equity markets, we're in a weak no-go. Treasury prices, which is the second one, is a strong no-go. Treasuries prices, remember, move inversely to rates. So we're in a rising rate environment, bond prices coming down. US oil, strong go. There's been a really, really strong trade all year. Has had some volatility lately, but still in a strong go. Bitcoin has get chopped around, and Bitcoin is now back in a no-go, a weak no-go, painting those pink bars. Gold has also been really, really strong, but has consolidated sideways. And interestingly, right now, the current bar is an amber go fish bar. So we've seen strength in gold throughout this year, but right now we're a bit uncertain. And then on the far right, on the bottom, the US dollar, really been on a run, right? Really been on a run. There was a lot of discussion, debate. How is the rising rate environment going to affect the dollar? How is this going to affect commodity prices? Well, you can just see it on the chart. The dollar is in a strong go trend and has been for a few months. So going around like this, just getting that quick overview of what's happening can then point you in the right direction on a purely trend basis.
Absolutely. Very well said, Alex. Now, I've seen a couple of other questions in the chat, in particular about the age of that SG behind your right shoulder. Alex and I are real human beings, and we do have other passions in our lives, including music. And we would love to talk with all of you all day long about music and bands and whatnot. But congratulations. You've made it to the 50-yard line. We're halfway through this presentation. We've got a lot more to show you. But hopefully you have understood that the concept of trend, that is what technical analysts are trying to do. We want to identify when the trend begins, capture the meat of the move, and then get out when that trend ends, right? We want to responsibly manage risk and be patient to that upside to not lock in our profits too quickly. It's a simple but not easy thing to do. So we want to simplify our charts and make those trading decisions a lot easier. Let's just keep cruising right through. The next half of this presentation, we're going to talk about the complete GoNoGo chart solution, also available on Metastock. And I just have to say a huge thank you to Jeff Gibby, to the entire programming team. The implementation of these charts with Metastock is fabulous in terms of the way that the implementation went. The look of the charts is fantastic, but they've also developed some really key features that we're going to get to here at the end. But we want to expand on this concept of blending indicators, capturing more information in a simple, elegant way on our chart. So we've been talking about this top price panel. That's the GoNoGo trend. That's a free template for you to try out on your Metastock charts. But we also know the concept of momentum is incredibly crucial to technical analysts, as well as volume and volatility. So we're going to talk a little bit more about this bottom panel and the additional GoNoGo indicators that will help you optimize those trades. Back to you, Professor Alex, to talk a little bit about momentum.
Yeah, we'll roll through this, but it's the same idea, blending concepts together that have so much value into something that we can easily understand and read, right? That idea of data visualization democratizing the sort of understanding for the end user. So momentum, really quickly, when I teach momentum, I try to put it in the context of driving cars. I'm British, and World Rally and Formula One is in my blood. These are your kind of cars. They're not my kind of cars. These are definitely not Formula One or World Rally. But the idea is that momentum measures the rate of change of price. So it's really measuring acceleration, right? It's understanding the velocity of a price move. And so we talk about if you're driving on, getting onto a highway, you'll increase your speed at a fast rate. And for a while, it might be increasing at the same speed, right? 10 to 20 to 30 to 40. But then as you get closer to the highway speed, which round here is a pedestrian 50 in New Jersey, you might get faster, but not as quickly, right? So you might go from 40 to 45 to 48 and then to 50. Now, when you get to 50, unless you're planning on spending a night or getting a ticket, spending a night in, well, depending on how fast you go, right? But unless you want to get into trouble, you're probably going to drive the speed limit. So that increase in acceleration and speed is topped out. And that's how we think about momentum. The car is still getting faster, but more slowly. And then when it hits that top, that 50, there's only really one option. You're either going to keep going at 50 or you're going to pull off, take your exit, slow down, right? So we can see that kind of thing when we're looking at momentum. And that's really, really key for us because momentum tells us so much about the strength of the price move. Now, we're not going to go through all of this, like we built that trend identification process. But think about it. When we look at charts, we add so many useful things on the chart. RSI, MACD, you name it, DMI. This sounds like the alphabet, right? But you could go on and on and on and on, right? And they're really good. They're really good. And I fell in love with so many of these indicators because they give us such good information. But if you throw all of this on the chart and you add it to what we discussed in trend identification, now imagine that chart. You're really starting to look at a chart that you cannot see price anymore, and it's really, really, really overcomplicated. So if we move on, what we came up with was the GoNoGo oscillator, which is the same idea as the trend, taking all of that information, but blending it into one indicator that gives me everything I need to know if I go to talk to a client in the institutional space. Now, as any good oscillator, it can be used in a traditional sense to find levels of overbought and oversold, right? Those will typically pull out the peaks and troughs in price movement. We can also identify divergence easily because we just got this big price panel and then the one panel below. So you can see when price is making a higher high and the oscillator perhaps is not confirming by making a lower high. That's very, very important concept in technical analysis. And then, of course, we also wanted to include volume. We talked about volume at the beginning being that first confirmatory indicator separate from price. And so in Metastock, when you see that dark blue ribbon along the bottom, when it's dark blue, that's saying we've got heavy volume. So that section right now where that pointer is highlighting, where we're seeing a no-go trend take place on heavy volume in that section there in the middle of the chart. But then we saw the divergence leading to what we see happening later on in the chart. So that's the traditional way to use any good momentum oscillator. But what we hope to show is that there's some unique aspects to the GoNoGo oscillator that can really help understand the trend and how to stay with it.
Now, this chart is about 20 chapters of the CMT curriculum. There's a month worth of learning here about all of these concepts. So I apologize to everybody on the line for how fast we've moved through that. But we've got a lot of additional charts to cover. I think what Alex was talking about with the divergences, both bearish and bullish divergence, how you would think about momentum is the investor public coming in to participate in that trend. When you've got strong momentum, there's more buyers piling in on a trend. We could talk all about the behavioral scientists that understand the herding principle. We call it price momentum or trends in the marketplace. But as I said, we gotta move on, and we're happy to take some questions offline from you as well. Alex, let's talk about the very unique nature of the GoNoGo oscillator in terms of its objective zero line.
Yeah, so this is really, to me, one of the best pieces of the chart, because I grew so interested in research around how you could use momentum tools in trend. We know, if anybody on the line has done some technical analysis studying, that momentum oscillators were designed for a sideways market, for a range-bound market where prices mean reverted, went up and down and up and down. So every time the RSI, for example, if you're familiar with RSI, probably the most commonly used momentum oscillator, every time the RSI goes above 70 and comes back, then we expect price to mean revert. Every time the oscillator goes below 30, we expect, and then comes back, we expect prices to mean revert. But the problem with that is that when a trend is really strong, and those are the ones we want, right? When a trend is really strong, the oscillator just goes overbought, and then it goes overbought, and then it goes overbought, and it never goes oversold. So it never gives you that buy signal, because it doesn't get below 30 and then come back into its neutral territory. So what was researched by people like Connie Brown, great literature about it, and others, is that when a strong trend is in place, these oscillators range. And what that means is they'll go overbought if we're in an uptrend, and they'll come back into neutral territory. They'll go overbought again, they'll come back into neutral territory. And so much is done to try to find what that range is. Maybe it's 40 to 80. But then what do? We reintroduce subjectivity, right? Because if we're sort of trying to look for an RSI to trade in that range, RSI and all these oscillators are very, very choppy. And so do we say 42 counts as a touch of support? If the oscillator goes to 39, 38, do we count that as a break of support and think that the trend is over, right? It's very subjective and hard to have a consistent range. Also across assets, people will revise those ranges. And so you end up doing a lot of subjective work. We created the GoNoGo oscillator in a way where the oscillator will fall to a zero line if all of the inputs to the oscillator are in their neutral territory. So that allows the oscillator's zero level to act as an objective level of support if we're in a go trend, or resistance if we're in a no-go trend. So throughout a trend, when the trend is healthy, what you'll see is the oscillator rallying into overbought territory and coming back to touch that zero line, to find support at the zero line. And each time we find support, we know that momentum has come back now in the direction of the trend. And that's really valuable because it allows you to stay with the trend.
You are, we're cruising through a lot. I hope you are all sticking with us. And one of the reasons that we believe in technical analysis so much, that visualization of investor behavior, is that it has consistently played out. And we know that data visualization can help traders understand that moment of entry or exit even better. So in addition to that GoNoGo oscillator, identifying that objective zero line, when momentum came back to neutral and when it's resurging in the right direction, we've also added icons right to the price chart to help you identify those moments more quickly. Now, when I first started learning about momentum, Alex was comparing that to rally car racing and the rate of change, the acceleration. Ralph explained it to me in terms of baseball. He's from the Bronx. Everything's baseball for those guys. He said, Tyler, if you have a baseball in your hand and you throw that up in the air, the minute it leaves your hand, it's got the most oomph. It's got the fastest rate of change. It's moving as fast as it possibly will. And you throw it up in the air and it reaches the apex. It's going to slow down as it reaches that maximum height that you threw it. And then it's going to come back down to your glove. And you're going to throw it again. And it's going to come back down to your glove. You're going to throw it again and come back. If you drop it, if you don't catch it, that's your oversold. That's where it went through the glove, fell to the floor. And so when we're looking at this GoNoGo oscillator, just picture, this is a happy game of catch. Every time it comes back down to the zero line, it's caught in the glove. ball is safe, gonna be thrown again. And the way that trend following investors like to manage their portfolios, and Alex and I have worked with these folks for many, many years, they're looking for those outsized gains by scaling into positions. So every time the price is going to correct a little bit, right? We've reached this overbought level and it's retreated, and we reach overbought and it retreats. Those retreat points, right? They want to buy those dips. They want to add to their position. They want to really press their bets when that trend is in place. They want to get in at a relative lower price than we see. And we know that those trends take the stairs on the way up. So using these tools, every time it comes to the zero, that's your confirmation that when momentum returns in the direction of the underlying trend, that's where we can really press our bets. So Alex, let's cruise through these icons here in our last 9 minutes.
Yeah, so the first icons that we're highlighting here are those trend continuation ones, which is really that extra piece of using the oscillator and its interaction with the go-no-go trend. So every time the oscillator finds support in a go trend, we will show those green circles on the chart, telling us that it's a relatively low-risk opportunity to take part in the trend. Momentum has come back in the direction of the trend. If it was a no-go, those would be red circles saying, yes, the no-go is likely to continue. The second icons that we have on here are these counter-trend correction arrows, and that's because there's so much value in using an oscillator in its traditional sense, right? And my process has always included oscillator information because of how valuable it is. So we also want to know where those areas of overbought and oversold situations are. So when we display these counter trend correction arrows, it's marking the end of an overbought condition when it's red arrows, right? So oscillator has gone into overbought territory and come back. Think about that like the RSI again, going above 17, coming back into neutral. We're going to display those moments on the chart as well. And they suggest that in the short term, prices may struggle to go higher. The trend's not over. Go-no-go trend still says it's a blue bar, but perhaps in the short term, we may consolidate or correct slightly against the trend. And then we look to the zero line to see if that trend holds.
And it makes sense, right? Wells Wilder and other great technicians of the 1970s were trying to come up with tools to help investors understand this range-bound market that went on for years. And so that overbought, oversold, that worked really well in the 70s. And we have to adapt as the regime changes in the markets. And thanks to Connie Brown and others who have understood how those momentum oscillators can be used in trend, we now have the GoNoGo oscillator that's bringing that together in an objective, observable way for you to time those entries and exits. All right, we've talked about trend, we've talked about momentum, we've talked about volume, all of that information in a clean, elegant chart. Alex, the last piece here is the GoNoGo squeeze, a volatility indicator that helps us identify that tug of war between buyers and sellers. Talk to us a little bit about what we are seeing in this orange grid.
Yeah, this was the last piece for me. I wanted to be able to talk to anybody and give them a complete overview of the technical environment, right? Whether it's an oil trader or it's a mutual fund manager, it's a rates trader, an FX trader, whatever it is. So for me, the full complete picture had to include volatility. So if you're on the line and you've done some research and studies, or if you've used technical analysis for a while, you'll be familiar with things like the Keltner band squeeze, the Bollinger band squeeze. And I always think about volatility reduction as squeezing a tube of toothpaste. And if you squeeze that tube enough, the cap will pop off and something will happen. You'll make a mess. But that's what we're looking for in those situations. We're looking for volatility to reduce. And we know that that can't continue forever. There will be that tug of war between the buyers and the sellers, and one will overwhelm the other, right? One will win. And then we'll see price move to a new level of, commonly agreed upon trading price. So when we see the go-no-go oscillator ride the zero line for an extended period of time, we're going to see the go-no-go squeeze grid climb to its extreme. So for each bar that the oscillator remains at zero, the grid climbs. Now we know now the importance of the zero line. We know how important that is. It means that all of our inputs to our momentum oscillators are in neutral territory. There's no directional momentum pull. So as that continues, we're seeing the squeeze build. And then typically a break of a squeeze like this could lead to a significant move in the direction of the trend, which we'd expect all else being equal, or in the other direction, and that would really tell us that the trend is in danger.
So let's just look at this chart for a second. We're in a no-go trend. Strong no-go on these purple bars, a little weakness to the overall trend conditions in these pink bars. The GoNoGo oscillator has been negative. We have oversold momentum. We have more sellers than buyers as it comes down through this no-go trend. Every time the oscillator tries to get through that zero line, it hits resistance. And we know from the concept of polarity, once resistance is broken, it will then become support. So this volatility indicator, as we are making this bottoming process, the volatility range of price is tightening, tightening, tightening like a loaded spring, and we've got a max squeeze. All else being equal, we would expect this to resolve to the downside, right? There's indecision, and then typically a trend in place is going to continue. There is so much information right here. When this oscillator breaks above zero, we have positive overbought momentum, more buyers than sellers. They're coming into the market, and when that trade reverses, when trends reverse, think about all the investor psychology. No, I know it's a no-go. I'm short this market. Oh, crap, I'm wrong. I got to cover my shorts, and then everyone piles in onto that new go trend. That's what drives price over the long period, because it takes time for more and more of those investors to recognize the new trend and come into place. So this volatility squeeze is an important piece of the GoNoGo charts puzzle that identifies those moments of trend reversal. All right, Alex, I know we're running a little short on time. We want to do a few examples with you all and look at some current charts. There's really just three things that we need to know. All of the information of the market is captured in these GoNoGo charts. Let's do a few together, identifying where the trend is at, where the oscillator's at, and if anything important is happening at the zero line. Alex, let's cruise through these. You lead.
Yes, sir. So this is energy, just because we recognize the shift, the cyclical shift at the beginning of the year into these kinds of value sectors. So energy has been something we've been watching for a while. It's been a strong trade all year. Right now, where are we? If you're in the chat, throw your answers in. But basically, all we need to know is, what's the trend? Trend is a go. It's a weak aqua bar, but it's still a go. Where is the oscillator? The oscillator is at -1. It's been testing and finding support at zero for this entire move. Is this important information that it's now at -1? Yes, absolutely. We would like to see it stay at zero or get above zero back into positive territory if this go trend is to remain healthy. And that's where we are on the energy sector. If we move on to the next chart, this is a specific trade that came out of that information that we were looking at when we were seeing that shift. MRO, a great trade again this year, but we're looking at it fairly similar. A weak go on the current bar. Where's the oscillator? At zero. Is that important? Is there anything important about the zero line? Yes, the oscillator's at zero. That's very, very important. We will watch to see if that holds as support, because we know it should. If this go trend is healthy, we should see the oscillator hold as support. If it dips below slightly, we should see it get back. But a significant break of the oscillator to the downside would be a threat to the go trend. So we're watching this now to say, will we find support at zero? And will that lead to another leg higher in price? We have to wait and see.
Now, we had some questions in the chat about, how do you pick which sector or which securities, what asset class we should be trading? And so for Alex and I, the rules-based, the process-driven work happens in our analysis as well as in the charts. And so we published research for all of our institutional subscribers. We do a weekend chart pack that's launch conditions, comes out Saturday. People to step back, look at the global trends across all sectors and indices. And then we also publish a newsletter every Monday morning called Flight Path. And that's going to take a top-down approach. We're going to start with the asset classes, see how they're performing on an absolute and a relative basis. We'll have another seminar with Jeff and our Metastock friends about relative strength another day. But then we dive down from the asset classes to the sectors and then into individual names. And that's the repeatable analytical process. And we can use GoNoGo charts to help us identify what's leading between the sectors and where, as Alex said, we want to fish where the fish are. So we're going to pull a couple ideas just from our recent research. As Alex was saying, we work with all of these clients. We listen to them as well. They pay us for the charts, but we are constantly learning from those big PMs what it is that's thematic, what's driving their allocation. So energy trade has been a big one. All of the value sectors outperforming growth this year. We look to the GoNoGo charts to manage those trades. But then, of course, with premium research, we know that people are also looking for individual trade ideas every day. Those come out pre-market weekdays. Let's take a look. Console Energy, challenging prior highs as the momentum returns, right? We see the break of that little squeeze, momentum coming back in the direction of the trend for CEIX. Alex, let's walk through CQP.
Yeah,
Energy Partners.
Yeah, this is Cheniere Energy. Actually, this is this is taking that console chart, I believe, and looking at what happened after that premium idea. But the point is that we give out we give the research on a weekly basis. We dive down daily, and we give these trade ideas, trade setups on a daily basis as well. It's the same process. Where's the trend? Where's the oscillator? Is there anything happening around the zero line? And I know we're running out of time, but I did just want to talk about the two features on Metastock that are just so super cool and important. So if we can run through these really quickly, then we can sort of just about finish on time. But with Metastock, expert commentary, if you're a Metastock user already, you probably use this all the time. It's fantastic. And so what we were able to build with Jeff and the team was really our process clickable on the chart. So if you click on any bar of the chart, you can launch the expert commentary, and it's like having that previous few screens right there with you. What's the trend? What's the oscillator value? Is there anything happening in terms of icons? Is there a volatility squeeze, and what does volume look like? And it's like having us just run through that on every single chart. The expert commentary, I really love it because you can get that complete overview of the technical situation of any security right there in plain English when you open a bar of the chart. And then the second thing, I don't know if you wanted to make a point.
I was just going to say, back in the day, sell-side analysts, they went through hundreds, if not thousands of charts individually to see all the patterns. Alex, trading is not something that I can do full-time every day, all the time. I got to find a shortcut. Talk to us a little bit about Metastock explorations.
Yeah, I mean, and once you have defined your process, then what do you need to do? You need to find securities that meet those criteria, right? But that it used to be, click, S&P 500 chart books, next one. And what we do with the Metastock explorations is just say, show me all the goes on the Russell 3000. Find me the max squeezes in the S&P 500. Find me any security that's giving a go trend continuation icon because I want to look for securities that are in trend and finding a resurgence in momentum. And you can do that in a flash using screening capabilities in the Metastock exploration. So I know, again, we really kind of flew through there at the end, but these two features of Metastock are super helpful to us in what we do and also to users of the systems as well.
Yeah, Jeff and the team have really done an incredible job adding additional features and ways to make these even more powerful for you. I just wanted to close on this Netflix chart just to illustrate the point that you don't know what's going to happen in the future, right? But we do know that if we follow our rules, we get out when it strikes a no-go, we're saving ourselves all of the headache. Alex and I didn't know there was going to be a gap down and another gap down as more and more fundamental investors understood that the business model for Netflix is not working as well. They're losing subscribers. That's all the fundamental information. But we knew in price, all the way back here, what was no longer in trend. And so for everybody who's watched today, thank you so much for your time, your patience. Jeff, I know we've got a very full day of expert lecturers here at the Metastock Traders Summit. But from Alex and I really want to just thank you all for sticking with us. By all means, reach out to Alex and I with any questions, and we'd be happy to see you again at the next seminar.
Great job, guys. Thank you.
Hey, thanks, Jeff.
All right. It's good to see you. I'm going to talk to everybody about how to get this and kind of the special that we're offering. You guys have let us do a really good deal on it. It's been super powerful. Wow, I look younger shaved. Okay, so thank you for coming in, and we'll see you guys again soon.
Sounds great. Thanks, Jeff.
Thanks, Jeff.
Thanks, guys. All right, give me just a second to kind of get everything kind of just resituated to me. So, and then let me go ahead and turn on the screen share here. We do such a great job, and it's been a very, very popular add-on. They also do a good job of showing things that I really love about Metastock that make it like super unique, like the ability to scan for ideas and the ability to test. And, you know, I do know that we're a little bit over on time, but I do want you to let you know real quick that even though that we may have missed some questions, or if you want to see charts, or if you want to get more information, feel free to get in touch with us. You can, our sales, we've got a couple of people on our sales team available today to answer any questions, help you get set up, send you charts, anything that you might want. And you can get a hold of them at metastock.com/sales chat. So in any case, though, Alex and Tyler did a really good job about talking about the GoNoGo Complete. We just released this, it was in January of this year, and it's been extremely popular. People really have enjoyed this add-on. It's been a very, very brisk selling add-on, and the feedback has been great. So they talked about the trend, the oscillator, the icons, and the squeeze. And they did, like I said, they did a good job of that. I love the fact that you can go in there, you can kind of run a quick scan. In fact, just to go through the scans that are available, I did run one. We're not going to kind of show the results, but I ran one on about the S&P 500. But if you're interested, one of the things I love about Metastock is if you're interested in just the stocks that have a squeeze pattern, here you go. Here's an exploration result that actually has all of the squeezes. Or if you just want to find ones that have a bullish trend or a bearish trend, or I guess it's in a go trend or a no-go trend, right here, you can scan through any list that you want to find stocks that kind of are meeting that criteria or that pattern. And then there's also one for the icons here as well. So very, very easy to go through large amounts of data. And that's one of the things I love, because I stay fairly busy every day. And what I love to do, usually about 1:45 our time, I'll run a quick scan of the market and just say, okay, what exists? What should I look at? Let's see what we need to do. And that's really kind of the fact that I can go through those stocks and just get rid of all of the noise, focus on the ones that have an opportunity, means that even me, who I have a very, very busy day, I can actually kind of get through all of the trade decisions I want to make, and it usually takes me just a few minutes. So I love the convenience of that. I love the ability to do that. So in any case, let's kind of keep moving a little bit. The GoNoGo charts Complete is a one-time package purchase. Here at the webinar, it's normally $1,495. Here at the webinar, we have a discount where we're going to give you $500 off. It's $995. We are going to back it with a full 30-day money-back guarantee, so you can try it out. If you don't like it, if you don't think it's going to be helpful for you, you can cancel. You can basically, we'll give you a refund. But part of that purchase is actually going to include some training where Tyler, Alex, and I sat down and they did a part where they kind of talk about the different patterns. I talk about how to run scans and experts and explorations. It's going to include that. I can't remember exactly how long it was, but it's available immediately as soon as you place your order. If you don't have a copy of Metastock and you're like, hey, maybe market scanning is going to be something that's helpful for me, or I like the commentary or the way that the brand new charts look, we'll give you, as part of your purchase, a free trial to Metastock, which means you have no risk. You'll pay the $995 today. If you're not happy, you'll get that back as soon as you decide you want to cancel your order. And we'll back that, again, as you see, with like our 30-day money-back guarantee. So you can take advantage of that. Give us a call, 800-882-3040. You can also, like I said, chat online with us at metastock.com/sales chat. Or you can also visit a website at metastock.com/GoNoGoA. Okay. I also want to say we have a number of different presenters today that are actually speaking. We do have a package that includes all of the add-ons that we've designed with these presenters. It includes GoNoGo Complete, the MQ Trender Pro, the brand new Wave Trader add-on that we're going to show you in just a little bit, some training we did with a good friend of mine, Oscar Carboni, 2 years of Stocks and Commodities magazine, a 3-month subscription to learnmetastock.com, Unleash the Power of Metastock, a workbook, videos you can go through. Normally, all of that would be $4,530, but we always try and kind of give a huge discount at these events to help you get started, help you give it a go. $2,245, almost. I'm going to say that that's actually about half off. It's more than half off, just by a little bit. So you can take advantage of that if you go to metastock.com/summit deal. You can give us a call at 800-882-3040, or you can visit us Come online and chat with us at metastock.com/saleschat. It's a great opportunity to try the software. The software has been rated #1 more than 29 years in a row, I think it is now. Decades, I should just say, so I don't have to keep track. 800-882-3040 or metastock.com/saleschat. So there you go. Real quick, I want to say thank you to Stocks and Commodities for sponsoring the event today. They run a very good magazine. We love them. We really appreciate the support. They've supported Online Trader Summit since we started. And what really blows my mind is I think we've been running Online Trader Summit for like 9 years now. So hopefully you've been to a couple sessions. If not, maybe you just stumbled across this on YouTube. Be sure to like and subscribe so you can come to the next one and be invited. In any case, they're going to offer you a free magazine. If you want to, you can go to metastock.com/tradersummit, Trader-Summit, and they'll sign you up for that. So our next guest is John Osborne. John is also a very good presenter. He's also a man that likes to wear a lot of mini hats. He actually programmed the trender that he's going to show you today for Metastock. He did a really good job. I also think he's an awesome presenter and really smart, actually. So let's go ahead and get you on here, John. And I know we're starting a little bit late, like 11 minutes late, but that's okay. Let's go ahead and kind of just see where you're at. Okay, John? I can see your audio's on, but I can't hear you. If you can hear me.
Now you can hear me, right?
Yeah, there you go. Good.
Voila.
We didn't even have to go to the oh crap video, so so everything's good. Okay, so I can hear you. Let me go ahead and give you the presentation here.
All right.
I know we're running just a little bit behind. Don't worry about time too much. Take the time that you need. Greg asked a question though while we get your presentation going. Do you include all U.S. stocks, including IPOs? Yes, we do. In fact, Greg, that's a really good question. We cover like 300 different. Well, I can say about 300 in case it's a little bit lower, a little bit more. 300 exchanges globally. So about 90% of the global market cap. So if you're interested in U.S., we have all of those, but we also get a lot of customers from like India, Singapore, Australia, you name it. So. I can see your screen, John.
All right, great. We ready to go?
I'll get out of your way. It's your turn.
Okay. Well, good morning, everybody, and good afternoon if you're a really early riser, I guess. I'm John Osborne. I'm from Basecamp Trading, and I'm here to tell you about something that's going to change the way you look at your charts forever. Because you're going to be able to see today some new technology that's able to route traders through a chart to find the best trades, just like a GPS can help you get where you're going, even if you've never been there before. So let's get started. Now, trading's risky, as we know. We don't want to trade with money you can't afford to lose. We have to do these risk disclaimers. We've done our best to ensure the accuracy of the information I'm going to share with you. This webinar is going to provide you with information you can use to help you make your own independent trading decisions. Past performance is not indicative of future results. The markets are unpredictable, which is good because that's how we can make some money on that risk. So you want to be prepared by having great tools and great techniques. Now, I also want to show you CFTC Rule 4.41, and that is the government wants you to know that trading has both rewards and risks. Don't trade with food or rent money, of course. And I'm not soliciting you to buy stocks, options, futures, or any other securities. Again, be careful. The market can take your money. And I always suggest trading in paper with any new strategy to make sure you're profitable in paper before you even think about using real money. That's so you can have real money left to trade when you finally are able to follow the system and use the tools. Now, today we're going to be talking about how to completely transform the way you are trading and start to seriously grow your account by using a very powerful technique that I like to think of as a stock market GPS. Now, imagine being able to approach the markets every single day, armed with sophisticated, but as easy to use as turning on a GPS, but the software that traders in our groups have used to double or triple and quintuple their accounts. Now, do you think you'd possibly improve your trading if you had a tool like that? I mean, just imagine being able to identify trades with pinpoint accuracy like a hedge fund does. Do you think that you'd be able to drastically grow your trading account if you had those tools? Well, if you've never thought that this was going to be possible until now, I have great news. It's totally possible for you to do this, and it's what I'm going to share with you and show you today. Now, this isn't just an incremental minor change. This is technology that's been in use by our best traders and even in powerful automated systems that we've sold access to. And today you're going to learn what a stock market GPS is and how it can improve your trading. This isn't just an incremental change. It's a powerful, fundamental way to identify trading routes that lead to the profits in the stock market. Like this one, this is transformative trading, like 700% gain in Tesla. It's $789 per share using this technology and these signals. Here's a 76% gain in Amazon using this technique. That's a gain of $1,535 per share. This is what I mean by transformative trading. Now, think about it. Do you think that if you can find trades like these, could they make a difference, a noticeable difference in your own trading? I hope that's the case. I hope you can get excited about this. Now, let me give you just a bit of history about who am I, and I want to illustrate and illuminate why I'm so passionate about helping people trade in the markets. And I've always been interested in the markets. Even when I was a kid, I watched my dad trade. He would look up stocks in the newspapers. He would stay informed on new developments through reading. We didn't have the internet back then. We didn't have all the resources, but newspapers carried stock information every night, pages of it. My father, he was one of those traders who bragged more about what he did wrong in the markets than what he got right. Still, he did pretty good. He did okay in the markets, but I know he always thought he could have done better. And he got me inspired to learn more about the stock market. And he made sure I understood that making money in the markets is how you stay ahead of inflation. And it's where you get where you want to be. So I dabbled with trading here and there, as a kid even, and then as a young adult. And like my dad, I did okay, but I wanted to do better. And I started to get more actively trading in the 90s. But when that dot-com bubble burst, I and so many others saw the end of that easy money that even monkeys, literally monkeys, made in the 90s. So I decided to take whatever training was necessary to learn how to trade. And then I thought I could share what I learned with my dad, then he could enjoy trading in the markets too, more than what he was doing. So that journey was a lot more complicated, a lot more effort than I expected, and it took a lot more money and time, that's for sure, than I can even imagine. But it wasn't until I finally got involved with Basecamp trading that I learned what it takes to be a successful, confident trader. Unfortunately, I wasn't able to share that knowledge with my dad before he passed away. But since I wasn't able to teach my dad, I now teach others like yourselves about trading in hopes that you can reach your own trading goals. And then if you learn this and you teach someone else, you can teach other traders to do the same, and they could teach even more people. So it could make a big difference in the world, or at least for many people. Maybe some of you or some of the people listening to this could even teach your own dad how to trade when you still have the chance. Or you might have your mom you want to teach how to trade, or your son or your daughter. Imagine passing on this skill. And I know that helping so many others to achieve their own goals in trading is something that would make my dad proud. That's why I love to share how to pull money out of the markets with traders like yourselves, people who are genuinely putting in the time and effort to learn how to trade. I already know that about you because you're here. You made a sacrifice to take this part of your Saturday to better yourself. So let's learn how to pull more money out of these markets. Now, I'm going to let you in on a technology that can help any trader be a better trader. I'm going to explain how this powerful tool can make a huge difference in your trading. It's going to completely transform the way you trade and revolutionize the way you pull money out of the market yourself. Now, I hope you're going to share this with your own family and your friends and help them achieve their goals, because then they'll help you get excited and stay excited, and it won't get boring when you start just generating income. So it can get a little boring if you keep doing the same thing, but you have to think about what that money will get you to your goals than just the mechanics of trading. We don't want trading to be exciting because we don't want you to trade with emotion. We want you to trade robotically. So I'd rather have you stand there cranking the wheel, making money come out of the market than saying, having all the excitement and the risk of trading. So let's get started and see how we can get somewhere when we have a trading GPS. Now, sharing an example is a great way to get a point across. So let me share this example with you now and see if you can relate this to your own trading. And I'm sure many of you are going to be able to. This is an example of where traders misinterpret what the markets are telling them. It's a common pitfall for traders who don't have all the information they need to make the right trade entries and exits. Now, in this example here, we see a really nice run higher, right? And when it pulls back a bit right here, we buy in on that pullback, expecting that it's going to continue running higher, right? So that seems like a pretty decent thing. We saw it jump, it starts to run, it pulls back, we jump in right here. In fact, we get lots of training that tells us to jump in there, okay, only to see what happens. Well, it goes up and pulls right back down again, and we get stopped out, okay? And this is because we entered the trade on the wrong side of the mountain. If you think about this as being a mountain going up, we want to jump in that trade as it's moving up. Instead, we jumped in as it was coming down the other side of the mountain. We don't want to take a bullish entry when it's on the way down. So how could we have known that this was the case? Well, we're going to talk about that in a second. And when this happens to you, to make matters even worse, after we get stopped out, and I hope you know what I'm talking about here, when we eventually find the next valid entry, we're hesitant to get in after taking a loss again, right? Because we lack the confidence to get in. So when we see a nice entry like over here, and it's time to get in, we'll be gun shy because last time we took an entry, it took us out. So this time, what do? We skip this trade, right? Because we're afraid we're going to lose again. And then what happens? Well, of course, then it runs without us. Okay, even if that was the optimum place, we killed our confidence by taking this trade here and weren't ready to jump in on this trade there. Has this happened to you? So I'm guessing it might have. You might have even said something other than these cartoon expletives down here. When this happens, it feels like the market's against us because when we take a trade, it stops us out. It seems like it's every time. And then when we wait it out, it runs without us. And it's incredibly frustrating. And that has such a great impact on you that you might not even realize. That impact, that type of flawed chart reading can wreak havoc on our ability to profit in the markets because psychologically it affects us. The setup looks correct based on the information we have. You jump in expecting it to run, only to have it go against us. I know some of you have felt this, and it's one of the most frustrating experiences that all traders face. When you have a failure like this, you try to brush yourself off and vow to be right the next time, but when that next trade setup comes along, that doubt creeps in, and you skip the next trade as your confidence is beaten up, and that one runs against you. Now, once you have a couple of these missteps where the trades you do get in fail and the ones you skip run, it quickly kills your motivation. And you may even start to second guess whether you're cut out for trading in the markets, or maybe you start to feel like the markets are out to get you personally. And you start thinking about, why do the market makers do that to me? Are they looking at my orders? Do they care about my tiny little order compared to what they're looking at? Now, if this is something you've experienced, you're not alone. I've felt it, and I bet that all of the best traders in the world have felt this at some point. So you're not alone. This is typical for new traders, especially once they get over that initial lucky first or second trade sometimes. But there are traders who aren't able to identify the real route through the markets, and that's because of this doubt. It's just one of those negative, energy-sapping, anti-trading things that we have to deal with. And it leads to a lot more negative emotions and actions. And it's these negative emotions and actions that ultimately wreak havoc on our ability to be profitable in the market. It changes our attitude. It kills our confidence. This type of doubt and lack of confidence creates that negative emotion, and that robs you of being able to achieve your goals and dreams that you know are achievable through trading. This negative emotions have no place whatsoever in a successful trader's mind. So if we're going to be successful as a trader, you got to find a way to get these emotions out of your head, because these are the things that will surface in the heat of the moment subconsciously when the trade is happening live. And real money's at stake, especially. Many traders revert to emotional trading in this case, and that makes them throw logic right out the window and do things like revenge trading and make things worse. It's a negative cycle you have to break to be a good trader, and you have to find a way to get your confidence back so you can send doubt out that window and enter each and every trade that meets your setup criteria, and you'll have confidence and assuredness in those. But how can you do that? How can we get around that doubt, those setups that go against us. How do we break that cycle? Well, we realized at Basecamp Trading that traders need one thing more than anything else in order to give them the confidence to trade well. And that one thing that traders need most is clarity. Clarity is what traders want, and what they need is they need that clear signal that shows you when to get in and when to get out of trades. Not just a black box signal, which you don't really understand, but a signal that still shows the why behind the signal. Traders need the clarity that reveals that state of the stock, so we can easily see when a stock's changing from bearish to neutral to bullish, so we can make confident decisions about that market's next move. If you just have a black box signal, then you don't really understand whether one signal is a better signal than another. You need to have more than just a signal. You want the understanding of what's going on in the market to be able to know what's behind that signal. Now, when we have that clarity, we can then brush aside all those negative emotions, knowing that we can trust our technology, our system, and get our trades to go through. And that gives us the confidence that we can move forward. Now, with clarity, we finally have something that can help rebuild that confidence that we know we need to be a successful trader. And it's something that can help us make better trades. Now, we've all heard the trading axiom, the trend is your friend. And I hope you've heard that. But if you're not able to hear all that the market's telling you, trade entries and exits remain murky to us. So we built this tool to give traders the clarity they need, because we know they're struggling. We know because we've been there too. Now, clarity comes from being able to see what's behind the chart's movement, because the market's not really out to get you, no matter what you think. It's actually telling us what it's wanting to do. In fact, it's screaming. We just have to find a way to be able to hear that and visualize it, see it, so we can know what a stock is going to do next. Now, our new technology, and it interprets that hidden information for you. It helps traders navigate their way through charts to find the optimal entries and exits, just like a GPS guides us to find the best route through an unfamiliar city. Now, once you start using this tool that I'm going to show you, you'll see notifications that at first you may not expect. Like, new users sometimes contact us, or I'll get a support ticket in and it will say, why is the indicator telling me it's bullish? Shouldn't it be telling me it's bearish here at this point? Is the indicator broken? And our answer is always, nope, it's working correctly, because the algorithms that are behind it are just looking at different things. They're looking at the right things that reveal what's going to happen next. And that's not always what it might appear at first. Now, how many of you have ever driven through a new city, you're trying to get somewhere, when you're driving through and you think even a city a city that you live in, you might think the fastest way across town is via the same path you've been taking for years. And then you get a GPS and the GPS says, no, go this way. And it finds a hidden way that you never knew was there, a way that gets you there in half the time. That's what it feels like when you're using hedge fund quality tools like this. It's like finding the best route right on your charts to get you where you want to be with confidence and speed. So this tool is called MQ Trender Pro 2.0. And I refer to this as many different names. It'd be Trender Pro or MTP2. And its full name is MQ Trender Pro 2.0. But let me show you how it works. Now, MTP2 is going to help you by, first of all, mapping out the actions right on top of your chart. It's like having Google Maps right on your chart, on virtually any type of chart or symbol. It does this by using very simple, logical color coding that'll make sense to you immediately. You don't have to go through all kinds of training on it. It should make sense immediately. You're going to instantly know what to do and when to do it. And remember that part about eliminating doubt in your trading that we talked about a couple slides ago? With MTP2, your confidence is going to increase, which will help you get bigger gains, because you're not only going to get in at the right time, you're going to be able to stay in trades longer to maximize your profits. And that's going to boost your confidence even higher, because you're now going to have a system that's repeatedly working for you, because you have the tools you can trust, and trust in your own ability to execute winning trades. All of this means one other important thing, and that is it gets rid of the fear, because just like having Google Maps gives you confidence to get where you're going when you're not familiar with a new area, and you turn on that GPS, MTP2 can give you guidance that gives you confidence to anticipate stock movement on any chart. Now, how does it do all of this? So Trender Pro uses a bunch of different algorithms that we have, a lot of technologies that we have at Basecamp Trading. They're all built into this indicator, adding and doing all the calculations and figuring out their own aspects and contributing to this indicator. And this is in a new way, a way that simplifies understanding of what the market's already telling us. So just like a GPS, the system tells us which way to turn to reach our destination. Trender Pro lays out a route for us right on our chart that tells which way the market's heading. Very simple. Green is bullish. That'll be expected to move up. Blue is neutral, or we're probably going to consolidate and move sideways. And red is bearish, meaning that we're going to move down. I hope that's natural for everybody. Up green, sideways blue, red down. You can change those colors if you want. I know some people have issues with differentiating red and green, so you can change those. But these are the default colors that we use. Now, the core point behind MTP2 or Trender Pro is that it helps simplify your trading so you can easily know when to get in a trade, when to get out. It even tells us when it's best to stay on the sidelines, not even take a trade. That is, it gives you the clarity you need to reveal and anticipate price movement. Now, we've been using this tool for many years, and it's gone through several iterations. We've increased its accuracy. We've provided additional helpful features. And the version that Metastock has now is the very latest. It has the very latest stuff in it. So we've got the best innovations we built into the tool. So MTP2 on Metastock also includes some additional special color codings beyond the red, green, and blue. It's also got the ability to detect when a market is getting extended. It'll show that in gray. Okay, that is, it gives a heads up that we've been running in this direction for an extended period and that we may not continue in that direction much longer. It's kind of like a slow exit ahead or a slow end of highway ahead. Now, we don't just jump out of a trade when we get extended, when it turns gray, because even extended stocks can run further in extreme cases. But when we get that signal showing an extended market, we want to tighten up our stops and preserve any gains that we have, perhaps take partial profits, but leave it on, leave some of it on, because we certainly don't want to get out just because it turned gray. It might still run, but more importantly, we wouldn't want to get into the trade and like when we see that it's extended. So if we're rising and it's bullish and we see that it's showing gray, that's not the time to get in. That's the time we start to protect our profits and ride it out. Now, another signal that's built in, another color, is called the trailed stop indications. And that's when you get a pullback against trend. So how do we use that? This indicates that the trend is pausing. So if we're running up and then we pull back a little bit, it can trigger a golden bar, is what we call this, is the yellow trailed stop bar. Now, we use these pauses as an opportunity to trail our stops or just get out of the position. Now, I prefer to use the bar that immediately follows a golden bar to determine whether I get out. And I'll show you how that works in a second. Now, we call these trailed stop golden bars because we use yellow for the color, but also it's because where we often take our profits. Now, all of these colors are going to appear automatically right on your chart. Like I said, it's almost like having Google GPS overlaid right on top of your charts to show you exactly how to get where you want to get, where you're going, and where the entries and exits are. So now let me show you how it makes a transformational difference in how you're going to make money in the markets. So let's go back and look at that example from just a few moments ago where we got into the trade at the wrong time. Remember, we got into the wrong side of the mountain up here when the market was ready to fall, but we couldn't see it here. So you might remember we got in here and then we saw it stop us out. Okay, that's frustrating. Now let's add in the MTP2 overlay, which is done here. Now that's the overlay right on top. You can see green, a couple of golden bars, some gray extended up here, neutral over here, red down here. Okay, so this is the GPS overlay. This is like having Google Maps on our chart. Once we have Trender Pro lighting the way, we can immediately tell where we got in before. What is this? It's gray. We're extended. We are extended, so we wouldn't want to be getting in. That would have kept us from getting into this trade, and it would have kept us from having this stop out right here. See, because we would have realized that it wasn't a good point to enter, and we would have saved us from this loss. And then we quickly went into neutral right here, and then even into red. And by this point where we took our stop, that's a possible entry point. We started to change to red and we were looking for a move lower. You could have been, instead of losing money here, MTP2 would have been telling you, go ahead and jump in. If you had a big enough stop here, you could have made some nice profit here. Okay. So it's clear at this point that we wouldn't want to have been in a bullish position. And what about over here, right? Remember this spot right here where we were afraid to jump in because we were kind of gun shy after the last time. Okay, this is the point where it would have been a great entry, we said. And that's when we had that breakout of compression. Look what happened here. Right at the point where that great entry was, it changed to green, signaling jump in. In fact, it changed to a very bright green right here, and it took off. So what we would have done in this trade, we wouldn't have jumped in here. We might have taken some profit on the short side here, but we certainly would have participated in this entry here as it moved up. See, this time with Trender Pro's help, we'd have the confidence to not take the trades or to take the trades based on the GPS overlay. Okay. With this added info, we can know when to get in and when to get out to maximize our gains. So how does it work? How does Trender Pro do this and create this amazing overlay? Well, like I said, it's full of our, probably best way to put it, some of our best indicators. It brings together our best proprietary indicators. It also uses some non-proprietary indicators into consideration, brings them all in when it determines trend and colors the bar. Now, it uses different technologies in different situations. So for example, it might pull from momentum and price action in one market condition, or maybe it's linear regression lines and adaptive moving averages in another chart condition. Or maybe it's comparing bar extremes and even looks at candlestick opportunities, candlestick opens and closes. It looks at all of these things. In fact, there's 49 different states that the indicator calculations can be in, which can drive our accurate results. Now, those multiple algorithms are all being checked simultaneously to read the charts and read them correctly. It's as if we have a team of advisors working together behind our charts to guide us. Like you're the CEO and you've built a team of the best stock advisors around you to keep you on course. Now, by looking at these different factors, we can accommodate accurate trend identification across just about every type of chart situation. And by using adaptive filters, we can measure the stock's movement, the current stock's movement in all these different ways and then score them. So, for example, if we have 10 of 12 filters active, we're strongly bullish. If only 7 of 12, we're neutral. And if we only have 4, or less, then we can maybe say we're becoming bearish, right? So it's a little more complicated than that, but that's the idea. We score it and then we assign colors. And just like a GPS, there's a ton of technology and complexity going on in the background. Most people who have a GPS have no idea how that thing works. They might know it doesn't work when you go under a bridge, but they know that it's connecting to satellites somehow. And you don't even have to know the fact of how many satellites it's connecting to, et cetera. But what it ultimately presents to the user is just go here, get off the road here, get on the road here. So it's simple to learn no matter how complex it is. It's intuitive to understand and it's easy to act on. And it all boils down to the simple color codings you've seen. So you'll know what to do and when to do it. Let me just check and see if we have any questions here. I'm going to keep up with it here. All right. So let me share a little bit more about using this tool and how we can help and show you how, we talk about transforming trading. I want to show you how that works. So many traders struggle with staying in a trade that's been running for a while. They'll get nervous about the profits they have. No wonder, if you usually when you jump in a trade, it turns against you. I understand you get frustrated. Almost what you want to do is somebody else standing behind you, putting their hands on your shoulder, says, good job. That's going to keep going. Right? You want that extra confidence, that extra clarity. So you won't get nervous about the profits you have. And you won't be letting your losers run all the way to the stop if you don't, which is what you might be doing now. Instead, you're learning to let your winners run to a stop. That practice of cutting off your winners early while letting your losers reach their full stop makes it so much harder to get your overall equity curve moving in the right direction. Okay, and for many traders, this one improvement that Trender Pro gives you, and I'm going to show you this, is enough to turn around so-so traders into stock market winners. So we address this problem in 2 ways. First, you can use the color alone to help keep us in winning trades longer. it can keep you, and actually this can give you the confidence to hold on for those bigger gains. And it's pretty simple. You enter on green. So over here, we can see we're neutral. Actually, we're red way over here on the side, if you can see that. Went to neutral, and then we went in green, and we can just stay in green all until we are no longer green. Now, gold, we don't count those yet. We'll talk about those in just a moment. But right here, we changed to blue. Now, you can choose to get out at neutral. Some people prefer to get out when it changes to red, right? You get a bigger gain. That choice is up to you. But enter on green, and as long as it's green, stay in it. Okay, even if it's blue, you might want to stay in it. Okay, very simple. Okay, now another way to do it, and this is the way I like to do it, is using our golden bars. Okay, and this is one of my favorite parts of this technology because it helps us to stay in those trades and lock in gains on the way up. So we call these the trailed stop bars. We also call them golden bars. So we trail the golden bars as we get in. So we still get in at the same time when we change to green, but this time, once we get a golden bar, we move our stop up to below the golden bar. And the bigger the market, the further the stop, just to give it more room. But then we get this golden bar and we stay on it. And then this one here, we can move our stop up below here, and then we get stopped out. And that's a nice run. And we didn't jump out over here or here or even here. We got this whole run. Okay. Now, one of my favorite ways to use golden bars is a little bit more specific, and I love systems. I'm a computer scientist, computer engineer, so I like to have something that's absolute. Here's what we do: if you get a golden bar, you look at the bar that follows it. If that bar closes higher in a bullish trade, we stay in it. Okay, so here, notice how this bar that followed it, here's our golden bar. It says, okay, watch this. We look at the next bar, it closed higher than it opened. So we stay in this trade and we move our stop under here. Look at this one closed higher than it opened. Stay in the trade. We're locking in gains. Right here, this one closed lower. We'd be out of this one. Okay, this is another way of using the golden bars. Now you probably noticed that the signals Trender Pro is providing on our charts. I'm talking about these signals right here. These are expert advisor signals, which identify key points to enter and exit trades and trail our stops, etc. You can only get these signals on the Metastock version. We haven't implemented this on any other implementations that we've done. So this is a feature that's unique because you're coming in from Metastock. You can make your own decisions based on the colors alone, like I showed you, or you can use these tune guidance signals. Thanks to Metastock's trade signal abilities. And MTP loves these. You can see right here, we got a long entry. Here's our trail signals. Another long entry here. Don't you love it when you're in a trade and it's running higher and you're holding on to it and you get another buy signal and you're already in it? Isn't that like the best? And then up it goes. Really nice. We ended up with our short entry reversing here, but if you were trailing or something here, you could have locked in even more gains. But this is really great especially when you get signals and you're already up in a trade. It's a great feeling. Now, speaking of additional features included in this add-on, you probably also noticed that there's a trend ribbon down here at the bottom of the display. Now, the trend ribbon is using another Basecamp trading technology called MQ Trend. And that calculates trend a bit differently than what MTP2 is doing. MQ Trend is a popular indicator at Basecamp Trading that we already sell on its own for $297 in our store. Now, in Metastock, we can use the wisdom of the longer-term market view that MQ Trend provides because we built that into the ribbon. You can use this to confirm direction, or it can help you stay in trades longer for bigger gains. And I appreciate knowing that longer-term trend on my trades, so that gives me more confidence to stay in those trades for more than just a short period. And when I have MTP2 and MQ Trend saying the same thing, I have a much better chance of a profitable trade. And sometimes MTP2 will alert us before the longer term trend is established, in which case it gives us that extra confidence that we're on the right track to trade and to stay in bigger gains. Like right here, even though we were still in a bearish mode, according to the longer term view, we got the signal here. And right at this point where you can see the green line up here and also the green down here, we got a reassurance that this was a good trade to stay in. You can see what the results were. Notice this one here, trade closed up after the golden bar, we stay in. This one we'd still be in. Here's another example of using Trender Pro guidance and staying in with golden bars. You can see the expert advisor giving us signals along the way. Okay, so here's our entry right here. Up we go, golden bar followed by an up bar. Okay, right here, even this one on a pullback. Look how we had the pullback here. A lot of people might have been, wow, I'm going to jump out. This is pulling out. But look at what happened. We had a move up after the golden bar, so we'd stay in. And bonus, we got the long entry again, and up we go. This one also saying stay in, and this one's still running. Plus, at this point here, we got the extra confidence that we changed from the bearish long-term view into the bullish long-term view. So we'd still be in this trade. We'd have trades profits locked in, and you don't have to only use golden bars to lock in your gains. You can also use like this area right here, whatever you feel comfortable. Because once you get up there with some gains, you want to lock in some of that move, especially something like this. So don't be afraid to lock in some extra gains. But if you want to do it system-wise, it's so simple to just keep moving your stop up a distance away from the low and just do it robotically. Now, let me show you a comparison of a chart without MTP2 and then with MTP2. This is Facebook on the daily chart. And without MTP2 lighting up the chart, it can be difficult to know where the optimum entry point is. Even if we start to think Facebook is about to turn bullish here, right here, where's the entry point? Many traditional methods would probably have you wait until you got up to this previous pivot before you would jump in on this break. But when we turn on MTP2 with that same picture, now we can see that we've changed to green and we can jump into this earlier. We're even getting some long entry signals. So we're jumping in over here at this point, gets us in a week earlier on this trade and a $20 per share difference, meaning we make an extra $20 per share on the move. If you're trading 100 contracts or 100 shares, that's an extra $2,000 in your pocket because we're using MTP2 just in this one trade. And with that extra confidence that MTP2 provides, we're also avoiding the stress of getting into the trade at that point because we have that extra insight from MTP2 and eventually the ribbon that's our board of directors helping us feel confident in our trades. This is why we say MTP2 is not just going to help you, it's going to transform your trading. Now, we can make even better decisions with MTP2 when we bring in multiple time frames together. And it sounds like a fancy name. We use a term called multi-time frame convergence. What we're doing is we're using the power of MTP2 on higher time frames at the same time as the lower time frame, and we verify that we have a trend and color alignment at the higher level to push us even further on our chart. So here's one of the layouts that's provided. We give you several layouts with this tool, and this is included with the MTP2 add-on. This is the weekly daily layout where we have the weekly view of Netflix on the left and the daily view of the same symbol, Netflix, on the right. And by viewing the MTP2 status on both of these at the same time, we can determine when we have confluence between the two time frames, and that makes an even stronger case for the trade. So this is from last summer. Netflix was having a hard time last summer, and it started to improve at the end of summer, around the end of August. So at the end of August, we saw mostly sideways movement on the chart, and the weekly chart was signaling a strong bullish move. In fact, we got a long entry here. So when we look at that, we can compare that to where we're seeing also a long entry on the daily chart. And when we see these two combined, that's an extra bit of confidence that we can jump into this trade. Okay. Now, in this case, we even got notified up here at point C. If you look right here, we got notified on the daily that we were getting extended. So that told us lock in your gains, trail your stop. When you can actually trail to a previous bar or previous 2 bars ago, or maybe 3 bars ago, whatever you're comfortable doing. And then you would have been able to lock in gains right here. And you could have also taken profits. On the golden bar, you see it was followed by a bar that closed lower, and therefore we would have been out right there, and then it dropped. But we got that heads up with the extended bars telling us, hey, be careful. This is getting to the point where it might not continue moving higher, and it worked out well. Okay, now you can also see some of the other features that are included in the MTP2 indicator. You're getting MQ momentum in the MTP2 package as well. This is the momentum indicator that we use on every single one of our charts at Basecamp Trading. And we sell that as a standalone indicator for $297. And remember, you're getting the trend ribbon to illustrate the longer term directional bias for additional confirmation. So you've got these three indicators working in tandem. We can identify not just time-based trend, but also strengthen our confidence even further with MQ trend and MQ momentum. Now, when these three are aligned, when these three different indicators align, it adds even more confidence that we're going to have a successful trade. Now, we can use a little bit more caution when that's not the case. Let's look at some convergence here real quickly. And I know we're already running out of time here, but let me show you here. So here's the train ribbon changing to green at this point right here. So in spite of things falling a little bit, the trend ribbon had just turned green. So longer term, we were getting the signal to go long. Okay. And then we were able to get complements when we had the long entry, plus we came back with the MQ momentum. Just look at the white line here. That's the easiest way to look at this when you're just getting started. The white line came back to 0, saying it was a reset. So we reset momentum, meaning that we have a full run ahead of us potentially. We got green on MQ trend, and we got the green on Trender Pro, and we have the long entry signal all at once. And that's when you get this kind of a nice, powerful move. Here's an example, by the way, of the extended color appearing, and there was no reason to jump out. You can move your stop here so you don't give anything away, right? You can keep moving your stop as it moves up. You know, you might even trail to the previous bar or the previous 2 bars or whatever. You might have got taken out right about here, which wouldn't have been too bad. But this signal here would have told us to exit. Right here was the long exit point. Okay. The other thing we can look for too is divergence. And when you have divergence, not in agreement, and I know Alex and Tyler were just talking about divergence quite a bit. We agree that's an important thing that you want to take into account. So I think I have another slide about divergence here. Let me jump ahead a little bit. Here we go. So this quickly shows divergence. And really, let me just tell you, divergence doesn't have to be that complicated. If price is going up like this and your indicator's going down like this, that's divergence. That's all it is. All right. So when we see right here, you've got point A where we're seeing a short entry. You can see the trend ribbons changing to red. We're getting multiple signals that we want to go short here. And sure enough, everything is lining up. And then right here, if you notice, before we get to point B, you can see we're trending lower, but look what the momentum indicator is telling us. See right here, price is dropping and we have lower highs, but look at our momentum indicator, it's already rising. Okay, that is a divergence. That's when price is dropping. It's the opposite of what I drew in here, right? That's when price is dropping, but the indicator is going up. So when price is dropping and indicator is going up, which is like what we have right here, that means that this is really a false bottom and that the indicator we want to follow. And sure enough, as soon as we got down here, we got our short exit signal and was followed up once we got momentum starting to move back up into closer to the 0 point. We got our long entry signal. We changed to green on Trender Pro. We changed to green on the ribbon and up we went. So it all starts to make sense when you bring all the different components together and you get all of these with you. And finally, this is what we're talking about with clarity and anticipating the market move. We can just use the signals alone, or we can take into account what we learn about the markets and look at the colors changing. Okay, and we can also bring in the other indicators. It's all up to you, and as you get better and better at working with the tools to be able to understand that. Let me just go over a few more things you get, just like in the commercials, but wait, there's more. You get the expert advisor. So there's detailed instructions using the expert commentary, which will tell you what to consider when you have certain setups on the chart. So these will tell you, they just appear when that chart condition occurs, and it will say, be careful. Here's some instructions about how to manage the golden bar and watch how the following bar reacts. It gives you that right on the chart. Okay, you've got the advisor signals that we already talked about, already built in. You've got explorations. There's a set of 8 explorations to be able to find the different opportunities that are out there. You got 4 bullish and 4 bearish. Okay, you'll notice you get just a plain new long signal entry. There's also a surge when you get a jump and when you move from one extreme to another, and then a surge within the last 5 bars or the last 10 bars. So you can now search backwards what's happened in the last week or the last half a month. And this mirrored results here on the bearish side. I'm also going to provide a significant, it's 46 pages here. It's mostly a reference guide, but it will help you understand some of the nuances that I talked about. And there's also a part about trading in general and being consistent. So there's some extra help in there about how to gain that clarity. Because remember, that clarity is what's going to create the confidence that you have. When you have the tools and you have the system telling you it's time to get in or time to get out, this is when you can make those better trades. Now, I told you that I was going to show you how to unlock a stock market GPS for better trades. And I showed you how you can use our deep technology to trade like a hedge fund. And we have used these in our funds like this. And this exposes the hidden information that's behind those charts and gets us to those massive profits, as you saw. And you can stay in the trades for longer, right? Because when you jump into a trade, you're at the highest risk at the first moment you get in that trade. So if you keep doing that, jumping out of trades and jumping into trades, you're spending a lot of time at high risk. Imagine getting in a trade and staying in it for a longer period. You're getting further and further away from that risk. You're just making money and you don't have to take any additional risk, not to mention commissions, because you are now just improving your existing winning position, not starting a whole new one from scratch. So you have the opportunity to completely transform your trading by getting this tool today. So you can get things like this. I saw Alex pointing this out as well, is that here's MTP2 signaling that we got a short entry. This is way back in January, where we were getting the signal here to get out of Netflix or to short it. Right. And look what happened just in this week. We saw that big drop in Netflix. We were already seeing that signal back here, not just in the entry, not just in the color, but also in the trend ribbon. Okay. This trade's still open, by the way. If you took this trade, this would still be open. And we don't have an exit signal yet. So we'll see where this one goes. Here's Pfizer, 81% gain. Okay. And while many other markets have been giving us sell signals, MTP2 has kept Pfizer in the neutral to buy area throughout, including a recent additional buy signal for further gains. So when the rest of the market here has been dropping, Pfizer has been recognized by this tool as still holding its own. And Pfizer is probably going to keep making money on more and more of these vaccines. Now, hedge funds have all the, they have trading figured out much better than the average retail trader. They all have resources to create the cool tools to help see things that are going on behind the charts. Then they can make quick and correct decisions for huge gains. Why should only hedge fund traders have access to tools like that? Why shouldn't you have that capability? And now that you've seen that this exists, can you see what a disadvantage you're in if you don't have these tools? Well, you don't have to worry about that anymore, because now you can get this right now and get the same signal as you've seen here. So you can stop falling prey to bad entries and start making the trades that are going to grow your account to hit the goals you have for you and the goals for your family, things that you are looking for to better your life, not just to be a better trader, but to have a better life. So get ready to rekindle those dreams that you used to have, because this is going to get exciting for you. And achieving these dream goals is what transformational trading can do. I mean, you might even start having fun trading again. Remember this 76% gain at Amazon using MTP2 signal? That's $1,500 per share, one share. Imagine what you could have made if you traded more shares. Even better, using options over the same period. That's what trading is like when you have your GPS, and that is when it gets fun. So what is this going to cost? Well, you're going to get Trender Pro, the MQ momentum indicator. The trend ribbon is going to include the MQ trend technology, and normally that would be $17.97, and we'd have a really great price typically in a package special for $14.99 for all of that. But because of today's special, if you act today, we're not going to charge you that. We're going to charge you only $9.97, where you can get immediate access to this. Now, remember, that one trade on Amazon would have more than paid for MTP2. And then you'd have the ability to find all the other trades for your own massive gains again and again. Like I said, it might even make trading fun again. And we're also going to throw in, I know everybody's got inflation on their mind, so we agreed to include this survival guide, the inflation survival guide, to help give you some tips on how to manage your account through these periods of massive inflation. And we're seeing inflation that's at 40-year highs. So this guide is going to be included for anybody who purchases this today. We're going to go ahead and give you this guide, and so you won't have to watch your hard-earned gains disappear. So this is an extra bonus that we're giving today. We've never done that before. I don't think we've ever given this away as part of this deal before. So $9.97 gets you all of it, and you'll be able to get the layouts, the explorations, the expert advisor guidance, all the trade signals, the user's guide, all that stuff. And maybe, like I said, maybe make trading fun again. I have some more examples, Jeff, but I think we're out of time here.
Yeah, we have a couple questions too. So let's that I promised to ask you. So
Right.
do you mind if we do some questions?
No, not at all. Not at all.
Perfect. We'll start on Facebook. From Facebook, Doko wants to know, and I hope I pronounced that right. I'm sure I did. Absolutely sure I did. He wants to know if this just works on stocks, or what type of instruments has this been tested on?
It works on you know what? I hate to say everything, but I haven't found something it doesn't work on. I even use it on Renko charts. And those are synthetic charts that aren't really showing in complete truth about where price has been, because synthetically they draw further than where price has gone. If you understand how those work, it still works there. We still use it there. It's still an important part of our trading there. But yeah, it's going to work on cryptos. It'll work on futures. It'll work on indices. It works on stocks. It works on pre-market, post-market data, all those things. It doesn't matter. And almost all of our indicators will work that way across, and they also work across multiple time frames. So maybe even more importantly than what markets it works on is that it works well on a 2-minute chart, just as well as it works on a monthly chart. And it just means when you're working on a monthly chart, you have a bigger target and a bigger risk. But on a 2-minute chart, you do the same thing, but you just have a more near-term target. You don't make as much, but you do it more often, but you also have less at risk. But it works across all those.
Okay. Here's another question going back into GoToWebinar from Peter. Peter says, regarding the GPS, it looks like an end-of-day system. And I think we can talk a little bit about that. You can apply it to any time frame. But he wanted to know exactly when in the day is the bar color-coded. And do you recommend can it change color during the day? When would you recommend taking a trade? Would it be during the day or after the market, the next day, the next bar? What kind of recommendations do you have around that?
That's a really good question. Can you see Metastock here, by the way? I don't know if I shared the whole screen or just the presentation. Can you see my chart? We
can see Metastock. Yeah. Oh, yeah. Okay. I see beautiful charts right there.
All right. So this is Netflix, by the way. And we just saw this example here. So the question was, when do we act? I think there's one way of paraphrasing the question. When do we act on the colors? Yes, the colors can change intra-bar. So we do recommend that if you're going to take a signal from the chart, you wait until the bar closes. But that doesn't mean you can't take action intraday, because all you have to do, go to your chart and then switch to an intraday chart. So if you go to a 5-minute chart, you're going to get your 5-minute signals, and you're still going to get GPS results on it. So this bar is going to close right here, in the middle of the day. You can act on it. Okay, so you can take this long entry right here, even though it's 2:55 in the afternoon.
That's a good answer. Also, I want to be really specific, because I think I might have confused with my answer that I typed up. If it's a previous bar, it's not going to change. It's just open bars that might change. So if you're looking at yesterday's close, if yesterday's already happened, it's not going to change color.
Yeah, there's nothing that's going to change a color in the past. It only changes the color in the current bar, and then it shifts over to the left. In fact, for performance reasons, some of our users will make it so it doesn't even color the current bar, so they don't have to worry about the colors changing. I like to know what it's going to be so I can prepare, even if if the bar is closing.
Okay. Perfect. That's, I think, the amount of questions we should take. So, again, if we have questions, we are getting a lot of questions. If we miss your question, please feel free to chat in with our sales chat team, and we can send you charts. We can send you things you're interested in, and we'll be happy to answer all questions that you have, Sean. Thank you so much for coming in today.
You know what? You're welcome, Jeff. And one thing I wanted to point out too is there's a 30-day money-back guarantee on this. I can bring up charts and show off, cherry pick things, get the indicator, try it for a while. Use it. Use the signals that it has. You have 30 days to try it out, and then you can get your money back if it's not working for you. And I'm talking about transformative trading. Give it a try. If it doesn't change your trading, then get your money back. But if you find that it's helping you make better decisions, and I'm confident it will, it's going to pay for itself anyways. So give it a try. If you're thinking about it, I mean, this is a good price. You're going to get that inflation guide as well as all the other bells and whistles. You don't really have anything to lose. You can give it a try, give it back, and no questions asked. Otherwise, you've got a great tool that's going to serve you for years. And we use it in almost all of our trades.
I wish I could get a money back guarantee on some of my trades. What a good risk reward.
You can't do that. You just have to outperform the pass. That's all.
All right. Thanks, John.
All right. Have a great
thank
day.
You bet. And I appreciate your time coming in here today.
You're very welcome.
All right. Go ahead and do that. Yes. And let me go ahead and change the presenter over to me real quick. So make me the presenter. Okay. Show my screen. Okay. And let me go ahead and do this too. Okay, there I am. All right, cool. Here's a picture of the box art. Again, it does take full advantage of all of the tools that have helped Metastock be rated #1 in its price category for decades. You get the expert commentary, you get the ability to do scans, explorations, all that stuff. John does a really good job of designing tools for Metastock. And as part of that, you get all the color coding for the trend identification that he talked about. You're going to get these explorations, the bullish, the bearish ones. You'll get the expert advisor that applies all the templates, the indicators, everything that you need to run it. It works with Metastock very, very well. I love the ability to explore and scan. And John did a really good job of talking about what's included. So here at the show, normally it's like $14.95. Here at the show, it's $9.95. It's a one-time cost. And like I said, we do offer that with a 30-day money-back guarantee. So if you're not happy, you can just get a refund. And if you're new to Metastock, you want to try that out, we will throw in a free trial of Metastock just to help you get started. And we'll back it up all with, like I said, a money-back guarantee. So give us a call, 800-882-3040. You can chat online with us at metastock.com/saleschat. And it is actually part of the Summit Special. So if you like GoNoGo, Alex and Tyler did a really good job. If you like the Trender, in just a second, Ed is going to come and talk about his brand new Wave Trader product. You can get all three of those with some training that we recorded with my friend Oscar Carboni on the classic technical analysis and drawing and line studies. We'll talk a little bit more about that. But as part of that package, you'll also get 2 years of stocks and commodities, a 3-month subscription to learnmetastock.com, and also, of course, a training guide called Unleash the Power of Metastock. So the normal cost for all of this stuff would be $4,530. Here, today at the show, it's going to be $2,245. Most of it is included with a money-back guarantee. You can take advantage of that at 800-882-3040. You can give us you can go online and order it at metastock.com/summit deal. And if you have any questions, our sales team is so good. Our support team is also good, but that's what I was going to talk about. Our sales team is so good. They'll be happy to send you charts, send you information, send you other information if you need it, help you get started. So metastock.com/saleschat to talk to a member of one of our sales guys. So again, 800-882-3040, metastock.com/summit deal, or metastock.com/saleschat. Okay, there you go. All right. I do want to say thank you to CMT for supporting the event. I usually like to talk about one of our sponsors between each of the events. I forgot to include a slide, but CMT does a great job. They've been supporting our events. It's called the Chartered Market Technicians Association. Very, very well-reputed company. You can find out more about them at cmtassociation.org. And we appreciate their support. Our next presenter today is Ed Downs. Ed, we are running about 10 minutes late. I blame someone else. No, I'm just kidding. We are running a little bit late today, but I don't want you to be worried about time. I'm the next presenter, and I can talk as long as I need to. and as short as I need to as well. So I want you to be able to go through what you're doing. To introduce Ed properly, though, Ed Downs, it has been a customer, or not a partner of Metastock since I started at Metastock over 25 years ago. He is a designer of systems. He's done some really, really good products for Metastock, ones that does a whole bunch of chart patterns. He's developed a really cool AI engine, an X suite. And today he's going to talk about one of the most popular add-ons he's ever developed that he's kind of got done making for Metastock called Wave Trader. A few things that I'll say about Ed is he's a really likable guy. He does a very, very good job in kind of talking about it. And he just is a great designer. He understands kind of the tools in Metastock and how to really take advantage of them. So with that being said, Ed, how are you doing?
Hey, good. I see you got my high school picture still. That's great. Thank you.
I know we should take a new one because I understand that we look better as we get older. That's what I was told.
That is true, actually. Yes.
Here, let me go ahead and make you the presenter here.
All right. Thank you, Jeff.
Is that a picture that Steve took back 25 years ago?
25? It could be that far back. I don't know. I hate to think that, but yeah, someone did. Anyway, hey, thanks for having me today, Jeffrey. Gosh, it's just so great to be with you. I love doing these things. And, just the 1 minute version of our history is that, yes, I met Jeffrey 20 years ago. Now, you look a lot younger than me, though. I got to say that. So you look good.
I look way younger without a beard. All right. I'm going to get out of the way. I can hear you. You look good. I can see your screen.
Okay.
I'll let you know if there's any issues here.
All right.
Oh, I actually muted the wrong person. Let me go ahead.
That's all right.
Sorry
That's
about
all right. Go again.
I also turned off your webcam, just so you know.
Do you want it off?
No. You can go ahead and turn it on again if you'd like to. I'd prefer it on. There you go.
Yeah,
Perfect.
yeah, because they can make it really small, which is good. Okay. Yeah, so 20 years or so we've been together working on stuff, and back at that time, I actually went to Salt Lake City and met Steve Akalis, the founder of Equus International back then, and great company, great people, and we were building automation utilities. And that's really my background, is automating stuff. I'm a chip designer, building automated systems to route chips and place them and all that stuff. That's kind of my background. But I started thinking, gosh, I should apply that to trading, because there's a lot of opportunity to automate things around trading. So in '87, I started this company, Nirvana Systems, to pursue that. And the first thing we did was we built these utilities that would run other software, because I wanted to drive really great programs like Metastock, because I didn't want to make those. I just wanted to use them. So I had a robot that would run them and pull trades out of them and make them do all these things. That was our first product. And Steve was gracious to allow me to present that to the customer base of Metastock. It was very successful. It kind of extended the platform in certain ways. And that's just been kind of the theme of the company since then, building all kinds of automated tools and products, particularly around artificial intelligence. We do have an AI module available for Metastock that uses actual AI. Today we're going to be talking about a very straightforward plugin that uses algorithms that we've developed over a very long time to trade a specific way. So, excuse me, and I do have allergies today. I'm going to apologize in advance. It's probably going to hit me about every 15 minutes, but hopefully less than that. Okay, so today we'll be talking about this new product that we have released. And the title says Wave Trader for Fulgent. So I need to explain what Fulgent is. My company is Nirvana Systems, but we realized a couple of years ago, I talked to Jeffrey about, can we do some things for Metastock? And I thought, we should just take our artificial intelligence and some of the tools that we've built and provide them for platforms like Metastock. And of course, Metastock is the first and the best that we've worked with to do this. And so it's great. It's a little engine that runs in the background of the computer, and it is able to load all these different programs we've built. I think there's 4 available now in the Metastock store, and including chart patterns and X Suite, AI, and now this. And it's very seamless, very easy to use. It's just kind of there in Metastock when you run it. So you're going to see that in a second when I bring it up. But let's talk about, dive in here and talk about this topic today, which is wave trader and specifically wave trading. What does that mean? Because it is, to me, this is the essential signal, the essential trade that everyone is trying to do every day. And they may not know it, but we're talking about very low risk trades that you can find in any freely traded market every single day. There's hundreds and hundreds of them. And the question is, how do you find them and act on them easily, simply, which is a very simple tool. So that's what we're going to be talking about. And first, I'm not going to talk about wave trader. We're going to talk about just doing it in Metastock, because you can do this kind of thing without really much support. I mean, just a few indicators and you can trade the waves all day long. So we're going to talk about that first and kind of educate you a little bit about that. So this is just a chart, what stock this is. It looks like Boeing. And this is kind of what markets do, right? They rally, they pull back, they rally again, they pull back, then they rally, but not quite as far. 50% retracement right there. We know that as a Fibonacci retracement. And then here's another like a 60% right there, and so on. And they just keep doing this over and over again. So if you can identify these points, like right here for a long or right here for a short, that's really great. I mean, that's what we're trying to do. So these are, we say, the waves. It is this movement up and down, like a rolling wave motion. And we're just like a surfer jumping on there and riding the waves. So we want to identify these points to trade. And in Metastock, it's actually very easy to do this with two indicators. I'm going to go ahead and bring it up here after I explain it. The first is the zigzag, which is very close to what Wave Trader is doing. We bring up Wave Trader. What you want to do is find pivots in the market. They're very likely to be a turning point. And of course, zigzag, it takes a little while to form a pivot because it's looking for movement. I have the 5% zigzag on this chart, and so it will not draw this line until it sees at least 5% of movement. So they form a little late. But if you look at the stochastics down here, this is the 21 5-period stochastics, you will very often, I'm talking like 7 out of 10 times, see this beautiful wave pattern setting up. And you just say, okay, high, 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 low, low, low. And you look up in the chart and see if you likely have a pivot low there. So here's low, 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 low. So, you're getting to this one or even this one, and you're saying that's very likely, to be, we're down here on stochastics, likely to be a reversion point. And that's as simple as it can be. Let's go into Metastock and just play around this a little bit. Let me see here if I can get oh dear. I think what I just did is hit my taskbar. Hold on 1 second. I'm going to get it back here. Taskbar, where did you go? 1 second. Just have to move a few windows here and I'll be able to find it again. I hate it when this happens. Oh, computers. You love them, but Okay. I think I got it. Go back. Okay, we're right there. Okay, let's go from current slide. Yes, we made it back to around the horn. Okay, here we are. You guys didn't see anything because I paused it. So, okay. I'm going to go over to Metastock and just kind of do this really quickly. It's easy. So in Metastock, I can say, here's the stochastics oscillator from the nice drop down here. I love, it's just so easy to get to things in Metastock. I love it. So stochastics right there. I'm going to pull it down and it's going to tell me what do you want. I want the 21 period and the 5. So we're going to go through some charts here and look at them and see what we can see today. Okay, that looks pretty good. There we go. And this is a different chart from the one that's on the slide, Boeing, and you can just see it. I mean, boom, 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 boom. There we go. So what we're trying to do is, going to go put the zigzag on here too. Okay, pull this down, get to the zigzag. It's got to be in the Z's somewhere down here. Right about, I'm getting there. There we are. Zigzag, drop it on the chart. And we're going to select the price chart here, select Boeing. And I'm going to do the standard 5%. So 5% on the close for zigzag. And what this does, like I said, it takes a little bit to form on the right edge of, a 5% movement, but it's very compatible with this display down here, because as you're going along, what you're looking for is a trend, and it's easy to see when the trend is down, the trend is up. The trend is up here, the trend is down here, and you can just tell these turns. And one of the best ways you can detect them is with the higher low, lower high principle. You guys probably use this. If you haven't thought about it, you probably just use it instinctively. So here's a low that's above that low. That's called a higher low. Here's another one here, high or low. There's one here too on the little short-term pivot. And I'll talk about these pivot formations here in a second when we talk about wave trader. But so that's what you're kind of looking for. Here's a lower high, a lower high, a lower high, lower high. Great shorting points. This one's indeterminate because this is a little lower, but then you went above. So you want to wait. Let's see. Are we still going down? We don't know. Starts down. Okay, yeah, that was resistance turning down, not a lower high, which is what we're trading in, in the downside. So if you just go through some charts, which we'll do here, let's see, pick a few, and just look at the two indicators. So I'm looking for a cycle to see if we're at a cycle high or low on one of these in the Dow. It's kind of going along here. Let's see, here's CRM. And the other thing is you get these very small cycles forming like this here, and they're also very tradable. So boom, boom, boom. Okay, right there, I'm probably going down because those cycles are telling me that. The other thing about the stochastics oscillator, this is just a little tidbit that I've used a really long time. It was taught by George C. Lane, the inventor of stochastics many years ago, is that you want to trade the knees in the stochastic just as much as the reversions. So you go through this, the 20 period, the 20 value, 20% value, and go back up. That's great. That's a great entry point. But also, if you pull back and form like a retracement, a 50% retracement in the chart, that's also a really good place to go long. So these knees are tremendous. There's one here that corresponds to this. So that's really, if you look at these in charts, and you can write a little exploration and in a system. I think Metastock actually has some stochastic systems. I know they do, that'll find this crossover here. So you can run those, explore for them, and then just look in the chart, look at the pivots, and do you have a clear case for a higher low or a lower high? I don't have one in my head here to show you, but this is really pretty good. So we had cycle, cycle, almost getting close. Not quite. It needs to be over just a little bit more, but you can see cycle, cycle, cycle lows right there. Let's go through just a couple more. And the market is really correlated right now, so it's going to be more difficult to find them. But we look here in stochastics, we've got, and this is the zigzag problem. I'm going to talk about that. But stochastics, we've got a high, 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 and so that's ostensibly a good short point, even though it's not a lower high. And of course, we know what's happened this week on the Nasdaq. Pretty negative stuff going on. But in more normal markets, you can just look for those cycle approximations, and the more consistent they are, the more predictive they are going to the right. Now let's talk about the zigzag, because, like I say, what it's looking for is in this case, a 5% movement. Now I can change that to say, well, rather than 5, let's do 3 and see what happens. Okay, now I've got what we call short-term pivots, equally viable. If I were to zoom in on this really, really close, you would see that those are, and then I drop the stochastics down to like a 5 period from a 21 period. If I'm going to do this with this set at 3, you have to kind of play with it a little bit, but those are great. However, we see these times when the zigzag just goes for a really long period, and there are lows in here that can be traded. So the problem with the zigzag indicator is that it is waiting for 5% movement. It will not draw the opposing line until it sees 5% the other way. So you can get these things like we saw in that last chart. Get it again here. Okay, where are you? There we go. Yeah. Okay. Let's get this back to our 5%. They do this. So, we've been using zigzag for like a millennium in here and looking at it all the time. We go, there must be a way to find these pivots that are occurring in here, something other than zigzag. And that's what started the Wave Trader project. We started looking for ways to predict these pivots in code with algorithms to say, you really probably have one right here. Even though we haven't moved 5% or 3%, you have formed a relative high with a down bar, and it's on the right cycle basis. And so we go and say, yep, that's probably a pivot. And that's the thing that Wave Trader does that is special. And it uses the pivots in all kinds of ways that I'm going to go over here. But again, you can't, not every chart does this, right? Most of them are fine. Most of them are very, very usable with the zigzag. Like this one's great. High, high, there's the lower high in the stochastic, nice turning point. And you got the little ones, the little cycles here that stochastics is seeing. This doesn't see it. So, low, 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 and somewhere in here, you're going to get another one. It finds it here. And so on high, and then going down the same way. Okay, so that's just kind of in Metastock using zigzag and some kind of an oscillator. I like stochastics. It's very predictive, especially the longer time frames, like 21 period that I'm using here. When you drop through that sucker from the 80 line, it's very likely going down. I mean, let's look for a place that fails. I mean, they might go down much, but let's see. This one was a little early. That one was a little early right there. The actual is over here. And by the way, that's a divergence, right? So it's going down. The chart's going up. That's a powerful sell signal. But here's, down right there. So it's really an amazing indicator considering it's been around forever and it's just so simple. So this is just keeping things simple is good. All right, let's go ahead and go back to the PowerPoint here and continue on to talk about Wave Trader and what it does. So again, the whole idea was to get better pivots so that we can really identify these turning points in the market and use them in several ways, 7 to be exact. So this is a picture of Wave Trader pivots drawn. I can't draw the pivots in Metastock. We don't have that coded. They're internal. They're used by the algorithms, but we just kind of put it on here to show where they're forming. And so we do a couple things. We create the Wave Trader pivots, and then we find signals at different modes where they're turning, where they're extending, where they're breaking. There's, like I say, 7 different experts in here that do different things. We're going to look at them, but that's really what it's doing. It's trying to find the best possible pivots and then trading off of them. So it's very, very simple concept. Okay, hang on a second here. Let me arrange something really quick. All right, here we go. Okay, and there's the usual, summary stuff in here. Okay, so using pivot analysis, Wave Trader identifies trend reversals and trend continuations. Higher lows, lower highs, and reversals, major reversals. It combines multiple time frames using fractal theory. So we look at, if I went back to the zigzag chart and did like a 30 period zigzag, a 20 period zigzag, a 15, a 10, like down to 3, you would see these different like big zigzags, and then kind of smaller ones, and then much smaller ones. So by analyzing those multiple time frames on the pivots, not zigzag, we don't use that, but the pivots, we can find confirmation that you're in the major wave, you're going up. So look at the minor wave, and that's going up too. So that's confirmation that you are in the major trend and turning up with it. So we do that. And also we have an Elliott wave deal. So, and we'll talk about Elliott waves in a minute here when I get to it. All right, let's go and go on down. So the whole idea of this conceptual slide, buying the higher lows, like we talked about, buy the dip. That's what we want to do. And you'll find out they're usually at key retracement points as well. Okay, so they will confirm that you're doing the right thing when you're trading off of pivots. Okay, so now Wave Trader for Fulgent. As I say, Fulgent is the company I created to bring this technology out to great platforms. And the one for Metastock is fantastic. Just got added to Metastock 18. Love the software, by the way, Jeffrey. It's awesome. So it's supported in Metastock 18. That's what we built it for. And so Fulgent is the company it comes from. And we have other products for Metastock in Fulgent. So let's look at what this thing is. So it's integrated into Metastock very seamlessly. And I'm going to show that here in a second. Basically, there's multiple experts. You select the ones you want to trade. And then it will start generating signals and exits. And this is very unusual. This takes some fancy footwork, which folks at Metastock helped us do. But to actually show these trailing profit stops in the chart is not easy, but it will do that for any of the signals it's generating. And so you can also shows in the interface, there's a stop level. Wherever you are, it says, here's the stop that has been provided, okay? And that implies that these are mechanical systems, and I'm going to show you some system tests in a minute because they are. And with any mechanical system, they're some percent accurate. I'm going to show that table in a second, but that's a really big deal because not that you're just going to trade every signal. You should confirm them. You should look at where you are in the trend, what the retracement value is, all these things that you normally do to trade something to improve on that. But the fact that it is mechanically accurate, that it can generate a profit itself, gives you a head start. I mean, it's much better than if it was just indicators. So, so that's a really big deal too. Okay, so let's see. So we support all these things, and one more click here. I'm going to get to. Actually, let me go and go to Metastock now, and we'll just look at it. So I have it. I have it on the in the chart. I'm going to delete these things real quick here. Zigzag. Let's go ahead and delete that sucker. Yep. And let's get rid of stochastics. We don't need it anymore. Yep. Okay, we're back to our chart. I'm going to get rid of this pane as well. Let's see. Inner window, close. Right. Yes, I really want to do it. Okay, there we go. So I've got this loaded right now. And if I can get to the machine as if I was sitting at it, this is my trading machine next to my desk in there. Oh boy, all kinds of stuff came up. Let's see. And I'm going to go ahead and bring up Fulgent here. This is the Fulgent interface. It lists products that you may have from us. There's patterns here. This is the AI module. But right now, today we're talking about Wave Trader. And I just double click that. I get the different experts that we have. Okay. Right now, none of them are turned on. And I'm going to go and turn one on. We're going to talk about each of these in the slides. I'm going to show you examples, but just for now, I'm going to turn this one on. I'm going to say okay. And I am also going to turn on the advisor. Okay, expert commentary. Here we go. And let's do a refresh. Go chart, do it. All right. And there we are. So this right here is the breakaway strategy. There's a signal that fired. The exit's up here. Actually, I'm going to have to make these words a little bigger because they're kind of hard to see even on a monitor. But and this is the trailing stop up to the exit. So that's just the chart we happen to be on. And I can go through a couple more. And then we'll just kind of talk about what we're seeing here. This is just that one strategy. You can see it's really pretty darn good at picking out those breakaway moves. What this one's looking for are breaks of the recent pivot. So the recent Wave Trader pivot high, when it sees a break of that, it goes, or good, right there. Okay, so in a strong move like this, which you're looking at it going, yeah, it's pretty strong. So the Explorer can bring this to your attention, and then you're off to the races. You see it, and you put your stop where it needs to go, which is right there, tells you. So like if I click in here, it'll say the stop is at 129.51. So, and again, all of these will do that. If I go anywhere in here, that's at 80.71. This one is at, it says it's new entry signal. Sorry. Okay, that got in and out really quick. Let's see. Let's look at this one here. 94.70. It also tells you kind of what the thing is. So WT breakout looks for price to exceed the last pivot for long trades, to exceed the last pivot to the upside. Last high pivot is what it says. Okay, and there's links to other information that you can go to. But that's it. It's really not a lot of interpretation over here. It's just the signal, the exits, the stops, the exit. That's it. Okay, so let's go ahead and go back here to this and look at the test. I said that they were mechanically profitable, and they all are. Here's kind of, if you were to get the accuracy of each one of these things, there's 7 of them. This is what we tested out over, I believe it was a year on the S&P 100, right as we were releasing this. And this is profit per trade % for each trade. So again, it's just good that they are mechanically profitable because that's just good. You can use them. We also wanted a meta stock and just pick some, garden variety technical analysis methods that are in there that just are provided with the program, like Bollinger Bands and MACD, these different experts that are in there to just turn on and look at and play with. So just for fun, I went in there and turned a bunch of different ones on. I just kind of randomly directional movement, momentum, Bollinger Bands, MACD, Chan momentum, and tested over 2 years. I did this yesterday. Here is Wave Trader. Here's those guys. And here's another one. That was the breakout strategy. Here's the pivot strategy. And of course, these are going to be the same. I have to test these individually in there. If I want to isolate them, you can test all of them at the same time, but I want to do them individually. And so there you go. So very nice profit and sorted on that. I could go over the numbers here, but you can see it looking at this. So it just gives you more confidence to take these signals because you know that they have the ability to be profitable just running them. Okay. All right. Let's move on here to our little expert repository. So here they are, all 7, and short-term and long-term Elliott waves. I mean, there's so many different things in here. This is actually the 3rd or the 4th. It's the 3rd version of this Wave Trader technology that we've worked on and created. And so we have improved the early ones, added more. The Elliott wave one is fairly new. And so let's just go ahead and look at these. Oh, it's going to list them. I forgot. There you go. Okay, so that's what we have. The breakout, pivot change, trending, E-wave, long-term 1 and 2. They work a little differently, and the short term. Okay, so this is just talking about, you can do long-term or short-term and isolate to these. Elliott wave is considered a short-term expert pivot change, and then there is the short-term one, then there's the long-term one. So you kind of have these two time frames built in. Okay, so exploring the experts. This is the pivot change expert. It is looking for a likely pivot formation and issuing a signal there. So these are the most the signals you want to really look at closely, because it is predicting a pivot. It's right very, very often. I think the hit rate on that strategy is very, very good. These are just some charts that my helper got for me to show. This is on Apple. And so these are actual trades that were generated by it. So like I said, we're going to go through all 7 very quickly. The breakaway looks for breaks of the prior pivot. We saw an example of that just now on the live charts. And that's it. Support resistance. There you go. The trending expert is looking for, it says HLLH. What does that stand for? Higher low, lower high, right? Higher low, lower high. So it's looking for that. So it's looking at the prior pivot and says, is this pivot I see right here, this way, I'm sorry, is this pivot I see right here higher than this one? Okay, that's good. So it issues a signal there. Okay, and that's really a good one. I love the trending one. It's fantastic. The long term is just looking at a longer term pivot, a much, more bars in the pivot, so it can try to get trades like this one that showed. Same thing, higher low, lower high. And long term 2 uses that fractal idea. So it's looking at the shorter term pivots inside the bigger ones. It's a much more accurate, it's more restrictive, so they won't fire as often, but it's much more accurate in terms of, do I really have a trend within a trend? So that's what that does, using this fractal theory. And WT short term says here is one of the best performing experts, and it is. So it's going to use the very small little waves using the shorter time frame pivots to find these short term reversions. And they're going to do typically 2 to 5% per trade. Typically, the ones that work. They don't all work. Just be sure this is, they're very accurate, but they won't all result in a profit. It's really the combination of the fact that it is mechanical, and then you look at the chart and you go, gosh, do I have a higher low here? Yeah, I sure do. That's a good place to go long. Of course, it's checking that too, but just looking at the chart and confirming the trade, is a really what you need to do no matter what you're using. You need to look at it to avoid weird situations like huge gaps and things like that are just there. So the last one is Elliott wave, and this is looking for the waves 3, 5, and C. Let me do something I've never done in a webinar before, just for fun here. So here's my little paint deal, and if I were to show this to you live, let me just grab a pencil here and say, markets move. Oh, we need more of this. Okay, so markets move like this. So, all right. 1, 2, 3, 4, and then this is the 5th wave here. So 1, 2, 3, 4, 5. Then you have the A, B, C. That's the classic, Elliott wave, formation. And so what it's looking for is it looks at the pivots, it looks at where they're happening, and says, okay, I've had a higher, a lower, a higher, a lower. That's 4. That's the start of wave 5, 4th pivot, start of wave 5. That's good. It wants to put a signal right there. Then it comes down, forms a lower high after a trend. Ooh, that's good for a short. That's all it's doing. It's looking for that situation. Okay, that's my debut of the Blackboard on the webinar. Okay, so, and we'll look at some of these in the product next year. Let me see, make sure I'm in the right spot to do that. Yeah. Oh, one last thing is we do have these stops coded, and we use both fixed loss stops initially that are they've been very well tested over tons and tons of data to get the optimal stop value and profit level. You can't make stops too tight or you get stopped out immediately, but there's a sweet spot where overall the trades work out if you set it at a certain place. So we do that, and then we have a trailing stop, which you can see those lines going up in the chart. That's what those are. So both things work really well. Okay, we go back over here, and I'm going to go and turn on some more of these things. Let's see. Could just turn them all on. I'm going to turn on my favorite ones because there's, well, I'll turn them all on first. You can see what that looks like. It's pretty mind blowing because it's finding lots of opportunities like everywhere. Okay, so let's go back to Fulgent. And again, here's a little interface to it. It's running in the background, the system tray. And let's just turn all those suckers on. Okay, there we go. And let's say, yeah, let it rip. Okay, close, refresh chart. Watch out, don't look too close. Okay, so here we go. Here's, there's just all these different ones. Long-term right here. Here's, breakaway. And we're just gonna go through some charts and see what we see. Unrehearsed, doesn't matter, we're just gonna go through them. But you can see when these things are firing, the little dot is the exit, the actual exit. And here's the signal. Signal is after that exit right there. Let me zoom in a little bit. Definitely better, you can see it. Okay, so breakaway, and it gets out there, makes a little bit. Breakaway here, and one here gets out there. Okay, so, and then this is a long term, which was a loss, actually, at the stop down here. Let's go ahead and go through a few more of these. Okay, and so here's, this is a pivot. We have on one of our, on the pivot reversal system, for some reason, it's not putting the signal on the chart. I know this is that one because you see these exits here. There's no signal and there's no signal there, but it's there. It's I can click on it and show you. So let's see the pivot change strategy. So this is WT pivot change, and it's based on you're looking for reversals of the pivot. So it's right there at that reversal point. But I talked to Primo this morning. I said, can we fix this in the next like hour? He goes, oh, I don't know. So he wasn't able to do that, but he will. He'll find out why it's happening. But anyway, that's a reversal pivot trade. So is this one. So is this one. So 3 beautiful trades back to back. And again, we'll just got to go through some more here. Okay, Caterpillar, breakaway all the way up to there, breakaway all the way up to there, breakaway. Let's see, what's this one? And I'm going to also have them increase. This is trending signal right there. Long-term 2 fired there, and so on. You can kind of see those through the chart there. Here's a breakaway that pulled back and got stopped out. Did not follow through. The other thing about these, once you get into them, if you see it's not going to continue, it's a breakaway signal. So to give it leeway, the initial stop is here. That's again those tested stops. But if I took this trade and it was coming back towards my entry, I might see if it reverts at the breakaway point. But again, you're managing these trades, so you could certainly just say, well, that one isn't going to follow through, so we'll just go ahead and get out of that. But it's signaling it because it's breaking the pivot high that formed just to the left of it. So here's a good breakaway opportunity, and these, of course, all worked out great over here. All right, let's see. We'll do a couple more. And let's check my time. I got good time here. We're good. Breakaway again, and I'm looking for an E wave because those don't form very often, but I know I saw this morning, and I'm looking. Here's one E wave right here. Okay, up. So it's looking at that. It's probably a wave 4 from back here. 2, 3, 4 E wave. Here's an E wave here. Beautiful signal. Went straight up just like that. And of course, there's lots in here. So what I do is I kind of, pick my favorites, which are breakaway, trending, E wave, and short term. Those are my favorite 4. The others, I find they're good, but those are the ones I really like the signals from. And you'll figure that out once you get it and play with it. Okay, so there you go. Let's go and go back here. We'll do one more. See, that's American Express. So, and Amgen, a breakaway trade here. And let's see, we have, there's a long term, got stopped out, and breakaway trending long term here that's still in trade on the right. So that's still going up there. Okay. All right. Let's go and go back to the PowerPoint and talk about what else is in here because, as I said, it supports all the main tools in Metastock, which are great. We could go ahead and do it. I think we have time. I'll go and do an exploration right now, but it finds signals today that are happening. So let's go ahead and do that because we have the time. So exploration, explore, and I want to make sure I've got Fulgent Wave Trader turned on here. Fulgent AI Wave Trader. Now you can do individual ones right? I'm going to go ahead and do all of them at the same time. So that over, so we'll load 500 bars of data. And let's see, who do I have down here? Is the Dow 30. Well, that's not very many, but that'll be good for a little quick test. Actually, we'll go ahead and we'll let that go, but we'll also do another one if I can find it here. Hold on, the NASDAQ 100. We'll go ahead and search those as well. All right, that's good. So I've activated those two target lists and start the exploration. We'll let her go here and see what we find. It's pretty quick. Of course, I would scan many more, like SP 500, the Russell. It doesn't take that long. You know, go get a cup of coffee, come back, it's done. Okay, here we go. So here's the output. And the way we have a long signal and a short signal column, let me see if we have any new long signals today. We don't. So that is why that is one that fired today on those 130 stocks or 120 stocks. So that's why we have these two columns, in long and in short, because if a signal fired yesterday, you know, that could be a really good signal. So you have in long, and this is how far back did it fire? Three bars ago. This one fired 2 bars ago. Let's go ahead and double click that and look at it. Okay. And let's see this one. Oh, this is that pivot that doesn't have the signal. That one that the programmer's working on. Okay, let's see. Let's look at another one here. Here's a 3M company. So just going through these and seeing, oh, same thing, another pivot signal. All right, well, it's just the pivot's gonna get me today. But you can go through these, and some of them, of course, have been in trade for quite a long time. Here's one that's been in for 20 bars. And we can look at that long-term signal right there. So you can go through them very quickly, both the in longs and the in shorts. Of course, the market's kind of going down right now. So we can get that picture. Oh, did it find any? It didn't. So all in long trades right now. Interesting. So I guess, oh, well, you know why? Because the pivots haven't formed. They have to actually form, and then it can generate the signal. So yeah, that's why we have just long trades. But that's as simple as it is. You can click through them this way or get a report, you know, and go through them separately later on. Okay, so that's that. And let's see here. Ooh, look at that one. That was nice. Okay, let's go back to this. There's more. And this is what I just showed you. Great trades every day. You can also run it in real time, which is good. Then there's a system tester, and I talked about using it on some of the experts yesterday, but it's a great tool. You just set it up there, you know, pick your Fulgent AI Wave Trader, your target list, and run it. And we did a recent run. This is not real recent. It was about, let's see, it was on 6 years of data, and it was done about 3 months ago. So it's not like yesterday, but I had this slide, so I want to show it. And this is the Wave Trader performance compared to the other basic. You know, there's some more in here that I didn't include in the other list, like volatility analysis. Let's see, stochastic. So that's really good to see from the system tester, just so we know that it's generally profitable on the mechanical side. Okay, well, I think that is it for me, Jeffrey. I'll go ahead and do a quick summary here. Wave Trader includes their special offer, Metastock today, I'm sure, but includes 7 great experts with the advisors, long-term and short-term signals, including Elliott wave signals, stops posted on the charts, unusual and very helpful, and of course, it's available for Metastock 18. So that is that's it. All right, and we can go back to software if we need to. Jeffrey, what do we want to do?
Hey, I have a question for you.
Sure.
From YouTube. Stefan wants to know, what about timeframes? Does this work well on 1 minute? Are there timeframes that you recommend?
Well, it's, of course, we designed it around daily charts, but as you know, charts are fractal in nature, so pivots form in real time. Actually did some work yesterday in real time in pivots and, you know, trading with them. So sure, I mean, anything stochastics, all this stuff works in any time frame because of the way the market behaves. It doesn't matter what the time frame is, you're going to get rallies in that time frame and then pullbacks. So yeah, my favorite time frame to trade is the 5 minute. It's not too quick. It's a little more relaxed, but also I do like trading with, you know, very short time frames, including ticks. But 5 minutes kind of my favorite real time.
Peter wanted to know if you knew what the average profit per trade was.
In the mechanical way, like just running it. Yep.
Yeah.
Yep. So that was this slide way back up here. Let me go back to it. Yeah. Well, there it is. This is from, I believe it was a 2-year test on the S&P 100, 2 or 1 year, but that gives you an idea. So, they're not like wildly, like 90% accurate or something, but they just, give you a huge edge because of that. But those are the numbers right there. So you can screenshot that and you got it. By the way, this one up here is if you include all of them, those are, some of the best numbers in here in terms of both the hit rate and the PPT, but that's just all of them tested together. These are the individuals. And that short term, like I said, I love that thing. That is very, very accurate because in the short term, the forces that operate on the market are highly viable. They're people trade in that time frame a lot. So, 4 or 5 bar move, yeah, it's good. Okay,
cool. And let's see. That's all the questions that we've got. I'm going to actually show scanning for you real quick after I kind of talk about how to get this. But before we let you go, I want to say thank you for spending some time with us. Thanks for being such a long-term friend of Metastock, partner. Really appreciate it. Always good to talk to you, Ed. Thank you for coming in.
You're very welcome. Love being here. Thank you all. Take care.
All right. Thanks, Ed. Okay. Let me go ahead and do this. Let me go ahead and make me the presenter again. Let me go ahead and do this. Turn on my video camera and show my screen. Okay. And then just to recap what was included, and I'm going to go ahead and take this out for a minute just because I don't need it for now. But just to recap what was included in this Wave Trader Expert Advisor, let me go ahead and go into the slideshow here real quick. So in total, it's those 8 different methods that he's talking about, including trending, the long-term expert, the long-term 2 expert, the short-term expert, and the LA Wave expert. And he did show you the trailing pivot stop and how that works and how that can kind of help you identify when to get in and out. He showed you how all of them perform and how well they all work. And he did a really, really good job of actually kind of walking through all of that. Since we do have a little bit of extra minute, a few minutes extra, I'll just kind of walk you through how this actually looks in Metastock. You get the stop, you get the explorations, the system tester, and the expert advisor. And I'll just recap for him. I mean, Ed does a really good job of showing everything, but a nice little recap doesn't hurt too much. So let me go ahead. I've got it installed here in the demo machine for our webinar room. And let me just we'll just open up a little bit of a chart. So what I'm going to do here, let's just do MAR. Oh, and I'm on the system test. So we go ahead and go to the chart real quick right here. And let's do, actually MRO was the one I wanted to do. Over here, I'm going to apply a specific template. And the one that I want to apply is actually called Fulgent /WT, if I remember right. So let me go ahead and see if I can find it right here. Fulgent AI Wave Trader. All that's going to do is it's going to open up the chart for us. It's going to basically put that stop on there. And then it's going to give us the expert advisor. You can go ahead and open up the chart. You'll see how easy that is. And I really like the way our new chart engine looks. Let's go ahead and kind of just take a look at here. You've got here the different signals based on kind of what I was just showing. Here you had a little bit of a breakaway. You can see where it had a bit of a breakaway gap to signal that. And let's just zoom in a little bit here. So let me go ahead and kind of just draw. And we can, that'll probably make it a little bit easier. Here you have the breakaway signal. As soon as you get that first signal, it's going to start calculating your stop loss. And you'll see as soon as that stop loss is penetrated, it wasn't for a while here. We ended up actually kind of taking a really good signal here. We moved up our stop right here, and we finally stopped out of that trade right here on January 22nd. You'll see the little arrow above it, and if you hover over it, it says exit long. That just means we got out of that long position. Pulled back a little bit against that, and then we got a trending signal, and as soon as that happened, we start to get our stop loss again. And you can kind of just see, I'm going to go ahead and zoom out a little bit here so you can see more data. You can see kind of how that trending stop gives it plenty of room to fish, but also kind of tightens up and kind of helps you protect some of your profits. Here you got out of it right in time for like a good sideways action here. Here you had a pivot change. Again, you get your stop. Here you had your breakaway. And all of those expert symbols are basically identified. Here you had a long-term. You had another breakaway just recently. You can see that it does a pretty good job of catching those waves, if you would. There is an indicator here at the very end of the chart. You'll see that it has like this sideways arrow that kind of points to the right. That just basically indicates that you're in a trade and it's currently long. In fact, if you hover over that, it's going to tell you that you're currently in a long position as well. So just looking to see if I have any questions over here. So very, very well designed. I like the way that they draw this. I like the way they integrate into Metastock. And that also includes the commentary feature that we have in Metastock. So let me show you that real quick since we do have a minute or two. So if I come into the view, I'm going to go ahead and open up the expert commentary. And when I do that, let me actually kind of do this. It kind of messed up my display here, but let's go ahead and kind of fix it. As soon as we do that, you'll notice that there's a bit of a triangle. Just point straight down at the bar that you're looking at. So if I'm looking at this basically for Friday's activity, what you're going to see here is Marathon Oil. You're going to be able to see what signal type that you're currently long in. Right now we're in a signal type for the WT breakaway, and you'll have that trailing stop. Okay, with this expert commentary, you can move this arrow. What I'm going to do is basically just kind of move it. And then if I wanted to see what it gave us in advance of this long term, right here, you've got WT long term 2. I can actually make this bigger so you can kind of follow around with what I'm saying here. WT long term 2, this expert uses multiple size wave analysis to find long trade opportunities on wave fractal conformation to improve performance, using minor waves for the initial signal generation while confirming trend direction with the major waves. Right here, what you've got is active stop. There's not one because we're in a new signal. That stop will show up tomorrow. So if I go 1 day forward, I just click on the advance to the next bar button right here. Immediately, it's going to then start to give us a stop. In this particular case, 1074. Now, as that stop advances, I think it advances the very next bar, or maybe the bar after that, but that will update in your commentary. It's the bar after that. So right here, it goes from $10 to $12.60. Looks like it even goes up a little bit more, but it does a really good job of kind of giving it enough room to fish, but also at the same time kind of protecting those profits that you're getting. I think they did a really good job with kind of designing the stops. And money management is such an important part of trading. I think that's almost also the reason that like it tests so successfully with that. So there you go. That's kind of how the play-by-play looks. That the experts are all kind of drawn on here for you. The commentary is automatically generated. You also have two different ways of looking at that stop. You can either look at the actual stop value, or you can look at the commentary. Okay. As with all of the other signals, you're going to have scanning too. And I love the way that scanning works in Metastock. Let me go ahead and open up the Power Console. I am next, so I can take as much time showing this as I want to. But with this, let's just go into what we call our Explorer, which is our market scanner for Metastock. What I'm going to do here is I'm actually going to kind of click on the scanner. With the new 18, I can actually search. I can find all of the Wave Trader scans just by typing in Fulgent up here. And that'll just allow me to easily find all the Wave Traders. So you notice there's going to be a number of them. So you have Wave Trader, and then you have the other patterns too. You've got breakaway, Elliott wave, long-term 2, pivot change, short-term, and trending. So I have a couple of different options with this. I'm going to run just the Wave Trader. I'm going to go I need to turn off one of the scans though. Let me go ahead and unselect all of these. And then we'll go back in and we'll just turn on the Fulgent one that I want to run. Okay, so we'll just run the main scan. And what I'm going to do is I've got it set to run against the Dow, the stocks in the Dow, the NASDAQ, and the S&P 100. Or I'm sorry, the S&P 500. Total is about 636 instruments, but there's some overlap there. One of the things I like about Refinitiv and the place that we get our data is just the amount of data that's available. We've had a lot of questions. Does this work on futures? Or will this work on the stocks that I trade in India and all that kind of stuff? And as we've mentioned before today, in today's session, we have literally right here, if you look at the amount of data that's available, it's fairly incredible. Right now, I've got 636 stocks selected. If you look at this bigger number, There's 313,328 different instruments, whether those are stocks or ETFs or mutual funds or commodities in all kinds of different countries. But for the purpose of just this scan, I'm going to keep it somewhat limited. We're going to do 636. We're going to do the daily using the most current day. Okay, so let me show you kind of how this works. I'm going to run the full scan. So it's going to run through all those 636 stocks. It's fewer than that because there's overlap. There's actually a total of 529 in those 3 different indexes. Okay, what it's going to do is it's going to identify all of the stocks for me that either have an opportunity for any of those 8 patterns or that are in a trade for any of those 8 patterns. Okay, if you are like Ed, and he says, I love that short-term trend, and you just want to find the short-term trend, that's what you would come in here and do that, just the short-term trend expert scan for. And you could then just identify all of the short-term ones. But if I want to run just everything, and I think I'm going to actually run that again. I think I didn't load enough records in there. Let's go ahead and kind of just kick it in again. You notice it's already done, but I didn't find anything. So something's wrong. And it was, I didn't load enough records into the expiration. But so what it's going to do is actually go through those 529 scans. This time we're going to load enough data, and it's just going to identify, again, any of those patterns that have currently a buy or a sell signal, or ones that are currently in and how long they've been in. So as soon as that's in, I'll go ahead and show that to you. But actually, I might just go ahead and click on cancel. You can see it's kind of punching through these things rather quickly. But what I'm going to do is I'm going to go ahead and cancel just so I can show you what a report looks like. I know it's rejected about 40, so they're going to be stuff that I can let you look at. And then we can kind of move on. So right here, we let it go through about 60. Right here, you've got different columns. If it's a long trade, you're going to have a 1 in this column. If it's a short trade, you're going to have a 1 in this column. Here we've got in long, and you see some 1s here, okay? And the number of long bars, that's how long it's been in those long positions. So let me go ahead and sort and see if we have anything brand new in those 60. We don't. But right here, if I go on in long, we can like look at in long. And all of these ones with a 1 have an in long pattern. This one has been in long for 3 days. This will be 52 days. So not only can you just find new opportunities that exist today, but you can find anything that's actually been in a pattern. So if you want to be able to see, sometimes, you want to see if it hit a pattern. A lot of people like to look to see if it penetrated the high of the bar as like an additional confirmation. You can easily do that with this exploration. So there you go. Just checking to see if we have any questions. Again, brand new add-on for Metastock. What I like about it, and I think you will too, is it's very, very trend-based, and it seems to follow the trend quite well. For me, I like to be in trades for a while, as long as the stock is going up. So something that looks like this and tests the way Ed showed it on the chart actually works really, really good. So there you go. It's the brand new Wave Trader. Want to say thank you to Ed for kind of putting it together and getting it done for us. It's a great little add-on, and it's also very, very affordable. Let's talk a little bit about that. So again, with the expert, or with the system, with the method, you're going to get the stop that they designed for it. 8 explorations, so the main exploration, and then the one that allows you to scan for all of the individual patterns if you find a pattern that you like best. You have the system tester, which will allow you to do all the testing and kind of compare it and see how it works. Find the best stocks that it works best with, because with our system tester, you have we'll talk a little bit about our system tester, but you can test this idea against as many stocks as you want and really get a good idea of how that works. You also get the expert advisor that allows you to kind of get that feedback, that English-based feedback, the stops, all of that kind of stuff every single day. So there you go. If you guys have questions as we're going, let me know. Type them in the chat. I've got all of the chats open right here. So when I look over here, I'm just looking to see if you've asked me a question. And when I look over here, I'm looking to see that everything's okay. In any case, so for this Wave Trader, what we're doing, normally it's going to retail for only $500. Here at the event, it's $395. Again, it's, as Ed said, it's his most popular add-on that he's ever developed. Where it's brand new to Metastock, we're going to offer it with a 30-day money-back guarantee. We're going to let you try it. And again, if you don't have Metastock, maybe today's the first time you've heard about Metastock. Metastock's been rated #1 in its price category for decades now. We're going to give you a free trial to that if you need it. And you can give us a call to take advantage of that at 800-882-3040. You can also visit us online at metastock.com/saleschat. You'll also notice that as part of our summit offer that we're doing today, you can get the GoNoGo Complete, the Trender Pro, the Fulgent Wave Trader, some training that we recorded in November about technical analysis and standard drawing of support and resistance. Oscar does such a great job. We're going to bring him in at the end of the session today, and he's going to look at stocks and talk about his feelings on the stocks and commodities. He does some really good training. And we sat down with him back in November and recorded some training with him. He did a really, really fantastic job. That training is included here, as well as 2 years of Stocks and Commodities magazine, 3 months of a subscription to the learnmetastock.com website, which is great. In addition, we'll give you some home study materials. If you bought all of this separately, it would be $4,530. But here today at the event, we're going to discount that to $2,245. And I'd encourage you to try it. This is some of the best products that we offer, as well as our software that's been rated #1 for almost 30 years in a row. So 800-882-3040, metastock.com/saleschat, or metastock.com/summitdeal. So there you go. Okay. All right. Here's a little CMT blurb that I was looking for before. I do want to say thanks to CMT Association for sponsoring the events. They've just done a really good job. Very well-reputed organization, cmtassociation.com, to find out more about them. And as luck would have it, I do need to take a sip because I have something kind of in my throat. Victor, thank you for your question. Is this an AI scanner? This, I do believe that Ed. This is not Ed's Fulgent AI scanner. There is one of those if you're interested in it, and it's really, really good, Victor. This one looks for his wave patterns and the other 7 systems that are available. So this one doesn't do AI, but Ed actually created a product that's also called Fulgent AI that does do AI scanning, AI testing, AI server-based system development. And if you're interested in that, Victor, get in touch with us and we can send you some videos on it. He did a really good job with putting together some AI, artificial intelligence scans. Thank you for the question. All right. And see, as promised, I do look at questions. All right. We're Metastock. I'm going to talk a little bit about Metastock. We are offering, if you just want to try Metastock, it has been winner 29 years in a row, best software in its price category by the readers of Stocks and Commodities magazine. The reason it's been rated so highly is exactly what we're talking about, the ability to scan markets. I do that every day. Test trading ideas to see what works. I just showed that, and of course you want to be able to understand how that works. I'm going to talk about system testing for an hour right now. We have a patented forecaster that allows you to statistically forecast where prices are likely to go. A real-time alert, commentary, signals, great software. Now it starts at $59 a month, $69 if you're here in the US. And what we're going to do is if you just want to try that out, you can get that here. We'll give you what we call an extended trial where you can buy 1 month and get the second and third month for free. So if you're doing end of day, that's like $23 a month. You can do that at metastock.com/traders-summit 3-for-1, or you can give us a call, 800-882-3040, metastock.com/saleschat. And if you can, Bobby, will you type those up and put those links in the chat since I was going to say I'm working right now, but I'd appreciate it if you can do that. All right, cool. You're also working, I realize that. Anyway. All right, as I kind of alluded to earlier, it's my turn to talk. I hope you're enjoying today's session. Let us know in the comments how you're doing or if you're enjoying it. I hope you found it helpful. I hope you've learned something. Hope you learned something from me too. I'm going to talk a little bit about my background. But first, I'm going to read this little disclaimer here. Today's demonstration is designed to instruct you on using Metastock and the accompanying software plugins. It's not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by the investors who are aware of the risk inherent in trading. Metastock shall have no liability for any investment decisions based on the use of the software, any trading strategies, or any information provided in connection with the company. So I hope you enjoyed that legal disclaimer. I've started here at Metastock. It's going to be 25 years ago. Actually, it's a little bit more than 25 years ago. I just got it. We just passed 25 years. So it's been a long time. I started in inside sales. So if you had questions about Metastock, I very much enjoyed working with traders and talking about like what they were trading and what they wanted to do, and kind of like what their goals were, what they wanted to accomplish. I actually worked in inside sales for the better part of a decade. So, and I enjoyed it. I thoroughly, it was a good job. It's been a good company to work for. For the next 10 years or so, I worked in our business development, where I met a lot of the people that I've invited to do the summit today, where some of the biggest industry experts, and we've worked on trading methodologies and done a lot of webinars and kind of talked a lot about the software. And then for the last like 5 years or so, I've been basically doing that too, as well as kind of being in charge of the sales team and making sure that everything gets handled well there. And it's a great group of guys to work with. Anyway, it's been a very, very good opportunity for me. I feel like I've had a chance to sit with some people that are some of the greats of technical analysis and learn directly from them, like John Bollinger, Alexander Elder, all of the people that are presenting today. It's been great. I've very much enjoyed it. It's a great job. In any case, the other thing that I've been extremely proud of is for like 30 years in a row, it's been the highest rated software in this price category. Most of us here that work at the office, we use our own software. We're all traders. I've been using it for decades as well. And I really, really like it. The other thing I like to kind of talk about, I'm not going to read this here off. You can read it if you want. But the other thing that I'm really, really like to talk about, I like to brag about, is our support team. They're all here. They're all based in Utah. We actually keep more people on our support staff than we keep in sales and marketing put together. If you have questions, you can always call, you can chat, you can email, whatever is most convenient for you. But one of the things that I really, really like is it's not uncommon for us we survey all of our customers that contact support. It's not uncommon for us to get 100% ratings for the whole week. And that's just unheard of. Like if you've ever called a company, usually it's hard to get answers. And I just love how well things are supported. And if you're using Metastock and you've talked to our support team and you've had a good experience or a bad experience, type it out in the chat. But I'm so proud of how good of a job that they do. And I like to talk about how they do for us. But in addition to that, the other thing I like to brag about, and this is a straight out brag, and I need to update the number, but for 29 years, almost 30 years in a row, it's been rated number 1. We've been working on it. It's very well established. Over the 25 years that I've been here at Metastock, we've seen a lot of companies come. We've seen a lot of companies go. We've always been kind of very, very aggressive at developing out software that helps people trade. And I'm going to kind of show you how that can help you with that today. But I just think that shows in the numbers, in the pedigree. It's a very, very well-established, well-branded product. So let's see. Jim says, Dr. Elder is a blessing to the trading community. That comment applies to me too. I don't know if I'd put myself anywhere near the same but Jim, I appreciate the sentiment. So, but Dr. Elder, yeah, he's one of the best technicians out there for sure. Mike says, do you offer a modern cloud-based version or is it still software-based? Yeah, we've actually done testing in the cloud and we don't want to put our software there. It's not fast enough. I was watching, I'm not going to mention the software, but I was watching some cloud-based software, like them doing a demonstration of it just a few weeks ago. They had to keep hitting the refresh button. HTML5 is no way to send real-time data. through. It's just, we tested it. It's not something that it's ready for release. So thanks for that question though, Mike. It might work for a chart or two, but if you really want real-time data, it just didn't pass our testing. So thank you for that question though, Mike. Appreciate it. All right, let's talk about what we're going to talk about then. And then there you go. So today what I want to talk about is I want to teach you something. And maybe, hopefully, it's something that you haven't learned. But I think trading with trading plans are important. I'm going to teach you the MACD, and I'm going to show you how 3 different ways people like Gerald Appel kind of talks about the MACD and how it's been used over the years. We're going to talk a lot about kind of testing trading ideas and how that works in the software. We'll talk about scanning. And my main goal today is to make sure you learn something. And I hope you do. If it's not from me, I hope you learn it from any of the other 8 experts that you go. I hope today is valuable for you. But if it, in addition to that, what I want to do is I want to give you enough information that you, as a trader, feel comfortable in doing at least an extended trial on Metastock. Try it out, get it installed. It's been extremely helpful for me over the decades to trade. Last year, I had the biggest short-term capital gains bill I've ever had. Certainly last year was a great year, but I'm hoping that it's something that you can look at and that is helpful for you and something that you want to use. Okay. And as we said in the legal disclaimer, we're not promising any type of results. I think it's good software. We will let you try it if it's something that isn't useful for you. You shouldn't keep it, quite frankly. So in any case, let's kind of move on with this one. If you're not familiar with Richard Dennis has a story that I like to talk a little bit about. Richard Dennis was a famous technician in the 80s, actually. He you can go to Wikipedia, you can type in Richard Dennis, and you can kind of read the story. This is actually where I get a lot of the numbers. But he started with next to nothing and actually grew an account and was a very, very successful trader in the commodities markets. He had a buddy who was Richard Dennis, Bill Eckhart. I had to say Richard Dennis to remember Bill Eckhart. But in 1980s, him and Richard Dennis and Bill Eckhart had a little bit of a disagreement. And what Richard said is that he thought that what he was doing in terms of all the money that he was making in the futures market, he could teach other people how to do. And Bill Eckhart disagreed. He was like, you can't teach people how to trade. It takes a certain sort of, let's say, psychological makeup. There's a lot of genetics that are involved. And it's just something that you really can't teach people. And so they had a fairly good disagreement that they decided to kind of test out. So in 1984, they basically put ads out in the newspaper. I think they did IBD and Barron's and a couple of advertisements said, hey, come trade with us. And they recruited, I believe it was around 24 people, but the Wikipedia article can tell you that. I do know it was 2 females and the rest were male. But what they did is they actually trained them how to trade. And in January 1984, they basically gave them money. They gave them between $250,000 to $2 million. And they said, here, go trade. And basically, the experiment that they basically crafted was called the turtle traders. And there's a whole story about why it's called the turtle traders. One of them was familiar with the turtle farms that they had, I guess, in Singapore. But they basically called it the turtle traders. Okay. And it was an incredibly successful endeavor. Their gross profit after 5 years was about $175 million. And one of the things that Richard said as a result of that is, though there's a couple quotes that are pretty cool, but this is one of them. I say you could publish my rules in the newspaper, but the problem is no one would follow them. The key to trading is consistency and discipline. And that might be the only quote that I have, but I should put the other one back in. It is actually pretty good, and I can't remember it off of the top of my head. But one of the things that I always kind of like to start with is discipline. I think trading with discipline is important in the marketplace. Days like yesterday means remind us that it's important to kind of have stops and respect our stops. But one of the questions that I usually ask when I go out and I do this kind of presentation in public is, what do you think is the best profession for trading? And we get a lot of answers like school teacher or psychologist or engineer, or you name it. Psychologist, I actually find is an interesting answer because Dr. Elder started as a psychologist, and so did Jake Bernstein. And so I find that a good answer, and I think that there's probably some good understanding of that. But the actual answer, according to the article that this was all based off, was actually an airline pilot. And actually, coincidentally enough, we've Greg Morris, who is very retired right now, but a very, very key figure in the market, was a fighter jet pilot. Then he went on to manage billions of dollars for Stadium Money Management. And like I said, he's retired now, but I've also wrote some candlesticks books that are amazing. In addition to that, another person that we work with was actually Chuck Hughes, who was an airline pilot. So airline pilot is actually the answer that we usually come up with here. And I've thought about that over the years. And it really, I think, just comes down to discipline. When you're an airline pilot and you're going to take off, you have a complete checklist, and you review your checklist. Okay, the landing gear in the right place. And I'm not going to show off my pilot. I'm not a pilot. We'll just leave that where it is. But the discipline, takeoff, landing, steps, rules, all that kind of stuff helps with discipline, which is the key, according to Richard Dennis, to trading successfully. And I do think discipline is important. So the other thing I like about this is rules. He talks about his rules. Generally, the thing that was true about the turtle trading rules or the MACD rules or any of the rules that are in Metastock is they're all objective. So since they're objective, you can actually test them. You can actually see how they work, and they're easy to follow. At no point today when we start to talk about trading methodologies, we're going to go, well, okay, if the Fed raises interest rates, this is going to happen to the market. Or if earnings come out this way, this is what's going to happen to the market. Or like if there's a global pandemic or housing crisis or any of those types of things, we're not going to be looking at those. Because technical analysis in itself is a study of price activity, right? We're not looking at we're looking at the trend, we're looking at momentum, and we're trying to make decisions that are repeatable. But we're not making guesses in terms of what we think things will do. How many, let's think back to the pandemic and when that happened. Did you think it would go down? Yeah, you probably did, right? So did everybody. They went down huge amounts. I think it was like 38+% over the course of a couple months. But did you think that it was going to bounce back so quickly? Probably not. Maybe you did. But in any case, with technical analysis, what we look at is, okay, what's happening in the marketplace? We're looking at indicators. And a pure technician will say that all of the fundamentals are already baked into the price. But I'm kind of babbling. Let's go ahead and kind of move on. Let's get to where we're talking about. And I promised to talk to you a lot about MACD and what MACD is and how MACD helps you in the market. So this is Gerald Appel. He created the MACD indicator, very, very famous indicator. We're going to talk about how it's constructed, and I'm going to give you 3 ways that you can actually use it in the markets, okay, or in your trades, okay. I would say that Gerald Appel, it's a trend indicator, but it's also a momentum indicator. So it does help you measure trend. I'll talk a lot about how that works. It also helps you look at momentum. And if you guys would, if there is a stock that you'd be interested in looking at, give it to me. We'll include it in the charts that we look at. A lot of people say trade with the trend. It's come up a couple times. The trend is your friend. Befriend the trend. Rising tide lifts all boats. You know, this is a way you can look at the trend, and it's very, very objective, which is what I want to be able to do when I'm trading. Okay, so I want to use an objective way of looking at the market. It also does momentum. So, and yes, Jim, I'm going to be talking about the MACD and the standard settings. You can consider different ones. It's I think it's 12 and 26 exponential or 27 exponential. But let's go ahead. You can use different settings if you want. I like to show that. Nyan, thank you. Will you look at Home Depot to start? Sure. I actually haven't looked at Home Depot for a while, but it is part of the list I scan every day. So let's go ahead and look at HD. And what I'm going to do is I'm going to start with a fairly, actually, we'll just apply it with a histogram. But let me go ahead and close out this chart. And we'll go ahead and do this. What I'm going to do now, well, I'm going to go ahead and open up HD, which is what Nyan is talking about. So Nyan requested this. Thank you, Nyan. And Richard said he had a question. Hey, Richard, I didn't see a question. I just see, sorry, meant Jeff Gibby. If you will, repost that question if you had one for me, and I'll look at it in a second. Okay, there is a new indicator in here, or that's called MACD histogram. There's a new template, and that has 3 lines on it as opposed to the 2 I normally talk about. I'll talk about how all 3 of them, since I actually, one of the popularized way to look at MACD is with a histogram, and Linda Rajki actually popularized that, but people have been asking for an easy way to put that on there. So we do have a new indicator in 18 that's called MACD histogram that includes 3 lines instead of 2. And I'll go through how all 3 of those lines are calculated. It's fairly straightforward. So right here, you do have 3 lines. I'm going to actually change the theme of this to white just because I think it's easier to see when we're looking at a chart. So we'll do actually bright white. And I think that'll just make the signals a little bit easier to see for you. What I'm going to do here is I'm also going to zoom in a little bit on the chart. So we'll look at this area, okay? And we'll go back just a little bit, okay? Now, there's 3 lines that are kind of calculated as part of the MACD. And I'm going to talk about how all of them are calculated for you. So the first thing that we want to do to show you, I'm going to actually grab the 12 exponential moving average. And this will be based on the close. You notice with Metastock, I can just drag it from that indicator quick list and drop it on the chart. Very, very easy. One of the things we try and focus on while we're designing software is to make it work like your other applications, like your other Office applications or your other Microsoft applications. What we want you to be able to do is very intuitively look at things. So right here, this is what we call an indicator quick list. There's a couple hundred indicators in Metastock. I'm going to grab the moving average again. I'm going to just drag it. I'm going to drop it on the price chart. And as soon as I do that, I'm going to put in the fact that I want it to be 27. Actually, I think it is 26. Exponential. I'll go ahead and click on OK. Once I have something drawn, if I want to change it, like if I wanted to change this particular indicator to make it a little bit different of a color, I can just double click on it. And what I'm going to do is I'm just going to change it here. I'm going to make it a different color. So I can refer to it as the red line or the blue line. I'll make it a little bit thicker so you can see it. Okay, we'll go ahead and apply that. And what I want to do actually, and I'm going to do that again with this one as well. And we'll just make it a little bit thicker. I'm not going to make it blue. I'm just going to make it a little bit thicker so it kind of shows up better on the internet. Okay. For now, I'm going to detach what they call the expert advisor. So we'll talk more about that when I'm ready to. We'll go ahead and do that now. So we'll just be looking at the chart with the MACD. Okay. The first line I'm going to talk about with the MACD is going to be the MACD. Okay. And if I wanted to, that's going to be this gold level, which again, I'm going to double click on it so I can make it a bit thicker for you. And I want you to be able to see it a little bit better. While I'm in here, I'm going to make all of the thought plots a little bit thicker so you can see it. And the differential line we can change. Okay. We'll just leave that here at, okay. So all the lines should have thickened up just a little bit so I can talk a little bit about them. The MACD calculation is relatively simple. Gerald used like a 0.75 and a 0.9 exponential moving average, but the closest whole numbers those are is a 12 period and a 26 period exponential moving average. So if I wanted to calculate a MACD, this yellow line, all I'm going to do is I'm going to subtract the value of this 12 period exponential moving average from this 26 period exponential moving average. That's it. That's how you calculate a MACD. Okay. And now that, if hope you probably understood that before, but now that you understand that, you can kind of understand exactly why you can use it to measure momentum quite a bit. Okay. And so I'll kind of talk about what I mean here using our trend line tools. Right here, we had a pretty dynamic move up in the market. Like now we're looking at HD, and over these 46 periods, it went up about 37%. Okay. And what you'll see here is the faster that MACD moves up. It peaked right about here. Okay, I didn't actually want to move the other side of that line, but okay. But it peaked right about here. Okay, right here it had a nice, big, huge run up. And as that run up happens, what's going to happen is your shorter term moving average is going to get further away from your longer term moving average. So the red line is going to get further away from the MACD line. So not only are you measuring that it's going up, it's above zero, but in addition to that, it's moving up significantly, which is why you're getting a higher peak in MACD. Conversely, if we're going down, let me just kind of zoom out a little bit, and we'll find an area that goes down a lot. Right here, we had a very significant trough, peak to trough move right here. If we go from the top here down to kind of the most significant move down, here we had a 28% drop over 36 periods. And you'll notice that as that starts to move down heavily, the difference between the longer term and the shorter term moving average gets bigger and bigger and bigger, which leads to, the shorter term and the longer term gets difference. It's a negative difference. Right here it crosses below zero, meaning there's a crossover of the moving averages, but you'll notice that you have a significant trough. So just understanding that, you can know that you're measuring momentum. You're measuring how fast this is moving. If it's sideways, let's just kind of point out this area right here. And if you can't tell, I just love the new trendline tools in Metastock. But if I'm looking at an area right here, there's very little movement over this, let's say this 53 periods. And the result of that is a very, very shallow, at least when compared to like this move up and this move up and this move down, what you have is a very, very shallow line. There's still a little bit of movement over here, but what you're getting is a very, very shallow MACD. And that's how you use MACD to measure, let's just say momentum for now. That's all. You can look at kind of how big your peaks are, how big your troughs are, and you can know where the momentum is and whether it's shifting up or down. Okay, so that's one way that you can use MACD. Here where it's sideways, you had a very shallow MACD that was hovering right around the zero line. Not a lot going on. Very shallow MACD, not a lot of movement. Okay. Now the second way that you use MACD, I'm just going to go ahead and clean up my chart as we go here. The second way that you can use MACD is as a measurement of the trend. Remember, the trend's your friend, right? We talked about that. But the way that Gerald used that specifically is that let's go ahead and kind of just zoom back in on this chart a little bit. And we'll talk, we were talking about the gold line before, and that's the difference between this moving average and this moving average, okay? This red line is what Gerald called the signal line. And what that is it's a 9-period exponential moving average of this difference, and he calls it a signal line. And the way that you read it is if you cross up above the signal line, the MACD, like you do right here. So right here, the MACD goes from being below its signal line to above its signal line. When that happens, the MACD enters a bullish phase, okay? When it crosses back down here, okay, as it does right here, the MACD enters a bearish phase, and so forth and so forth. So right now we can see where we go into these bullish phases, and when we go into the bearish phases. And again, as long as I did a halfway decent job of explaining to you, you can do this for yourself on the chart because it's objective and it's not subjective, right? Okay. We do have a tool, and we've been showing it in Metastock that's called the Expert Advisor, and it will help us understand this. There's a bunch of experts that are in Metastock. There's one that I like to show that does all the candlestick patterns, like, well, not once all of them. Let's say it's about 30 or 32 of the most common candlesticks, and it shows them on the chart and draws them for you. There's also this MACD by Metastock. So I'm going to go ahead and attach that to the chart. Okay, we'll go ahead and click on close. And what I want to point out right here is it's going to draw that trend ribbon for you. So here you have your bearish zone, here you have your bullish, your bearish, etc. It's actually going to draw that. Now, I did miss it by a day right here, so I'm going to correct my line right here. But right here, you'll see that this is a MACD buy signal. So what's happening right here on the chart is based on the MACD and its signal line, it's entering a bullish phase, which if we're just using the MACD to trade, if we're bullish on a stock, you might want to consider buying the stock. So it's giving us a buy signal here. Right here, it's giving us a sell signal. Right here, it's giving us a buy signal. Here, it's giving us a sell signal. And this is the thing I really like about technical analysis. We come up with these lines objectively. So when we're talking about inflation or the COVID wave that is the flavor of the month, or, you know, quantitative easing, or whatever it might be, that we're looking at the trend of the stock and saying, okay, well, based on kind of like what it's doing right now, here we're getting a buy signal. Okay, does it work all the time? No, but we can actually test it because it's objective. We're not making guessworks out of this. Okay, and what you see in the expert advisor is when that buy signal happens, you're going to get that buy signal. You're going to get that sell signal, and then you could say, well, okay, well, based on this buy signal, which is just the cross of this signal line, I went ahead and bought here. I sold here. Did that work well? That one would have worked well. Probably not this one though, and not this. This one would have been okay. You can kind of go and get an objective idea of how your trading rules are going to work on the stock that you're interested in. Okay. Now, a couple things before I kind of start to move on. The other thing that I want to talk about is I promised to explain what all three lines were. So the blue histogram here was developed by Linda Radke. I think she developed it, at least she popularized it. And what it is it's the difference between the gold line and the red line. So you can see if it crosses up above 0, you can see that there's a signal line cross here. It goes up above 0. It just tells you the difference between this line and this line. Okay, so and that's how you could read it. You could also look at that if you're getting somewhat a higher peak and trough, you can kind of see exactly what that difference is. Okay. So, and then to recap, I promised to talk about 3 ways you can look at MACD. One of the things that you can use it as an overbought and oversold indicator. And I'm looking for a highlight to show that on the chart. I'm not seeing a highlight, but if there is a part where it seems like it's gone too far too fast, it will do a highlight on the chart for me. And what I might do is actually just make this, I'm going to make a quick change to the chart where it's always black. So I can see that if that happens. Okay, perfect. That's what I wanted to be able to show you. Right here, you see where it starts painting these bars red. That's telling you something. So I'm going to zoom in on this price activity. Okay. The first way that we talked about is using the MACD as a momentum indicator, which would be for us to look for reversion to the mean opportunities. And what I'm going to do is I'm going to open up our expert commentary. And what we're going to do, I showed you how we can move those from bar to bar before. What I'm going to do is I'm going to move it to this. I'm pointing at my screen like you can see where I'm pointing. I'm going to move it to this bar and just show you what it says. Okay, so right here currently the MACD is bullish. This is a relationship of the price to a signal line. So since it moved into a bullish zone 13 periods ago, it's gone up 13.38%. Okay, it also gives you the range of the price. The second thing that it's looking at is it's looking to help you understand if MACD has entered an overbought, oversold line, which is why it starts to paint these bars red. Okay, and then what it's saying here for you is the MACD is in an overbought range. But be careful. I added the be careful. But prices can continue to move higher for some time. Wait for prices move lower before considering a short position. And I think that's important, especially in the markets where we end up in kind of like these extended bullish trends. We might have, some people would say we just ended one, right? You can look for overbought, oversold indicators, but if you decide to short here, one of the favorite sayings that I have is the market can stay bullish for way longer than you can stay solvent. So even though we are seeing a bearish reading here, we might use that as an opportunity to move up our stop and maybe protect some of the profits that we have. But what we're trying to caution you against is actually wait for some sort of confirmation if you decide to take it as a short signal. Because you'll notice here we started giving that overbought flag from that day. And again, I love this new trendline tool that they made for Metastock. From that day, it still went up another 9% before it even started to go back down. And it didn't even go down that far. Because again, just because something's overbought doesn't mean it's going to return to the mean, although it can happen. Okay, things can stay in a trend for longer than you can stay solvent. So you can use that as a way to kind of maybe an early warning, maybe move up your stop. But again, I wouldn't use it by itself. I'd use it maybe as a confirmation of something else. Okay. All right. The other thing that you can use MACD for is what they call MACD divergence. Okay. And I'm going to only cover this briefly. You'll notice that it does look for divergence for us. But I do want you to know that one of the technicians that I referenced earlier, Alexander Elder, calls MACD divergence the strongest, the most powerful signal in all of technical analysis. And he is a great, he's a great analyst. I was looking for the right adjective. I think that works. Okay, but let's talk a little bit about what MACD divergence is and maybe how you could see that on a chart. And I'm just going to kind of scroll out. We'll kind of take a look at some price activity. I'm looking for, and we may not have it on this chart, but I can show you kind of what we're looking at here. Okay, there's a couple of ingredients that Alex very specifically looks for. Okay, and we don't have many divergence here. I wouldn't really call this one, but it does kind of give you a signal of what's happening. What I'm looking for is a peak in MACD, followed by a cross down below zero, the zero line on the MACD, followed by a peak above MACD. Okay, and that one doesn't actually qualify, so I'm going to actually kind of go out a little bit. Here you had a peak in MACD. You had a cross down below zero. And we'll say we had another peak in MACD right about here. Okay. What I'm going to do is I'm actually going to draw a trend line here between these peaks. Okay. And I'm going to draw a trend line between these peaks. And I'm going to say right now that these are not divergent. Okay. If I look at the general slope for me, this is up. This goes up a little bit. In fact, it goes up 30% on the MACD level over that 161 period. So from this peak to this peak, there is a smaller uptrend, but a significant one nonetheless. During that same time period, we have about a 20% move up over 145 days, but this angle of this line and this angle of this line are both up. So that's not an overbought or a MACD divergence signal. If we looked at this and we had a peak in price that didn't match, I'm going to go ahead and kind of just unlock this trend line so I can move it to where I want. I'm going to have it turn off the snap on it. Okay, go ahead and click OK here. Again, easy to use. What I want to do, like if I wanted to kind of, if I had a MACD that was like this, but actually I'm moving the line that I want to. If I had a price that was going up that wasn't supported by MACD, okay, let me move this down. Let's say it looked like this, where this was pointing down. But the MACD, the price was still going up. That's a divergence. That's what Alexander Elder calls a bearish divergence. In other words, we make a new price in high. We make a new high in price, but MACD doesn't confirm that price. He calls that literally a breaking of the back of the bulls. Would have been nice if this one showed it, because there's a pretty good sell-off, but that isn't the classic pattern you're looking for. You're looking for more something like this and not something like what we showed before. But keep an eye open for that. It's a very, very, well, according to Alex, it's the most powerful signal in all of technical analysis. If we see one on a chart, you'll see it right here. It'll say there have been a divergent signal within the last 5 days. So in this particular case, it's not spotting that one. There isn't one there, but that's what it's looking for. And so those are the 3 ways that you can look at MACD: trend, momentum, and as a divergence. Okay, cool. Victor wants to know if I'll look at the word, at the symbol root. Sure, we can do that. I'll just take a look at it though, quickly, and then we're kind of going to move on. And we can kind of look at how well this performed. The thing that I love about technical analysis is that it's objective. So I didn't say, well, okay, inflation's going to cause everything to go down. No, I mean, you can see that issue went down on the chart starting in right around January. Okay, we would have gotten a sell signal pretty early on during that down movement. Not all of these signals were perfect, but it's objective. Let's take a look at root, and then we'll talk a little bit about how to compare MACD with other signals. And I'm looking at the time, and I got to move actually. So we'll go real quickly. We'll quickly take a root. Okay, let's see. We had a sell signal. There's root. That's how this performs on the chart. So I said as we started, and I'm going to kind of move a little bit quicker, but that's okay. Just I don't want to take anybody else's time. I want to stay within my time. that I started in Inside Sales. And, you know, we've talked about some of the powerful features of Metastock, the hundreds of indicators, thousands of instruments, the ability, like with this expert advisor, to look at many different systems. I believe we have about 90 something built-in experts that you can actually apply. Some of them are signals like this, the candlestick one I mentioned in passing. But one of the things I like about Metastock and technical analysis is the objectivity of this. So if I wanted to look at root and say, hey, how did this look? Well, we would have sold here. Okay, that was good. We started to get overbought warnings, oversold warnings all the way here. We got a buy signal that looks okay. That signal wasn't so good. That signal wasn't so good. This sell signal was pretty good. And we could get a really good idea of how well this methodology works. Okay. With Metastock, we have a tester that'll tell you that number, and you don't have to go in and say, well, I would have sold here and bought here and sold here and bought here. But I also have the ability, as Ed was talking in his class, to test this methodology to see how it works against whatever stocks I'm interested in, whether it's like the S&P 500 or the Dow, or maybe you're interested in optional stocks, you can test it against optional stocks. Maybe you're interested in ETFs or Indian stocks or London stocks. Our system tester is very powerful. It allows us to go in and test trading ideas against as many stocks, up to 5,000 at one time as we want, against all of the methodologies that are put in the program or ones that you may have built. So if I want to understand, you know, I've spent 40 minutes, which is 15 minutes too long, talking about how MACD works on a stock. But if I wanted to understand how it compares with other systems, I'd run a test for it. So let me go ahead and we're going to do this a little bit real quickly, but I'm going to take my time anyway. That's my 15-minute warning if you just heard that. And what we're going to do is we're going to test MACD. We're going to test it against Turtle Trader. We're going to test it against all the other built-in test systems that are with Metastock that we've been adding for the last 30 years. And with this last one, we added another 54 methodologies in addition to updating the entire chart engine and making a lot of other really cool stuff. So right here, we've got the charting. This is a quote monitor. Scanning we'll talk about a lot. I've already talked about scanning. I think it's my favorite feature in Metastock because I use it every day. But right now we're going to play with system testing. Okay, what I've done here is I've made a list of all of the tests in Metastock that I know are included, because even with this built-in, we have a lot of systems that have been added by either us or, you know, because we've installed like the Fulgent add-on or whatever it might be. So I know these 110 are actually included in Metastock, and I've actually specifically excluded any that use optimization, simply because optimization is a subject I could talk about for an hour by itself, and it takes a little bit longer to test. So what we're going to do is we're going to look at HD. We're going to look at MSFT.O because that was the other symbol. And I'm going to look at root, which are the three symbols that we're asked for. Okay, I can do as many symbols as I want. I'm just typing them up here in the instrument list, or I could do like a whole group like the S&P 500 or the ETFs. And again, for time, I'm just going to do a few of these. So we'll also do Google, maybe MAR. Marathon Oil has been moving pretty good this year. I think it's actually MAR. It's the only signal. It's okay if it's not. I'm going to test all the long trades and all the short trades. So if it gets a long signal, it's going to take it. If it gets a short trader, it's going to take it. And about 500 records, which on a daily chart, which is what we're testing right here, you can change it if you want, is about 2 years. It's just under 2 years. Okay. I'm going to do that on daily. For trade options, there's a lot of customizability here that I'm going to skip just for time. But I'm going to start with 10,000 US dollars. Okay, it's going to match the currency. Like, you don't have to worry about the currency. It's the base currency that the stock is reported in, 10,000. What I'm going to do, I'm going to basically change this to trading 50% of the available equity. So when it gets the first trade, it's going to take 50% of whatever equity it has. That means every time it takes an initial trade on a stock, it's going to start with 5 grand. If your account grows to 20 or 30 or 40, it's going to take half of whatever you've got. Okay. There are other options here. You can play with those, but you can also say just buy 50 shares or buy this. But I like to test it with compounding gains. Compounding's powerful in the market, and so I like to test it with that. Here we've got realistic market prices. I'm just going to leave it at that. We're going to go ahead and click on OK. What realistic market prices is, and you notice I started it so I could kind of get the system running. I think I started it. Oh, yeah, okay. Now I've started it. What realistic market prices? Before we had, wasn't Shan? Mike was talking about when do you get the signal? Is it during the day? Is it during the bar? And with the expert advisor, you're going to get the signal as soon as it happens. So, the market is really volatile. This isn't unusual. Sometimes you'll have a bit of a run up in the morning. And if we're looking at that MACD, you might have that MACD buy signal. Okay. And you're like, great, let's buy. And then you come back after lunch. I'm sure this hasn't happened to you, and the market just sold off. And you're like, well, what happened? And that buy signal no longer exists on the chart because that MACD is based on the close. Okay. So what we do with realistic market prices, we wait till the bar is closed. And since we're testing buying that signal, since we can't buy a closed bar, we wait until the open of the next trading bar. So if that's a daily, it would be the open of the next day. If it's an hourly, it'd be the open of the next hour. That's so that we can kind of test realistically. Now, I said earlier when we were kind of having the back and forth between Mike and me, I was like, well, I like to trade based on the last 15 minutes of the bar. So I'll come in, I'll look at all of the stocks that I have, and the results are done, by the way. Let's go ahead. Okay, this is fine. We did have a little bit of an error, and I think I need to look at my installation for Metastock, but that's okay. It's still giving me results, and I'll kind of tell you what it's not. This happened last time I did a system test in this room too, so I'll play with that for the next time. Let me jot it down. In that scenario, though, where I'm buying on the close and selling the close, I'd actually turn off because I want it to be realistic to what I'm doing and have it just execute on the close, and that isn't an option. So you can do that. That's one of the settings. Okay. Now look at the system tester, though, because what we should have is and we're getting a null value instead, is we should have a graph up here that shows us all of the profitable systems and all of the non-profitable systems. And unfortunately, just use your imagination, you have a bunch of green bars here, a bunch of red bars here, like Ed was showing, okay? Down here, though, it gives us the same information. Our best performing system was an expert in Metastock called Trend Analysis Expert. Okay, it's up 45%. It traded 60 times in 2 years. That's 5 times a month. No, 30 trades a year. That's too many for me anyway. So I'm going to skip that one. I'm going to skip 46. 23 would be about a trade every month. You get the idea, though. I'm kind of looking at something that kind of matches how often I want to be trading, not 60 times in 2 years. 23, that's a trade every other month. That might be a little bit better. It didn't get as much money. That actually had a return of 27%. But yeah, I just don't want to trade that much. Actually, I might even go for this moving average crossover. Oh, this one has optimization. I thought I need to take that out. Let's go down to pattern trading. Oh, okay. Let's go down to this rune system. It traded 8 times over the last several years. Over the last 2 years, so about 4 trades a year. It had a 4.2 trades to 4.2 trades as a win-loss ratio and an average performance of about $3. So it gained $3 for every dollar that was lost. Okay, I can go ahead and click on view right here. And again, I'm going to get a couple error messages, but I can see how this, what this is trying to tell us is how this actually performed over the time period. Here, Root was actually the best performing system on a rune. It made 8 trades, 7 winners, 1 loser, 98% gain in terms of our overall profit. So if I was looking for something that I wanted to trade with Root, this would be way better than MACD. Okay. If I click on view, it's going to give us all kinds of information. The report's not showing up. Again, something's going on in here that's kind of funny, but it will give you a detailed report of like the winners, the losers, all that kind of stuff. Wish I could show it to you, but we are also running out of time. So what I'm going to do, though, is we'll go ahead and look at that system en route. And what I want to say is that you should use this as a way to not bypass, but shortcut your education. In other words, like one of the questions I get from a lot of new traders is, okay, you said there's hundreds of indicators, hundreds of systems. How do I know where to start? And my argument would be start by learning what works well. So if we know that the PS or rune system works well on Root, and I want to trade Root, I want to learn what that system is actually entailed, and that kind of stuff. And the easiest way for me to do that is come back in here to the expert advisor. And what I'm going to do is I'm going to go to PS Arun right here. We'll attach that to the chart and go ahead and click on close. And then we can actually visually see, we could see this in the system test, but we can visually see every time it would have taken a sell signal and every time it would have taken a buy signal. I'm going to zoom in here. Okay. And then if I want to know more about the actual system, why it's generating a buy and a sell, I can go into the expert advisor. We can go back into that commentary. So I'm going to go view expert advisor here. I'm going to actually move that commentary data this bar, and it's going to say, okay, you're getting a short signal on a rune. Enter short with a market on close order. It's going to give us some advice. It's going to tell us about the rune indicator. So the rune indicator was created by Tushar Shandy and is a means of identifying an impending trend action or as an impending trading range. The system enters when the two rune indicators are at extremes from each other. This is a signal for trending action. The system exits when the indicator of the entry direction turns to zero strength. So right there, it's telling us it's based on the rune. It's telling us how it's doing it. If I want to learn even more about that, I can go in and I can add the rune. I'm not going to just for time. I can add the indicator to the chart. And one of the things that's really cool about Metastock is we actually have a huge database for our help file. When we printed this out, it was over 600 pages. But in the case I just clicked on the MACD, it's telling me the overview, how to interpret it, the parameters for the MACD, and the interpretation. And actually, when I got ready, I've done this presentation a few times, but when I got ready to show the MACD, I actually used the Metastock help files to make sure that I was giving the proper information and understanding exactly. I used the MACD indicators as well as the expert advisor, so I could kind of explain everything to you. So what I'm saying is the same tools I used when I learned the MACD is the same tools that will be available for you if you're using Metastock. And of course, scanning. So like if we like this rune system, we want to go in and actually run a test or a scan. We could go in and we're probably not, I didn't notice, but we're probably not, if we look at this whole chart, getting a sell signal today. We're not. We got one several days ago. If I wanted to find an opportunity that exists in the market today, I just have that scanner. I can scan whatever stocks I want, whatever markets I want. If I'm interested in ETFs, I can do that. If you're joining us from India, welcome. We have a lot of Indian users that love to use Metastock, and we offer all of those markets. So it's available to you. It's an incredible tool to help you understand what works in the market, how that works, and help you kind of really implement it. Like I said earlier, there's a reason Metastock's been rated #1 in its price category 30 years in a row. Well, not 30, I exaggerate, only 29. And that's because it helps people trade year after year after year. So if you've been using Metastock for a number of years, thank you. I appreciate that. I hope you love it half as much as I do. I absolutely love it, but I use it every day to help me identify those trades, identify what's working, scan the markets. It's a great software program. So in terms of pricing, $250 per month for a real-time version. This includes Metastock real-time. It also includes a product we didn't even talk about called Zenith. And with Zenith, it's an institutional quality newsfeed that basically is literally the same application that a lot of hedge funds and mutual funds and stuff like that, brokers, banks, you name it, use it to keep up to date with the news. They have like 300 reporters in over 3,000 different news bureaus. It's amazing in terms of kind of the work that they put on it. So generally the cost of that particular product alone can be thousands of dollars just by itself. So you get that. You get the retail version of that as well as our Metastock real-time. It's $250 per month, and that's it. Okay. We also have an end-of-day version. Here in the US, it's $69 per month. If you're interested in international markets, it's $59 per month. But that'll include Metastock, which is everything that we've talked about today, as well as all the data that you need to power it for the regions that you're interested in, whether that's here in America, or maybe it's Asia Pac, Asia Pacific, or maybe it's like Europe, Middle East, and Africa. Those are kind of the different regions that we offer. It's going to include Metastock, as well as all of the data you need to run it. Checking the time. I'm going to do okay. Melissa, we'll get to you in time too, I promise. So what we're going to do here, I mentioned it before, is if you buy a month, we're going to give you the second and the third month for free. So let's kind of just think about that. For $69, that's less than $23 a month. I actually think it's exactly $23 a month. But for $23 a month, you can actually try out the software that's been rated #1 for 29 years in a row, just shy of 30 years. Okay. So with that, we'll include Metastock. We'll include the data that you need to run it. If you do real time, it'll be less than $100 a month, right? We're actually going to have somebody, we call this our white glove installation support. We'll set up a 2-hour block of time where we'll have somebody that will give you a call during that 2 hours and just walk you through, answer all questions, make sure you're set up. They'll even show you how to run scans and system tests. It's a one-on-one with one of our support staff. We call it white glove installation support, and people love it. Stephanie started doing it a few years ago with our support team. People love it. We're also going to include some training called Unleash the Power of Metastock with that, which you can go through. It talks about some of our favorite systems like Armo, how to run this test, how to run scanning. All of that stuff is going to be included. You have unlimited access to our support team if you have questions. And like I said, 100% rating, many weeks. They do a great job. So 800-882-3040 to take advantage of that, or metastock.com/sales chat. You can also get a 3-for-1 as part of what we call our Trader Summit Action Pack. That would be an addition, but as a Trader Summit Action Pack, you'll get GoNoGo Complete, the Trender Pro, the Fulgent Wave Trader. All of these are great products. You'll get that training that we put together with Oscar back in November on drawing trend lines and support and resistance and flag patterns. Did a really good job. You'll get 2 years of stocks and commodities, 3 months of learnmetastock.com, and Unleash the Power of Metastock. So the normal cost for all of that separately will be $4,530. Here today at the event, $2,245, almost half off. So give us a call, 800-882-3040, metastock.com/sales chat, or metastock.com/summit deal. Again, you can find out why we've been rated so highly for so long, and give it a go. There is a reason. So I did take my headphones out over here. I'm going to need them now. So they fell on the ground. In any case, let me go ahead and do this. The phone number there again is 800-882-3040, or metastock.com/sales chat to kind of get involved there. So want to say thank you to one of our sponsors. We're sponsored by Stocks and Commodities as well as the CMT Association today. Thank you for the sponsorship. We appreciate that. You can find out more about the CMT Association. Very well reputed. We're happy to be, we're proud of the fact that we're associated and sponsored by CMT. But you can find more about the CMTassociation.org. You can also give them a call, 646-652-3300. So there you go. And again, we just talked about Metastock for an hour, and I'm going to go ahead. And I am only 1 minute late, so we're going to go ahead and introduce our next guest. I believe this is Melissa's 3rd time here. I absolutely love Melissa and the way she likes to look at gaps. It's a very interesting and unique way of looking at charts. I hope you enjoy it as much as I do. But Melissa, I want to welcome you back in here. How are you doing today?
Great. Can you hear me?
You sound great. Yeah. Step 1, we can hear you.
Okay, great. I fixed my sound issue. I think I emailed you while you were talking. Sorry about that. I fixed it.
Oh, awesome. Yeah, we can hear you. You sound good. Okay. Like an angel.
Let's see if we can get my screen. Let me know if you got that.
Yep, I can see short stocks using this system. So everything's coming through. I'm just going to go ahead and get out of the way. Go for it.
Well, welcome everyone. Good to be here today. Beautiful Saturday here in New York City. And as Jeff was saying, I do gaps. So that's pretty much what we're going to talk about today. And it's interesting because on the weekends, if you're an active trader, it's nice to take a break, give your brain a rest from looking at charts. But, you know, it's been a wild couple of days in the market. And really since the beginning of this year, since January, the market has been very volatile. So I'm going to talk today about shorting, which is very advantageous. We will discuss why. But like on Friday, for example, if you shorted the market, you really made bank. Why? The market fell and fell off a cliff on Friday. And we may be down again on Monday. I mean, who knows? This is the type of market where not only do you need to know how to go long, but you also need to know how to short. And for some reason, and I don't know why it is, a lot of people are hesitant about shorting, or they just don't understand how to short. I don't know. And I'm talking retail traders, all of you people that are here right now, I consider retail traders. But the fact is that anybody can short. You can short as a retail trader. You can short as a professional trader. Again, you can set up your account, your trading account to do that. And it's fun to short. And we're going to talk today about why. This is me. If you have questions, you can always call me at 929-3200-GAP. You can email me at melissa@thestockswoosh.com. And you can always go to Twitter, Facebook, YouTube, or Skype and follow me at any one of these places. I appear on television. And actually, about a month ago, I predicted that the market was lower. It took a couple of weeks, but I'm not surprised the fact that we've fallen off. I talked about it actually 3 weeks ago when I was on Cheddar TV. And at that time, we were rallying. And probably nobody believed me. But one of the things that I do is based on technical analysis. And again, you know, Jeff has this whole charting package. I read the charts. I look at the price data. While you can always look at the fundamentals and say, okay, I think this stock is higher because of the fundamentals, or I think this stock is lower because of the fundamentals. The reality is that what counts is right now, what's happening this second, this minute, right now. That's what really counts, because all that matters is for you to make money at this second. I'm trying to open up here to see the questions. How do I do that, Jeff? Do you know? How do I open up the little box to see any questions? I don't know how to do it.
Unmuted.
Typing, but I don't know how to look at them. Oh, okay. Okay. I see it. Now, how do I expand? Undock from panel. Let me see. Oh, there we go. There we go. Okay, very good. I think there's a couple questions there for Jeff. He can answer later. Oh, okay. People are reluctant to short because the market goes up 80 to 85% of the time. I don't know if that's true or not, but I will say that most of the life of the market's in an uptrend. That's true. But we're talking about active trading, day trading. So what does it matter if the market's in an uptrend? It doesn't matter at all. You can short and get in and get out in 1 day, in 5 minutes, in 1 hour. So it doesn't really matter. Again, we're talking about swing trading, options trading, day trading. No one said that you have to be in something for umpteen years. If you're talking about a long-term retirement account, you would want to pick very strong stocks to be long for long-term investing for something like your retirement. But no one should be concerned about shorting the market when they're an active trader. And again, that's what I do, and that's what we're going to talk about here today. So the idea of trading is one goal for you. That's all that you should have every single day when you get up out of bed in the morning. You have one goal when you trade. One, it's to make money. And the whole idea is you can make money going long and short. But what I found with shorting is shorting actually gives me a niche. One of the reasons is one of the very reasons I just explained is that many people do not like to short, don't understand how to short, or those that do don't know how to do it well, okay? But you have one goal, it's to make money. And that is what you should think about, and that is what you should focus on every single day. Now, I plop this in here. I'm not going to go over every single trade we've taken since the beginning of 2022. But since the beginning of 2022, with an advanced trader risk, this is an average risk of about $2,700 per trade. Day trades only, this isn't options. This is where we are year to date, $292,744. It has been a really big year for us. Why? Well, first of all, I have a good system on any given year. But second of all, many of the trades that we've done have been very big trades because we've had a lot of sell-off moves in stocks and particularly the market. So it has been a great year to capitalize on these types of moves. And again, if you don't know how to short, you're missing out. You're missing out on profits. And not only that, you're probably losing in the last few months. 2021 was a bullish year for the market, where the market really basically power trended up all year. So you could have gone long every pullback almost in the market in 2021 and made money. That is not working this year. And by the way, that doesn't work consistently to do even in bullish market times, okay? which again, most of the life of the market, it is in an uptrend. Whether we go and break in a downtrend or not is neither here nor there. I will short stocks that are in uptrends. I will short stocks in uptrends, downtrends, all around the town. And again, it is based on my system, which we're going to talk about here in a little bit. But in order to become successful, you absolutely need a system. That's number one. Whatever you're doing, you have to have a system. What do I mean by a system? You get up in the morning, you say, I'm going to look for this, and I'm going to do this. And it has to be something you can replicate Monday, Tuesday, Wednesday, Thursday, Friday. And not only that, I think you need a niche. Because the reality is, if you don't have that, you're going to be competing against so many other people, millions of people that are trading. And if you never get really, really good at one thing, you're going to have a difficult time making money. Again, trading is not about having a broad-based view of this thing, that thing, and the other. And I don't have time when I get up in the morning to read research reports. And it's earnings season right now. For those of you that are active traders, you know that. If you don't, there are 4 quarterly earnings seasons a year. Stocks report their earnings, and they tend to have big moves in earnings, and they tend to gap. Some gap up, some gap down, some are long, some are short, but I don't read the fundamental reports of every single earnings that come out. I wouldn't have time to do that and make a decision to trade each morning. So it gives me a niche, though, to short because of the fact that many people, like I said, do not know how to do that well. And that is one of the things that we're going to talk about today. But you can make money in the market. People do it all the time. However, not everyone does. Why? Because they don't have a system. And even something that they're doing, they may say, well, this is my system. But the reality is it may not be a system. Like buying pullbacks is not a system. Okay. And I think people think it is, and it isn't. And the thing is that every time you take a trade, you're never making and creating something when you make money. It's not like you're going out and you knit a sweater and then you're selling the sweater out there on the street in Manhattan. No, you're not really make anything. There's always one winner and one loser, and the winner is taking money from the loser. You're taking money from another human being, from another person, could be the guy next door, when you win in a trade. So it's always the idea of being the one that knows what to do, that has the niche, and that is ahead of the game to predict what's going to happen because, before it actually does, okay? I was talking about day trading. I just started talking here. I've been talking for about 6 minutes. So, so that's what you're here for, an hour for me to talk for 1 hour to hear what I have to say. But I will tell you that I can read long-term trends based on gaps as well. Again, we're going to talk today a little bit about options, but even the options that I do are short-term, and the day trades we're going to talk about too. But you can short for long-term as well. There are many stocks that you could have shorted at the hit of 2020 when COVID hit in March of 2020 that you could still be short. There's lots of them. Boeing is actually one of them, and that report's actually in a few days. The cruise lines, other airlines too, I could go on and on. So you can short stocks for long-term if you want to that are against the overall market. And I look at that. What I'm basing that is I'm looking at the overall trend as well. But that is something that where you would invest your money for the long term. That is not something that's going to offer you cash flow. Day trading actively or doing options in and out of options actively gives you cash flow where you are having money. I call it chunking it out, where you're pulling $1,000, $2,000, $5,000, whatever you're pulling out of the market each and every week. And that is something that is advantageous, again, because then you don't have to wait for the trade to move and you don't have to suffer through the swings of something. And that's what's happening right now in the market since the beginning of this year, 2022. People are long stocks and they're suffering through the swings and the wiggles and the jiggles of the volatility. But you need a good system. You need a good system to succeed. And not only that, you have to follow it daily. So what do? My focus, as I was saying, is gaps. That's all I do. Every single trade I make a decision that I take is based on that. And again, my niche is shorting, but I'm looking at the gap. So I look at a chart, and we're going to go over some charts here in a little bit. I look at a chart and I will rate the gap. And I determine if the stock is going to move higher or lower and how I'm going to take it on the day. I prefer to short. I created my system in a bullish market, actually. I created my system back in 2008. It took me about 3 years to figure it out. And the market was very bullish then. So all of these years that I've been trading, for 14 years going on 15, I've been focusing on shorts, and we've been in very bullish market times. In fact, if you bought the market after the election, presidential election in 2016, we've had such a tremendous move since then, it's hard to believe. And even with the sell-off we've had this year, It doesn't even compare to where the market's gone from 2016. Now we're coming up to the midterm elections at the end of 2022. And then, of course, another presidential election in 2024. It'll be interesting to see where the market goes from there, because we're in very different times right now for many, many reasons. But again, if you're someone that wants to actively trade or put your money at work for you, you have to think about what's happening right now today, this second, this minute, between now and 4 o'clock when the market closes, okay? So I focus on one thing, gap. So what is a gap? A gap is the difference between the close and the open. That's it, simple. How many things gap on every day? Almost everything gaps. It's very, very rare that something would close at 32.01 at 4 o'clock Eastern time and open the next day at 32.01. While that just sometimes happens, it's very rare, okay? So most everything has a gap. It's about finding the right gap, or what I call a good gap, something that's predictable, that I can predict the next direction that it's going to go. But really, stocks gap most every single day, including the market. But not every gap is what I said, a good gap, or what I called, according to term, I called it my system, the golden gap. I'm looking for gaps that are predictable, so you can take it in the direction that it's going. How do I do that? I use my rating system. Now let's take a look here at the market. This is, again, a chart of the QQQs just going back to last month. We were talking about when I was on TV and I was talking through the rally. Well, here was the rally. Hard to believe where we are right now compared to where we were just a month ago. So here was the rally up. We dropped off here since the beginning of the year, back down here. March 14th was the low, rallied up. And this took us into the end of March, wiggled and jiggled, and then we fell. And then, of course, we had a big sell-off into the last day, which was Friday. Actually, I don't have the Friday bar in here. I look for gaps based on earnings, based on news, based on sector, based on the market. Stocks gap for many reasons. Earnings season particularly, though, is what I'm saying is a good time to trade because you get a lot of gaps. So you might get up in the morning and you might have 2 or 3 good gaps on a non-earnings day. You might get up in earnings season at 30, okay? Do you see the difference? So again, you can trade as many things as you want to trade. You can do as many trades as you want. I prefer to look at one thing, one pick a day, and then I trade it with size. And I think it makes it a lot easier to focus on that too, because you only need one trade a day in order to make money. Again, what is your job? You have one job, make money. That's it, okay? It's whole the idea about going, you know, and trading all day from 9:30 to 4 o'clock Eastern time. You can get crazy doing that. You can get money back in the afternoon doing that. It's the whole idea. Again, you have one job to make money. If your goal is $1,000 a day, once you hit it, boom, you're done. It's very rare that the market will power trend all day long, or your stock. Now, while that happened on Friday, like I discussed, and actually it happened the day before too, we started out round in the morning on Thursday and then dropped on Thursday, Friday. We just were, you know, negative the whole day. But the fact is that that's rare that you'll be able to get in something to be in it all day from 9:30 to 4. The idea is to get a quick move in and out if you are in something. And again, it's based on the gap, and it's also based on momentum. Now, here was another really good chart here. And this is back from the beginning of the year, January. This had earnings just the other day, April 20th. This is Netflix. Here it was the day before. So let's go over what is a gap. Like I said, a gap is the difference between the close and the open. This is a daily chart. Boom. This is right up here before the earnings. Netflix closed at 4 o'clock Eastern time and then gapped down here, snug as a bug. Right under 250, fell, dropped, fell. Anyways, this is a gap. Again, there are big gaps. There are small gaps. This is a little gap here. Closed here, gap down. It's a little baby gap, but again, this is still a gap too. And if you shorted this, you would have made money as well. Now, we did this, and we're going to talk about this trade later. But anyways, this is just a lot easier, I think, for people to see when you have such a big gap like this. What about this one over here? We did this one too. This was first quarter earnings season for Netflix. It was up here at 4 o'clock. At what price? Hard to believe. This was just January, people. Look what the stock has done. And again, this is the power of trading momentum in the gap. And again, that's what I do. And this was a short. Again, we're shorting. Anyways, this is back here January. This wasn't like 100 years ago. That was January. The stock price was over 500. Look at it now. It's lost more than half its value from January to April. So within 2 earnings, it's dropped and lost more than 50% of its value. And again, you can go into the whys and the things and the this and the that. It's neither here nor there for me. I look at the gap and I'm rating it to determine, okay, what's going to happen here today? Should I short this? Yes, boom, it rates good, do it. You can do it as a short, as a day trade short on margin. You can do it as a put. We did both. Same thing over here. Now, it might have flipped, okay? It might have flipped around. It might have gone long, okay? But it didn't. It was a short, okay? I'm focusing on the daily chart. I'm looking at the gap on the daily chart, whoever asked that. I'd like to take, well, the gap itself is happening in the post and pre-market. That is where I'm making the decisions. Whoever asked that, Ari. I don't show that on here because I like to take it off when I'm trading on the live day. You can keep it on if you want to, but that's where the gap is happening. That's how it's happening in the first place. So good question. It's happening because after 4 o'clock or before 9:30, you have trades that are going off. You have professional traders, institutional traders that are buying and selling stocks. And that is what is creating the gap. We're going to talk about that more a little bit. This was another one here, Facebook. Again, beautiful one. Talk about shorting. I love to short. This was up here back at the end of January. Stock was right over here, over 320. Boom. Gap down here. This was February then. The stock had another tremendously big move down. Open here, fell. Again, you could have done this as a put or a day trade short. And you can see, again, see the gap. All right. We also did this week. This had a big sell-off this week, actually. Nice trade in that this week. I think I have this in this webinar. But we were talking about what's happening in the post and pre-market. Guess what? Again, selling and buying. But these ones here we're talking about in Netflix and Facebook, we're selling. So I'm looking for the footprints of institutional money. When I make a decision what I'm doing with a stock or a gap, if I'm going to go long or short it, I'm looking for big money to come in. I'm looking for big buying or big selling. That's how I'm making the decision whether or not I want to go long or short. And again, I do prefer to short, but I'm following the footprints of institutional money because that's what drives stocks. That's what drives the market. It's big money and momentum, okay? And then the momentum is created by big money. And momentum is how you make money as one individual trader in the market, okay? If you are scalping like 5 pennies, 10 pennies, 8 pennies, you know, you have to take a tremendous amount of size, 50,000 shares or something ridiculous. And it just doesn't make any sense. And that's too risky to trade like that. And we don't trade low float stocks. Everything that we trade, you've heard of these companies, you know what they do. They have huge volume. Facebook, Apple, Netflix, Zoom, all of the things we trade have volume. And we're looking for momentum. We're looking for moves, okay? I don't know what you're talking about a green bar. There are gap ups and gap downs. Today we're talking about gap downs, Vinod. Getting back to momentum. If you have 1,000 shares of the stock, say you have 1,000 shares of the stock, and you short it and it drops $1, boom. Say you short a stock at 230 and it drops to 229. How much are you going to make if you have 1,000 shares? $1,000. If you have 1,000 shares of a stock and you short it and it drops 10 cents, how much will you make? $100. That's not much. That's not much. So again, it's the idea of trying to find stocks that are going to have a big move. A big move. We want momentum. So would you rather make $100 or 1,000? Obviously 1,000. Again, this goes back to the idea where I said the focus. So you don't have to take 10 trades to make $1,000 or 5 trades. You're making $200 a trade. It's the idea that you can do 1 trade and you get it very precisely, which size, and you're in and you're out. So the key to day trading stocks successfully is using a system. But I think that this is true in anything that you do. Even swing trading and long-term trading, either way, you have to have a successful system that you apply. You have the information, you're applying it, and you're using it. And again, this doesn't mean you never have any trades that lose. There will be trades that lose. I take trades that lose. I showed you the stats at the beginning. We have some losers, but we have way more winners than losers. And that's how you get ahead. And that's how you can be successful to do this, whether you want to do it part-time or whether you want to do it full-time as your career, like someone like me, that's up to you. I have people that are trading with me, doing options, that are doing all kinds of things, and they're not full-time trading at all. I have one guy, it's just a great story because he's a truck driver. He's literally delivering packages and doing the options trades. And he does it. He makes it work. So there's people doing all kinds of careers and all kinds of things that want to make money in the market. And right now, because we're in this a period of high inflation, and it's not going away. It is not going away. It's probably going to get worse before it gets better. High inflation, rising interest rates, everyone is looking for a way to make extra money. And you've got to take it upon yourself to do that. And if you're the type of personality where you're an independent person and you have an entrepreneurial spirit, then active trading is something that you might want to think about. And if you're here and you're already doing that, you probably already have those types of feelings where you want to be independent. You don't want to rely on a boss and you want to work for yourself. But for me, every day I get up and I use my system. So number one, you have to trade a system that sets up with a high level of predictability in the directional move. Again, I never go long and short the same thing. Then I will trade a system that works independently of the market and does not need the market with it to work. I just told you I created my system in a bullish market. So I don't need a bearish market in order for my system to work to short stocks. But what will happen if we go into bearish market? And I am not predicting that. I am not predicting that at all. It's a possibility, of course. But the reality is that then there'll be a lot of things to do, even outside of the normal earnings season, which again will be a very fruitful time for us to trade. So let's talk again here about what is a gap. This is the daily chart going back basically a year here, February to February 21 to 2022. You can see all the gaps in the market. Again, let's just look at some of them here. This was back in September. This is the Qs. We were running up, like I said, very bullish last year. Ran up, made a new high. Closed here, gap down, boom. Again, what is a gap? It's a difference between the close and the open. So we closed here, gap down. This was a short, boom. Here's another one over here. Closed here, gap down, fell, boom. Fell, fell, fell. Could have done that as a day trade, could have done that as a swing trade, could have done that as a put. A put is a short, okay? Let's look at some gap ups just to talk about it. Here was a gap up. Closed here, gapped up, rallied. You could have gone long here or done calls as options, took the market to new highs. This was in October. Feels like a long time ago. And then we rallied up here, made a new high. The last new high we made was the week of Thanksgiving and the overall QQQ. So SPY did make a new high at the first week of the year. We have not made a new high in the market since then. This is the longest we've gone without making new highs in the market since I can't even remember when. And so it's very interesting. Like, again, we're in interesting times. And for the people that are actively trading that do not know how to short, you're missing out. You're really missing out. Again, let's take a look at it. What is the gap? Closed here, gap down, fell. Boom. Here's another one here. Closed here, gap down, fell. Boom. Here's another one here. This is the gap. Closed here, gap down, fell. This was money if you were short before it flipped. Okay. I just look at the charts. Everything I do is based on the gap and the gap in the chart. So it's all price action that I'm seeing live in the chart data, which is in live time. So success or failure has everything to do with the quality of your system. So how can you become successful day trading? You need to have a system and a strategy that you can use consistently on a regular basis. And I also think it's important to have a niche. I really, really do. Some of the things that I do that I have a niche in is shorting and gaps. I don't do anything else, but also I'm very, very good at reading the first half hour of the day in the market on a 1 minute chart. So I'm making decisions very fast, very quick. My brain works very quickly. So if you decide and you come and you want to trade with me, I'm calling the trades live in the room. And basically I'm shouting it out as it's happening. Sometimes we get a trade and they happen in 5 minutes and you can be in and out. And we were talking about a dollar move. Sometimes you can make a $3 move in 5 minutes. And then your goal is in for the day or you've surpassed your goal for the day and you're done. I would rather be in fast trades and in and out in 5, 10, 15 minutes than be in trades for 6.5 hours. Your brain gets tired the longer you're staring at a computer. It's better if you can be in and out of things fast. So I like to do things fast. But again, the philosophy, the basis of everything that I'm doing is based off of institutional money. Big traders, hedge funds, banks that are in the market. It's one of the reasons why my bias for the market has been that we would drop and not continue higher, is because I don't see the institutional money buying the market. It's not coming in, it's not buying the market up, it's not supporting it. That's one of the reasons we have not been going long the overall market, okay? This was another one we did. This was the 21st. It continued the 22nd. This was an earnings. This was AA. This, again, is a gap. Again, this big fat red bar here. So again, we got in and out. This actually ended up continuing way past where we got out of it. It fell all day. This was a nice trade. Take it up to the left. This was a 20th. See where this closed? Closed up here well above 85. Boom. Gap down in the morning here. Snug as a bug, right at 80, fell all day. Again, I got in and out of this fast in the morning, but you could have been in this to the close. I don't like to trade all day, but that was a nice short. Again, shorting, selling. This fell. Okay, that was Thursday. Then it continued here on Friday. So again, how can you make money shorting? You make money when the stock price drops. That's what happened here. So this stock AA, boom, fell. It dropped. If you were long, you would have lost money. You have to be short to make money. Again, who can short? Anyone can short as long as you have an account to set up to short. And again, you can buy puts, which is an option, which is basically shorting. All right. So retail traders and professional traders both can short. And again, this is very advantageous. You need to know how to short if you want to be successful in all market conditions, but particularly in this market. So I was talking about options. Now, what's the benefit of doing options? Well, people love options because you can open up an options account at a retail broker with as little as $2,000. So you do not need to have as much money as you would need necessarily to trade on margin. And you only have to pay the cost of the option. For example, if the option costs $1, you will pay $1. You can't lose any more than that dollar. Say you buy one contract, it costs $100, you can't lose any more than that. And so very often the price of the stock will be dependent on exactly as far as what the price of the option is. In other words, an option at Amazon may cost you $50 for one, which is $5,000, but that's still a heck of a lot cheaper than shorting Amazon, for example, at $3,000 a share. So people like to do options because it's cheaper and you can trade them with less money and you have a fixed risk, and you can also trade options overnight. Okay. So the whole idea is that, again, options is another way for you to do it if you don't have a margin account. And the market, the overall market, I say the market, I'm going to talk about the QQQs here today. I also trade the SPY and the diamonds, but we're talking about the Qs here today. This particularly has had many setups from many options in it since the beginning of this year to do. Somebody's asking something. You identify the gap after the fact. Yes, I'm not predicting what the earnings are going to be on Apple. Okay, so Apple has earnings as well. I just talked about BA. It's the 28th. I don't know if BA is going to gap up or gap down. No, I'm not predicting the gap. I'm not privy to that information. No, I wait for the gap. After I see the gap, then I rate it to determine if I'm going to short it or go long it. Okay, does that make sense? So again, you have to wait for the gap to happen. My rating system helps me determine what I'm going to do with it after I see it. I'm not predicting where it's going to go. I mean, sometimes I have an intuition where I'm in a trade, I'm up in a trade, and I decide to hold a trade because I think it's going to continue and gap down again or gap up again. But that has nothing to do with the system. The system is you wait until it gaps, like this Netflix here. But to be honest with you, I was surprised that this had this type of move. Where is it? A second time around. I mean, again, we did this one. This fell out of the sky. Another fall out of the sky one here. So again, you wait. You wait. This could have gone against you. Could have gone up to 500. I rate the gap to determine here to trade it on the live day. Do I want to short it or is it gonna flip? Okay. Hopefully that makes sense and answers that question. We were talking about the market. We were talking about options. Okay, so let's talk about options a little bit. I have an options newsletter. You get the trade, it's emailed to you. I was talking about the truck driver. You get it, you take it. This is just a newsletter. You do the trade. So I called on Tuesday, April 5th, and we'll go back to the market chart in a minute, and I'll show you the gap. The 363 strikes and the keys that expired that Friday. So again, you're in, you're out. You're in, you're out. A put is a short. Okay, let's look at 4-5. 4-5 was here. Okay. So market close here, gap down. Again, we're on the QQQs daily. 363. You see where it fell? Boom. Closed here, gap down, get the drop. Boom, boom, boom. And again, this is momentum. That is a move. It was a huge move. Why? Because I called the trade, fell that day, then it followed through and continued in a gap down the next day as well. This was very reasonably priced, $250 for one. If you bought 30 contracts at advanced trader risk of $7,500, you would have sold it at $1,250. Profit was $30,000 on a $7,500 risk. If you took 3 and were $750, you still could have made a 400% risk. I'm going to go back to the chart in a minute. But this is just one trade, okay? And again, for an options account, you take the position. The position is the max that you can take. You can't lose any more than that. So if this trade would have gone bust, you would have lost the whole amount. And if it works, then you let it ride out. Options, as you know, are tied into what? Direction and timing. And again, we were talking about momentum. Got to get the direction right in options, but you got to get the direction right in every trade that you take. But again, the momentum came here so nicely, so nicely. So here was the 5th of April. It dropped, boom, closed here, gap down, boom. You see this move. And again, this is one, I do not think people should hold options to the last day. If they're up on them, if you're down, that's one thing, but you would have made more money in this. Like, I don't know what it was worth that last day. It was over 400% the last day even. It continued to fall on the last day. And again, I'm not saying you should hold it the last day, but this is one that you actually could have, okay? Well, again, these are the meta stock charts. You can see the gap here. How do you use the charts? You see the gap. This is what I'm doing. You come and learn my class and learn how to rate the gap to determine to short the cues here and here. As far as the charts, they are the resources that help you to be able to see that. You will need charts in order to see the gap at all, okay? So that's how you would utilize it. Jeff can talk about that more when we're done. JPM, then we did this here. Again, this was earnings. Doesn't look like much, but it was a nice trade. This was a day trade. Stock closed here, gap down, boom. Again, closed up here the night before around 131 and changed. Open in the morning down here was around 127-ish or something. And again, we shorted this. Doesn't look like much, but we got in and out quick. So the entry was 127.99. This is a day trade, which you would need margin to take the trade. And if you don't know what a margin account is, you can ask me or email me later or Google it. 4,500 shares was a risk of 27.45, exit at 126.80. Again, we were talking about momentum. So this is a little bit more than $1, $1.20, in and out. You plop on the size and you take it and you're out. Profit was $5,355. Here's the 1 minute. Again, how are you going to use the charts to take the trade? So again, here's a 1 minute chart. Rally, boom, short it, get the drop, in, out, done. And sometimes it's just like that. You might be in something for 3 minutes, 2 minutes, 4 minutes, 5 minutes, that's it. Again, this is not long-term investing when we're day trading. We're trying to make money every day, okay? Now, we did talk about Netflix. This was a beautiful one, April 20th, okay? Here was the daily. Here was the trade that we did. So this is, again, an advanced trader risk. You could take 100 shares, okay? You take what you can afford. These are squished together pretty small, but this is a 1 minute chart. We entered it here, 245.05, got the drop, boom, we were out at 234.55, and this kept going. This actually continued down. Again, I like to do the fast trades, and this was basically more than a $10 move, a huge trade, huge return on investment, huge risk reward, 6,300 profit, doubled your money with what you risked, but it kept going. So we got out at 234 and change in the morning, really fast here. Look where it went. This was crazy. And again, I call it an option in this too. So I think if you want to hold stuff, maybe you do the options. But in this case here, you could have held the day trade down way past where I got out of it. And look where it went. I think it was at 215 or something that low. So this again shows you, go back to the daily, the power of the gap and getting the direction right, because you got to get the direction right. Someone was talking about gaps and this and that and gap fills. Gap fills do not work consistently. While sometimes something goes against it, it doesn't consistently do it. Anything, sometimes something works. Do you understand what I'm saying? It's not the idea about any time. It's the idea about high times, high number of times that something's going to work in your favor. Calculated risk, that you're determining this is a high win ratio. And that's where I think people are having difficulty in 2022, because in 2021, like I said, people were buying every dip in the market and it worked. But that is not something that you can use forever, even in a bullish market, even in a bullish market. Okay, why? Because there's a million supports in the market. They're not all going to hold, even in an uptrend. Verizon, we just did on Friday. Again, take a look at the chart, the daily chart. This is a gap. Again, love to short. We shorted. Got out of in and out of this quick too, but it kept going. Stock closed up here around 55. Boom. Gap down in the morning here was around 53 and change. We did a trade. We got in and out, in and out. But this kept going too. Why? It had the market in its favor. The market fell Friday as well. And we didn't do an option in this, but you could have done an option in this too. So we entered this short. And again, I called the trades live in the room, 53.05. Shares was 4,000. Risk was 3,000. Your risk should be the same in almost every trade you take. So if you're going to risk 2,000, it's 2,000, 2,000, 2,000. Or if it's 1,000, whatever, your risk should be similar. And the day trades, we're only ever in one thing at a time usually. Sometimes two, but that's so rare. Exited at 52.37. Boom. In, out. Again, you're trying to turn it over once. If you risk 3,000, this is close enough. Close enough, but again, this kept going. So we got in it, got the drop, boom, out. And then it continued. I mean, it broke 52. It went down to 51.60 or something. I don't know. So, I mean, we literally could have made almost another dollar out of this, which was crazy. I never go back and look at something to say, I wish I could have made more and I should have made more or anything. Be happy and grateful when you make money. Now, getting back to shorting. That's the topic today, and gaps. Short moves happen fast. Why? Again, I personally like the fact that it happens fast. If someone said you could make $2,000 in 3 hours or $2,000 in 3 minutes, what would you prefer? I'd rather make $2,000 in 3 minutes and have the rest of the day to myself to do whatever I want. So, I mean, I like the fast moves. It suits me. But why does it happen? How can you do it? Because of panic. Selling happens because of panic. Panic is fear. The fear creates the selling, okay? So people are scared and they sell. Sometimes they sell when they're down. Sometimes they sell when they're up, but they're not up as much as they were before, okay? Or specifically before when the market was up at the highs or things were up more. So it's the idea of panic, and that is why it happens so quickly too. Now, how do I make the picks? I go through in the morning and I rate my gaps using a checklist. If you come and decide you want to learn from me, this is what you'll learn. This is the meat and potatoes of what I do. It's a 26-point rating system that tells me that I'm going to do Netflix or not do Netflix, or that I'm going to short it, okay? But it's really the niche of following the institutional money. Gaps are created with large institutional money. That's what makes a gap in the first place. The professional gaps that happen and play out in stocks are formed by one thing and one thing only, large institutional money. That's what drives the market. That's how I've read the market so well to even say on live TV that I know the market's lower, which is very, I mean, that's, you know, it takes chutzpah to do that. And I said it right there. I said it when we were rallying, I said it, because I saw that the institutional money wasn't buying the market. Anyways, you need a way that will help you pick the correct direction to play the gap and then confirm that the large money will flow with it. So you have to look at something and say, I'm predicting at 9 o'clock in the morning, 8:30 in the morning, 8 a.m., whenever you get up, whenever you're seeing the pre-market, whenever you're seeing the data, whenever you're seeing the gap, you're rating it, then you know all ahead of time what you're going to do. I don't trade until the open. I may send options trades out at 7 a.m. in the morning. Okay, like I knew Netflix was going to work when I get up that day. But the fact is we don't take the trades until after the open. But my whole system is really based on common sense because we're looking for institutional money. And again, think about it, the common sense in reference to the idea of shorting. Again, I don't know why people are scared to short that are retail traders, mainly because they understand, they say, okay, buy low, sell high. People get that. You got to get the concept of shorting. And if you don't, that's another reason to come and learn from me. But shorting, it gives me a niche. People get scared. They get scared. They get scared and they sell, okay? And that's how you're going to take advantage of that opportunity. And that's what you're going to do. And again, a put, if you do an option, a put is basically just a short, all right? But some people like to day trade. Some people like to do options. One of the pros of options, like I said, is you do not need as large of an account as you will for day trading. And you can hold overnight to get the overnight moves. So for example, if the market gaps down on Monday morning, and you were in puts that I called on Friday, which I did call puts Friday, you will be up way more than you were at 4 o'clock Friday. So that is the advantage, the overnight move. And you have the insurance is that you have the protection of the risk in that the risk itself isn't any more than you took that you paid. So if you paid $2.50 for an option and you bought one contract, if the market would be if you were in a put, for example, if you took a put on Friday and you're up in the close and you didn't get out and you're like, I think I'm going to hold this. I know it's lower. And then it goes against you. You can't lose any more than $250 if you took one. If we're up at the highs, you can't lose any more than $250. So that's a difference between swing trading and doing options. But you got to get timing right with options. Timing is so important with options. But again, timing is important with everything too, because when you're in a day trade, you have to get out of it before 4 o'clock. Okay. I don't use a scanner. I don't use a scanner. If you want to use a scanner, you can use a scanner yourself. Okay, so overnight moves. So we sort of talked about this one before. We did talk about this one before. So this was a nice trade. Why? Because it followed through in the gap. Again, I called the trade on this day. Closed here, gap down. Called it, trade was up. I thought it would drop and continue. I was right. But thinking isn't knowing. The system told me that this was a good trade to take on this particular day. Whether you hold it a day or 2 or 3, that's up to you. You have to have certain money management principles when you're doing something. For example, if you want to take 4 contracts, get out of 2 into the first drop, hold the other 2. There's another idea. So again, but one of the reasons that trading options as gaps is advantageous is you can capture the overnight moves. And again, you have the fixed risk. It's not like a swing trade, because swing trades is something where you don't have a fixed risk. Something can go against you, say you were short, and again, it would be all the way up here over the highs. You essentially are down an unlimited amount of money. It depends on your size and your position. Okay, so this is a nice way to do it, but you got to get the timing right, and we do the weeklies. Now, what can you expect to earn as far as trades 1-to-1? And I think that even if you take an option, 50% return investment is good. But if I'm taking a day trade, I'm looking for 1. If I'm taking an option, I'm trying to get 1 out of that 2, or 100%. Some trades go more, but I think 50% is normal. And if you can't watch a trade after you buy an option, put a sell order immediately at 50%. It's a day order. It's a limit order. It'll cancel out if it doesn't fill by the end of the day. And you can get up the next day. You'll still be in the trade. It may be up more, or you just put a sell order again at 50%. Okay. So how do you make good choices? This is critical. You have to find quality trades. And I think that with the evolution of Reddit and all the chat rooms out there, I think people, while they love the camaraderie, and there's camaraderie in coming to these types of lectures, like these all-day lectures too, the fact is that you've got to find quality trades. When you're taking ideas from strangers and you don't understand their system or what they're doing, how can you have any conviction behind it and you're still risking your own money? You have to understand what you're doing, and you got to take it seriously if you want to do well. It's the idea of really, really understand what's happening so that you can make good choices. Making good choices is important. And I know that people, when they're trading for a while and they're losing money, what happens is it gets away from them and they start to make worse choices. And then they spiral out of control. Don't do that to yourself. Be honest with yourself and say, I have not been making good choices. I'm going to do better starting Monday, and I'm going to make better choices. And it really is about common sense, good money management. Don't overtrade. Don't be piggy about targets. Know what you're doing. Have a system. All the same things that you've heard a million times before, and things that you know. You've been trading for more than a year. You know these things, but you may not follow them all the time. And again, a lot of it is because people are chasing the money. The money is your goal, but you still have to know why you're doing something. Okay. And money management is important. I discussed having the same risk on every trade. And also using stops is important too. In the live trading room, I'll call the stop. I call the entry and the stop. Okay. You got to put the stop in. Otherwise, something can go against you. You don't even know where it can go against you. Okay. I buy or sell the put. That's it. And again, I'm using my gap rating system to do the option. It's very simple. We're looking for momentum in the options. If I'm buying a put, I think it's going to drop big time. If I'm buying a call, I think it's going to rally big time. Same thing. Okay, we were going long CVX a lot at Chevron. It's an oil stock. I haven't looked at that actually for the last couple of days, but we did a bunch of trades in that were calls, and that's been working this year too. Why? Oil's been running up. Again, I'm not in anything with that right now, but that's what we've done recently as far as the call side. Any other questions here? So again, you have to win more than you lose. Trading is about odds. Put the odds in your favor. How do you do that? Use a system. Take calculated risks. Have a niche. Get good at what you do. When you're doing all kinds of things, you're doing crypto and this thing and futures and day trades and options, you're never going to get good at anything if you're all over the place. Get good at one thing. You add size to it, and that's all you need. That's all you need. You can make a lifelong career out of doing one thing. Trust me, I've done it. And now I'm teaching people how to do it. So you don't need to be all over the place. You're never going to get good at one thing if you're all over the place. And again, we don't really scout. If I'm desperate for a trade and we don't have anything good, I might scout something for 25 cents, but I'm trying to make a buck. I'm trying to make more than that, ideally. But you need an edge in order to get a good return investment or risk reward. And that's my goal every morning. In the pre-market, I'm trying to figure it out. And the edge I've had is focusing on gaps and then really the downside. So I rank the gaps in the morning and I'm making the prediction before the move occurs. I'm talking about on the live day, not the gap itself. I'm rating the gap, so the gap's already there for me to see it, okay? If you know what direction and where stock will go before it goes there, that's how you're going to make a lot of money. So again, we shorted the market before the market in the morning at 9 a.m. on Friday morning. I said, we're going to fall today. It's crazy. People are going long this, but we're going to fall. We're going to fall all day. 100% conviction, 1,000% conviction, no chance of failure. That's exactly what we did. That is just pure talent on my part to be able to make a prediction like that before the market falls like it did all day. And I made that prediction at 9 a.m. before the market opened, before we took a trade. The reality is it comes from experience that I know how to read price action in the gap of doing this now for almost 15 years. When you have experience to do something, you can be aggressive. You can get in the first 5 minutes of the day, which we very often do, and sometimes get in and out in 10 minutes. Now, as far as options, again, I'm holding them for longer. But again, experience, understanding how to do something really goes a long way. And then when the market rallies, like it does, like it did at the end of March, if you happen to be in shorts, or for example, you wouldn't lose conviction or kill trades if it rallied against you. We are going to go over Facebook here. I called this trade. This was just this week. It was an option. It went against it. It was down. It rallied. There were some people that were on the options letter. They haven't done my class yet. They killed the trade with a loss. That was crazy. I tell people not to do it. And that's why you shouldn't risk more than you can afford to lose. It went. Not only did it go, it went huge. I thought this was a good exit here. It kept going and going and going. Again, can't be picky about stuff. This was a huge trade right in here. But the trade first was down. Then it went. Having conviction, which comes from experience and knowing a system and believing in the system, helps you make money. It helps you make a lot of money. And it helps you from not making mistakes. Here was the trade. I called the 205s on the 18th. Again, this little tiny bar. But the trade didn't go right away. In fact, it was down. And the market rallied here too. Then it went boom. And that was there on the 20th. Cost was 225. 40 contracts. Risk is an advanced trader risk of 9,000. Sold at 850. That was the first day it fell. I don't even know what this was the last day. It was probably something stupid like 700% return on investment or whatever. It went to 190. It broke 190. It broke 185. You could have held it all day on Friday. It was crazy. I don't know what the low of the day on this was Friday. And this is, again, I don't tell people to hold trades for the last day necessarily if they're up a lot, which you were in this. This is an exit on that first selling move on the drop in the momentum. And it kept going and going and going and going. This was a sick call. But again, some people messed it up because they get scared. Don't get scared. Take your risk accordingly so you don't have to be scared. If taking one contract means you're going to make money and hold a trade through, do it rather than taking 5 or 10 or outside your risk parameters. So if you did a beginner trader risk of 5, 1125, you would have made 3125. Again, this is a 278% return on investment with an exit this first drop day, but it kept going here. And then when I done it the last day here, it was a ridiculous trade. It was a great call. But I want to point out again how having an understanding of a system and following the system and good money management, which you kept doing the trade. You take more risk you can afford. When the trade goes against you, you get scared and then you'll kill it. And then you not only take the loss, you miss some of the money when the trade goes. Your goal is to make money, not to not lose. And I think that many people that are trading for a long time or they're losing for years and years and years, they're in the mode of trying to not lose. I get up every morning my goal is make money. While I size myself accordingly and I use stops, I'm not like, my goal isn't to not lose. My goal is to make money. If you see yourself as your goal is to not lose, your head is upside down, and you have to straighten it out because all you're focused on then is losing. Losing. You understand? Let me see what the question was. There's only one kind of gap, in my opinion. I know you can name and term a lot of other things. To me, there's only one type of gap. I think somebody's asking something about Metastock, Jeff. Jeff's there. Okay, so again, we're talking.
Listen, I'm just asking a question.
Oh, go ahead.
How to rate them for a continuation trade. So you can, like, it would be fairly easy to do a scan for a gap in Metastock. I think really kind of what it comes down to is how you want to rank them. I think that's really kind of where the class comes in. So finding gaps is easy, but scanning for them is actually pretty easy as well. So Mike, if you need any help with that on the Metastock side, we'd be happy to help you put together a quick gap scan. That's all the input I have.
Okay, yeah. So yeah, so Jeff can help you find them, and then you would come to me to learn how to rate them. I think that answers the question.
Yep, that's exactly what I was trying to say, but you said it so much better than I did.
Thank you. So anyways, correct trade selection is very important. I think it's important in any type of market, bullish or bearish. But we are in a volatile market this year, 2020. I don't think anyone would deny that now at this point. And so knowing that, you really have to be super duper picking. And I'm not saying 100% this. I'm not going to make a prediction 100% this, but I realized a couple of days ago, and I talked about in the trading room, there is a possibility that the market does not make a new high at all this year in 2022 in the Qs. That's a distinct possibility. If we do, we're looking into the late summer, early fall type of part of the year. And that's going to be really difficult for people. While we could, Apple could gap up and have fabulous earnings, and Amazon and Google and Facebook and everything else that doesn't report in, and we could blow it out of the water and rally up in the next 2 weeks. That could happen. That's why I'm not saying 100%. But I'm saying I realized a couple of days ago that, man, there is a possibility. We're so far off the highs right now that we don't get there for months or at all this year. The backdrop of what's happening overseas and everything else that's happening with inflation and rising interest rates, coupled with bad earnings in the financials and some other things too, means it's going to be a struggle for the market to get back up to the highs, a struggle. And again, I'm not saying 100% prediction, but I have a feeling that that's a possibility. And that's going to make it for very difficult trading for individual traders like you people here if you don't know how to short. You're going to have a hard time finding good opportunities to the long side on a lot of days. So you need to understand that, and you need to learn how to short if you don't know how to short. And you should not feel comfortable doing it. It's just a function of learning how to do it, just like you learn how to go long in the first place. But everything for me is rating the gap. I go through the checklist in the morning. The points tell me where the money is flowing, whether in or out, okay? And it matters so that you know what direction to take a position to profit. So again, what do you need to make trading work? Number one is strategy. For me, it's called golden gaps. I do it every single day, okay? Number two, you need a rule, a daily system to follow the rules for the picks. You can't just take whatever all the time. You can't short every gap down, you can't go long every gap up, and you can't do the reverse, okay? And you can't deviate from it. You have to have a set of rules, you have to follow those rules. And then you need a method and a structure to enter the picks. So if I write something, like I said, at 8 a.m. and I know I want to do it, where am I getting in? Where am I getting out? All of these things. This is what I teach in the class, but you have to have a structure for that too. And again, letting things play out, which means not risking too much. So you need monetary goals. This is number 4, day per week per year. I say chunk it out. Sometimes I talk to people, they say, well, what do you think about this? I have this much money in the account. I said, listen, what's your goal? Break it down. You know, one guy I was talking to, he would be happy with $500 a week. It's very realistic. You know, I'm sure he's making more than that now. But the point is, just break it down for yourself. Sometimes people are like, oh, you know, if they've lost money in the last 5 years trading, the idea of making even 100 grand a year seems completely insane to them. It's like $1 million. So, you know, just break it down. You say, I want to make $2,500 a week, $500 a day, whatever it is. Okay. You will get there if you follow some type of structure. You need to follow a structure, but it's really the reliability of the system and sticking with one thing and not deviating from it. It's about calculated risk. Like I said, if you want to take risk for risk's sake, then you're just gambling. Trading is not gambling, and you should not think of it that way. And again, trading has to be something you take seriously if you want to be successful. And I would think that you would want to be successful. Otherwise, what's the point of doing it? If you just want to gamble, then go to Atlantic City, have a good time, go out, stay out late, go to Las Vegas. This is about something you should take serious like a business. Well, you don't have to trade all day for 6.5 hours like a normal job. For the 30 minutes you're trading, if you're sitting at your desk for 30 minutes, you better be on point. Have your coffee, have your breakfast, be focused on what's going on, and have some clear decisions in your head where you're getting in, where you're getting out, and how much are you risking. And again, how much you're risking really has to do with the size of your account. If you have questions about that, you can always ask me. But I say start out slow. Start out slow as a beginner. You have all the time in the world to build it up if you're doing well. And again, we were talking about confidence too, and conviction. If once you build your confidence that you can actually do it, you will risk more over time because you will have the confidence. And I think some people are so inconsistent with their trading, with what they're doing, that they lack the confidence, and confidence is extremely, extremely important. You can trade ETFs. Like I said, we trade the market. We trade the market. So the QQQ is an ETF for the market. And we do the SPY, we do other ETFs too. So yes, ETFs do GAP. As far as options, we're not trying to save pennies. Someone's looking at the difference of the bid and the ask. We're not looking to try to make pennies or save pennies. We're trying to make dollars. So if you pay 25 cents more for something or 30 cents more for something, if it goes $2, who cares? Everybody's going to pay an exact price that's slightly different. Some people pay a little bit more, some people pay a little bit less, some people take it right out of the gate, some people wait till 9:45. It shouldn't matter. If the trade's going to work, Vinod, it's going to work. If the trade's going to lose, it's going to lose. The way that I call them, that's how it is. Because hopefully that makes sense. But again, I teach a class on this once a month. If you want to come and learn my system, you'll learn more in detail what we talked about today, which is really the point structure, how to take the trades, how to get in, how to get out. And again, the whole idea is for you to make money. But it's a 26-point checklist. It measures gaps by rating them in the daily chart, looks for a high probability directional bias for the entire day. Big move in the day, early confirmation of the bias, precise entries with follow through, and a good risk to reward. This is the meat and potatoes of what I do. And again, this is the whole day on Saturday of my class. One system is all you need to make money, and you will learn it in the checklist. So the class is next weekend, April 30th and May 1st, 9 to 5. Tuition is $69.99. Everyone pays the same. That's the price of the class. It's online. If you're interested, you email me at melissa@thestockswoosh.com if you want to sign up. And I am doing an earnings season special because it's a busy time to trade right now. If you sign up by Thursday, it's a deadline to sign up for the class anyways, the 28th. Again, it's Saturday and Sunday Eastern time. Then you would receive the trading room free to the end of 2022 and the options newsletter. That's a huge deal. I'm doing that for an earnings season special for this week. I had a girl that signed up Thursday for the class, was in the room Friday. We did Verizon. She made money. She didn't even do the class yet. So she's thrilled to bits and pieces. So again, if you want to join, you can get in and start trading this week. There's a lot of stuff out this week. It's a busy time to trade. I think giving people the opportunity to do options and the equity trades in the room helps them decide which one they like best, or both. I like both. I like both because I'm not day trading Amazon, but I'll do options in it. And then I also get the overnight moves in the market, which I like as well. I think that's everything. Vinod, I've seen you at a million webinars. I hope one day you join. Thank you so much for having me, Jeff. Thank you, everyone.
You're welcome. We did have one question from YouTube, if I can ask.
Go ahead.
Jay wants to know, will we learn how to do everything by ourselves?
Yes. Yes, you will. The class is 16 hours, and we have 1 hour break each day for lunch. So yes, you will learn how to do everything with yourself. As far as me, you get the support by being in the room after the class, which I think is good for people to start out. But I have people, since I've had the business for 10 years, that are not in my room that have done the class. Many people have done the class, and they're trading on their own. I think the support helps you in the room afterwards, but you will learn how to do everything on your own.
All right. Thank you very much. As always, great job. I really like your gap approach. Thank you for coming in.
you.
Okay, go with this. All right. Thank you, Melissa. All right. Very good. Let me go ahead and do this. Yes. Let me go ahead and make me the presenter real quick. Okay. And I will, as we're kind of getting transitioned into the next part of the class, I do want to remind you about the Metastock Summit Traders Action Pack. Again, that includes GoNoGo Complete, the Trender Pro, the Wave Trader, the Oscar Carboni training, 2 years of Stocks and Commodities magazine, a 3-month premium subscription to learnmetastock.com, and the Unleash the Power of Metastock videos. Normally, all of that would be $4,530. Here at the event today, it is $2,245. So to sign up for that, you can give us a call at 800-882-3040. You can visit us online at metastock.com/summit deal. And you can also join us at metastock.com/sales-chat. So there you go. Well, while we're going to talk about it real quick, I do want to say thank you to Stocks and Commodities for sponsoring our event today. They've been sponsoring the Online Traders Summit for a number of years. We really appreciate it. And you can actually get a free issue if you go to metastock.com/traders-summit. So we are going to take a very quick break to see if we can get in touch with our next speaker. Who's not in yet. So what I'm going to do is I'm going to play a real quick video, and we will be right back.
Hi there, Greg Lewis, Metastock Software. As the marketing director, I get asked all the time, what is Metastock? How can I help my trades? Well, stick around for about 3 minutes and I'll tell you. Metastock is an award-winning software and data package that has been helping traders for over 35 years. Simply put, Metastock is a tool for traders like you to analyze the markets. Metastock helps you take the guesswork out of trading by offering a methodical, systematic approach to some key questions all traders come up against. Questions like,
All right. Looks like we're here. Okay. Let's go ahead and change this back a little bit. Sorry for the small interruption there. And you should be able to see my screen. So what I would like to do is introduce our speaker, who will be a little bit familiar from earlier. His name is Tyler Wood. Tyler, it's good to see you today. Really appreciate your coming in. Tyler runs the CMT Association, and he does a very, very good job with this presentation. So Tyler, can you hear me?
I sure can. Am I coming through clear to you, Jeff?
Oh, like an angel.
It did feel like a small miracle to get on nearly on time. Sorry about that.
No, you're cool. You're cool. I'm glad you made it. I was about to call you. Let me go ahead and change the presentation over to you. You sound great.
That's great. Perfect. Thank you all for staying with us. I may have a familiar sounding voice from earlier this morning, and I know the conference has just been tremendous all day long. So here we are, 3 o'clock Eastern. Let's bring it through the home stretch, huh, Jeff?
You bet. And I'm not pandering to the audience, but they've been amazing.
Excellent. Yes, some great questions earlier this morning. And by way of introduction, my name is Tyler Wood. I'm the managing director for the CMT Association. That stands for Chartered Market Technician. I'm also the co-founder of GoNoGo Charts, and we talked a little bit about that this morning at 10 a.m. If you didn't catch the session, make sure to check out that replay. A lot of really good technical education in there. But what I'm here to do right now is tell you a little bit about this organization, not about myself. Over 50 years on Wall Street. These are the men, women, inventors, and innovators who really help shape the technical analysis that we all know and love today. And I'm going to talk a little bit about how you can improve your own investment decision making and take advantage of some of the educational tools that this beloved nonprofit does. So I started in the classical route of folks of my generation. I got a liberal arts degree. Had a lot of student debt and not a lot of marketable skills, but was able to land a job in publishing and then in consulting. And I had a great boss in the management consulting organization who said, you got to go get your MBA. So I did. I spent even more money and I learned all about the fundamental side of the business. How do you evaluate a company's performance. Focus on the balance sheet. You focus on cash flows and enterprise value. Thinking about corporate actions and some of those corporate finance disciplines was really helpful for me to understand the company. But that's very different from the stock. And I got a re-education when I got to New York City, and I met the folks at what was then called the MTA, or Market Technicians Association. These were the people in the 1950s and 60s that realized that for all of the fundamentalists out there, there was a great body called the CFA Institute that helped organize collegial events, networking, a lot of educational content, and of course the credential, which helps set aside CFA charter holders from other fundamental analysts. Well, the same was needed in the technical community, and that gave birth to the CMT Association. So fast forward, it's a 50-year-old startup, a nonprofit that's really just catching its big wins in terms of growth. So we've got over 55,000 folks from around the world in 137 countries who participate in our educational conferences and events. We obviously administer the CMT program. That credential is for professional asset managers, sell-side research analysts that are at all the bulge bracket banks and research boutiques that you know and love, that you see on CNBC and Bloomberg News all the time. But then we also do a lot of educational activities. We focus on publications, we do webinars, we host conferences, and I'll tell you in just a second about what we're doing next week. But for those of you who aren't aspiring career professionals, maybe the CMT program, that rigorous 3-level exam, maybe that's not for you. But by all means, after this presentation, check out cmtassociation.org, a ton of learning resources, and really just to help us drive on our mission of explaining how responsible technical analysis looks and feels, and how people can use that in their own discipline. I just wanted to highlight in this little introduction that we are doing a whole lot of content, and it's been my great pleasure in 2021 to launch or relaunch the CMT Association's podcast series. David Lundgren, lifetime portfolio manager, Fidelity, Wellington, now at his own hedge fund, but he's my co-host, and we have been shining the light on technicians that you might not otherwise hear from. These are big buy-side managers, financial advisors, individual equity traders and derivatives traders, hedgers for big shops. But we want to show the universality of the technical discipline and hopefully bring some of the lessons that they've learned over multiple cycles to you, the end investors. So make sure to check that out wherever you get your podcasts. Fill the Gap is the official podcast of the CMT Association. We've just been so fortunate to have amazing guests. It's a monthly interview that I really, really love. Another part of what we do, as I mentioned, conferences and events, we do have one coming up next week in Washington, D.C. This is our annual flagship event called the CMT Symposium. It's been happening for 49 years. So for those of you who aren't open yet to traveling and being in person, we're also broadcasting that as a hybrid event. Encourage you, if you like what you're learning today in terms of technical tools that you can put to work, by all means, you got to join us next week, and we'll just continue that learning Thursday and Friday, the 28th and 29th. If you're coming in person, get there on Wednesday. We've got amazing networking and networking opportunities, cocktail hours, dinner parties, Wednesday night, Thursday night, and Friday night. All right, that's enough of an introduction. Here's what we're going to talk about today. First of all, we got to set some groundwork. We got to define what we mean by technical analysis, because there is a lot out in the internet that talks about getting 10,000% gains in the next couple days, or about predicting what's going to happen in the market 3 months from now, or all sorts of things that may mislead you in terms of how these tools are used. We do not forecast what the markets are about to do. Instead, we put probabilities on our side and we react responsibly to what the market is telling us. Second thing that we're going to talk about today is how to improve your decision making. We'll talk about 3 specific tools, and then I'll wrap up and I'll tell you a little bit more about the CMT program, which may be right for you. If you're an aspiring professional, we've got a ton of universities around the country, folks who are entering the financial services industry, and they really want to develop a niche skill set that they can bring to their firm and their clients, and that might be for you as well. So we'll talk a little bit about that at the end. All right, let's dive right in. Talk about how we define technical analysis. And echoing back to that podcast I was just talking about, we spent some time with Robert J. Farrell early on, the first episode actually of Fill the Gap. And he talked about how the term technician, or what Wall Street referred to as technical analysis, and they really misunderstood what it was that we were doing. Edwards and McGee, that's the original text from the 1940s on technical analysis. They talk about the study of the action of the market itself. And Bob Farrell went on to expand on that, and he said, it's macroeconomics, it's odd lots, if you remember that from the 1970s. It's understanding the internal market data that is coming from the exchanges. And as the head of research at Merrill Lynch, he had access to really incredible data. And when we think about technical analysis in the 1940s and 50s and 60s, these are the men and women who were doing this by hand. Pencil and graph paper, they were computing. Any of these indicators that we enjoy today, all the computation was done by hand. Anything that they wanted to plot on their chart was done with a pencil. And I had the great pleasure in the first couple of years that I started working with the MTA over a decade ago. We had all of Ralph Acampura's war room wall charts in our library at the headquarters office in Lower Manhattan in New York City. And Ralph tells the story about the Dow breaking through 10,000 for the first time. It was a very big call on Ralph's part, but he understood the technicals, and it was clearly in a strong uptrend. And when it broke 10,000, he said it literally went through the roof, meaning the graph paper that they had on the wall ended at the ceiling. But as price broke through 10,000, they were charting up on the ceiling. And so you get to understand that from the early days, these folks had their hands on their indicators. They knew how they were computed. They actually felt what the market was doing. And you fast forward to today, I mean, we're lucky. We have 5,000 charts in the palm of our hand at any time. We can look on Metastock and cover the entire universe, click through thousands of charts. We can run scans. We can apply hundreds of indicators to our charts without ever having to pull out a calculator. That is perhaps an advantage for those of us who know, but if you don't spend some time understanding what those indicators are and what you are looking at in terms of the market's message, you really miss out. The second thing that we talk about when defining technical analysis is this concept of supply and demand. And I'm going to take you back to Econ 101 in here in just a minute, but there's been tremendous work. Specific, the folks at Lowry's Research down in Florida have really quantified what it looks like in market tops and market bottoms, what we can see in terms of those supply and demand relationships at an index level, at an individual security, and on down the road. The last thing I want to mention, Perry Kaufman is heavily cited in our curriculum. We've got multiple textbooks for each level of the exam. And he talks about the systematic evaluation of price. You can think about price, volume, momentum, lots of different indicators. But when he talks about systematic or quantifiable and objective views on market data, that's what we want to anchor to as technicians, as technical analysts. We want to be objective in our nature of review. That doesn't mean that algorithmic trading or quants are doing anything totally different from what the basic core discipline of technical analysis was. So you might hear folks from the fundamental side of the business that sort of poo-poo technical analysis. Yeah, that's too subjective. Actually, prices are an estimate, and it's never restated. And what we do is the most quantifiable, objective view on the markets that you can have. So I've had the pleasure of working with our board of directors, and we help define how we view technical analysis as an organization, as the leading global nonprofit credentialing body in technical analysis. We say the technical analysis provides the tools to successfully navigate the gap between intrinsic value and market price across all asset classes. And that's through a disciplined, systematic approach to market behavior and the law of supply and demand. That gap, that's a lot of fancy words, but what we were trying to ascertain was originally explored by Dr. Oswath Damodaran. He's an NYU professor of finance, and this guy lives and breathes discounted cash flow statements. He loves the fundamentals. But in his blog writings, he had this nagging question: why is the market so often overvalued or undervalued our estimates of intrinsic value? Why is the market always wrong? As technicians, we never believe the market is wrong. And so Ralph Acampura asked me if I'm ever talking to an audience about technical analysis, which is something I like to do a lot. He said, use this graphic. And when Ralph taught for 40 years at the New York Institute of Finance, his stock of the day, the mega cap name, was IBM. Today, we're going to talk about Apple. So in the top half of our analysis, we could think about the company. And that company has a PE ratio. They have competitors in the space that might have great products. They have a management team that may be very efficient or very inefficient at allocating capital throughout the firm. For those who are following tech stocks, Apple is holding up pretty well in a very beaten down sector. This company might pay dividends. That's something we want to know from a fundamental side. We might want to see corporate actions on our charts. They've got products. Those are going to generate the future cash flows, which are going to fall into our DCF statements and our intrinsic value estimate. Well, that's the company. That's what I spent all of those years in my MBA program really trying to understand. But if we are trading, we're not buying the whole company. We're buying stock in that company. We're buying shares of that company. And the stock may behave very differently from those underlying fundamentals of the company. If you want a complete view on your investment, you got to understand both. So the technical piece starts with price. We have volume. We have other market internals like open interest that we want to take a look at. We want to understand the supply and demand, not just for this individual security, but for that sector or for equities versus other asset classes. We can do some top-down macro analysis to keep us on the right side of these trades. And then there's the psychology. And I'm gonna skip through because I got here a little late, but there's a fantastic video about crowd behavior that I encourage you all to check out some other time. And what we're saying is that behavioral psychologists have understood now, works of Daniel Kahneman and Amos Tversky, many others who have won Nobel Prizes. They understand that the human brain evolved over tens of thousands of years to keep us safe. We understood that it was better to stay with the group and not get picked off by a saber-toothed tiger. Well, that's all fine and well that the behavioral psychologists have now given this fancy names. Academic research accepts the irrationality of all investors. We as technicians have been looking at this for hundreds of years, since Monohisa Homo was in rice pits in Osaka, Japan in the mid-18th century. And we don't call it herding behavior. We call it price momentum. We call it market trends. And so the language is a little different. The concept is exactly the same. And Tversky and Kahneman understood many heuristics, these mental shortcuts that we all fall victim to in our investments even today, anchoring. And we have these biases that guide us, perhaps in the wrong way, but they create some volatility and sentiment in the market that we as technical analysts can actually use to our advantage to capture great market trends. So let's go back to this supply and demand concept. I'm going to take you back to Econ 101. At a fixed level of supply, the demand curve, an increase in demand is going to increase price up that supply curve, right? Very, very basic concept. And when you think about publicly traded equities or any market where there's liquidity, that price at any moment, that's what is the agreed value. That's the price of each share. And that's where buyers and sellers meet to make transactions. It's no more complicated than that. As technicians, we have to pay attention to price. And oftentimes, it's really separate from the fundamentals. A couple of examples here for you. Did anybody see what was going to happen to AMC? Do we understand why these meme stocks go from $6 to $250 a share? It doesn't make sense, except that the market, the herd, can drive price up way beyond any estimate of intrinsic value. And at this point, the only game in town is technical analysis to understand those price moves. For many of you, that might be where you found success in meme stocks or shorter term trading. God bless you. The volatility here really scares me. And I think for most institutional investors, which is where I spend most of my time, they're not trying to capture these explosive event-driven moves. But you can see that the technical tools work the same way, whether you're trading AMC or GameStop or Bitcoin. None of these are driven by fundamentals. This is price action. And who could say it better than Mark Abraham, who said that ultimately it's the dollar-weighted collective opinion of market participants that determines whether a stock goes up or down. This consensus is revealed by analyzing price. Price is paramount. And for the CMT Association in 2004, there was some new legislation coming out from the SEC, then the NASD, and our board of directors had to step up in front of the SEC lawyers and argue for why technical analysis needed to be recognized in their new regulatory framework. one of the lawyers asked Ralph and David Krell and Barry Sein, he said, on this chart, it's all subjective, right? You guys are just, reading the tea leaves, but what's a fact about any of this? And Ralph said, price is a fact. It's the earnings that are an estimate, and they're often restated. And you don't get that information on a regular basis. It's coming out quarterly. That's so slow. Price, we can look at every single day that the market closes, and even intraday, and it's real, and it's never restated. And so Mark Abraham and many trend followers and many technical analysts have understood that the greatest fundamental investor out there is the market. All of that information, everything we know about what's happening to the corporate balance sheet and what's happening with new product releases and what's happening if Elon's taking over Twitter, that all gets distilled down and shows up in price. It's a supply and demand game. So thank you for sticking with me. Hopefully this is sounding familiar. If you guys are Metastock users, you know the power of charts and price and data visualization. So the three things that we want to talk about in terms of improving your investment decisions are going to be relative strength, breadth, and divergence. Now, there's many, many, many other concepts that are core, that are pillars of the technical discipline. We're just going to talk about these three today in the interest of time, but hopefully some of this will help you in your own trading decisions. So let's get started with relative strength. Martin Pring, a dear friend and a frequently referenced author in our curriculum, says that the technical concept that measures the relationship between two securities, that's relative strength, one security divided by the other, can be used to better understand an intermarket relationship, right? Technical analysis can be very comparative. Now, let's just take a look at an example from last year. We've got in the top line S&P growth, the bottom S&P value. Now, growth and value both moving up after the pandemic crash in 2020. I'm going to give you a little laser pointer so you can follow along with me, right? Both knocked off their skis, but rallying together. Now, if we wanted to decide whether we should be allocating to growth equities or value equities at any time during 2021 and even now in 2022, we might want to compare which one is rising faster. So we can divide one security by the other, and that's this red line at the bottom. That's the relative strength concept. So when you look at this, growth is outperforming value as we get into the pandemic crash, really accelerates through 2020, right? Growth equities, tech stocks, the stay-at-home trade, everybody's buying Zoom, they're buying Peloton, they're buying Apple, Microsoft, Facebook, Netflix, right? Nobody's going to the movies. That's what drives this relative performance. Growth equities are outperforming value equities. And then we jump ahead here in 2021, we can see in February and again in late April, we've got a real overpowering of value above growth. Now that happens to coincide with interest rate rises during 2021. And of course, if anybody's been paying attention here in the first quarter of this year, the rising rate environment, inflation coming in at record-breaking levels, haven't seen this since 1980. Now those growth equities have become very unpopular. They're stretched multiples, what investors were looking for in terms of long-term yield from growth equities. That's no longer the game. They're getting defensive, and they're looking to value sectors like industrials, like energy and financials even. That's when we see the value outperform growth. That's the concept of relative strength. Now, in your own portfolio, you might have 10 securities that you're looking at, and you might be trying to beat a benchmark. A lot of the institutional portfolio managers, they care about their absolute return that they're bringing to clients, but what they are measured against is a benchmark. So XYZ mutual fund needs to outperform the S&P 500 in order to keep clients happy and justify those management fees. So they're looking at relative performance all the time. Now, the only way to beat a benchmark is to own the things that are beating a benchmark. So they might look at Apple versus the S&P. They might look at Tesla versus the S&P, or at John Deere versus the S&P. They're looking at those things on a relative basis. You could also use this and apply it to the sectors of the S&P 500. So simple 11 ETFs that show you REITs, utilities, industrials, builders, and compare them all to the benchmark, selecting those sectors that have strong relative strength performance. That's the analysis that technicals can give you. You can compare across the asset classes or across the sectors. For many folks, as they're getting defensive, thinking about this inflationary environment, they might have been looking at gold. Well, an absolute trend in gold, that's one thing, but do you want to own gold when it's not going up as fast as perhaps some other equities, right? Do you want to keep any bonds in your portfolio when they are just selling off really, they have the glide path of a brick? That relative performance is going to tell you a lot. All right, breadth. This is our next big topic to cover before I move on. We're going to measure the imbalance between advancing and declining stocks. This is coming from Perry Kaufman, one of the authors in the curriculum. Perry says that a net increase in the index, while more issues are declining, should generate concern than the upwards move is poorly supported. So let me break that down or paraphrase. What we're talking about is bench strength, right? You're sending a team into the championship game. Do you have 2-star players, or do you have an incredible team that works really well together and everybody on that bench can perform their duties really, really well? They're all top athletes. Well, that's what we want to understand about the market. And these are market internals. Folks like Walter Deemer and Bob Farrell and many others have done incredible work around the advanced decline line and other measures of breadth. And what we want to see in a market rally is that there's more participation. Does it get all the way down to the small cap equities? Is everybody participating in the rally? Is the economy broadly expanding? Or is the index being supported by just a few names? And I know Jeff and I could probably talk all day long about the construction of each of these indices and why is it cap weighted in the S&P. There's a lot to explore there. But the central idea is it a stock market, right? When we're looking at the index, is that just a single name? Or is it a market of stocks? Do we see broad participation? So again, we're just going to look back at, as a case study, that crash in 2020, the coronavirus, the pandemic hitting the headline news before the market tumbled. But let's look here at the price chart, S&P 500, weekly, this is small cap. IWM is the ETF. We're looking at small caps going into that COVID crash. And here is our advanced decline line. We see more and more of the small cap equities participating in this rally at the end of 2019 and then into 2020, before price drops off the cliff, right? These are weekly candles. We see a massive deterioration in breadth. That is a signal from the market before we see anything in price. It's a leading indicator. It's either confirming or diverging from what we're seeing in price when we see that there is less participation in the rally as it makes a new high. We've got fewer names participating in that upward move. The market knows even before massive price moves whether or not the economy is still expanding or if we are contracting. Now, again, at the bottom in this COVID crash, nobody knew if it was just going down 35%. Was it going 50%? Are we going to lose 90%? Is it time to buy, bunkers and canned corn? Is this the end of the world, as we all thought in 2008? When we see those breadth thrusts, that improvement and more participation to the upside, we can take confidence in the fact that these price gains are sustainable. And we continue to see broader participation, expanding AD line as more and more of those small cap equities participated in the upside rally. And this, of course, we all know how this played out as the IWM crashed here at the end of 2021 and through 2022. We've had a real tough time getting broad-based participation from small cap equities. But breadth as a concept, if I can leave you with something today, it's to look at those market internals to understand the context of a market rally, because that COVID rally was really led by just a few names. It's a cap-weighted index in the S&P 500, and so you saw a lot of participation in names like Tesla, Facebook, Google, Amazon, Netflix, and so on, but not a lot of broad participation from the smaller cap equities. All right, third and last big concept that I want to leave you with today is the idea of divergence analysis. So we've talked about how we can see the marketplace, right? What market internals are going to tell us in terms of leading indicators or comparative studies. Let's talk about how you might manage an individual trade and trade risk. So divergence analysis, indicators, calculations made from price, volume, breadth, etc., are used to identify important market action and to help separate signal from noise. Again, as Ralph told me and Mark Abraham told us, price is our most important indicator, but we can use all of these others to confirm whether or not what we're seeing in price is really durable. The weight of the evidence is the approach we want to use. We want to have as much evidence that that a rally or a trend is in place, and we want to look to those divergences on the negative side to get out of trends as soon as we possibly can. So the technician is going to ask, does the indicator confirm that price action? I want to take you back just real quick to a couple slides that we covered this morning when we were talking about GoNoGo charts, just that concept of momentum. So if you're familiar with something like the RSI indicator from Wells Wilder, you know that what they were trying to understand in the 1970s, when it was a real range-bound market, was whether or not momentum was overbought or oversold, right? And we could use those signals to identify tops and bottoms within that range. So when we think about momentum, we want to think about the rate of change of price. And it helps us understand the nature of the price move. So these are some rally cars off the line. They're going to accelerate at the same rate, 10 miles per hour to 20 miles per hour to 30 miles per hour to 40 miles per hour. And then as we peak out, we're going to continue to accelerate, but accelerate more slowly, 45, 48, maybe get to 50 miles an hour. And if you think about entering a highway, right, you get to your max speed and you slow down, you slow the rate of acceleration as you're merging onto the highway. Now, right here, momentum, right, still getting faster as the price move is going up, but momentum will wane even as price continues to make new highs. This is the number of buyers and sellers. That's what we're looking at when we look at an RSI. So let's bring this to a metastock price chart. Okay, we're right up here making new highs in price, higher highs at each level. And every time we make those new highs in price, we're seeing a lower high in the RSI, which means fewer buyers want to participate in this uptrend as price reaches new levels. Think about that. That's the psychology of the markets taking hold. The number of investors willing to buy at higher and higher prices decelerates as we get to this penultimate high. That is a bearish divergence from an uptrend. We're seeing the price, but we're not seeing it confirmed with volume. That's a leading indicator that tells us the price action may not be able to sustain these highs. Do we know that it's going all the way back down? Not at all. But we could perhaps see some price consolidation. In this case, we did see a pretty large decline. Same thing in reverse. We can see a bullish divergence. As price makes a new low, the oscillator does not confirm. Here we have negative momentum, oversold conditions. Now, the number of sellers willing to participate at these lower levels dries up, and we see momentum come back in the positive direction and trend continue in the other direction. Now, when I first joined the CMT Association, Ralph Hackenpora was explaining overbought and oversold. And he said, you know, a lot of young technicians get it wrong. They see overbought and they think, all right, time to sell. They see oversold, great, time to buy. He said, just because a momentum oscillator reaches oversold doesn't mean that it's suddenly bullish, that it's going to mean revert immediately. He said, think about if you had a beach ball and you're in the water and you submerge that beach ball and then it just stays there. First of all, you'd ask, where the hell did you get that beach ball? What's wrong with your beach ball? But more importantly, it doesn't always snap back. And when it doesn't snap back, that means that something's really wrong. We also know to the upside, something can become overbought and stay there for prolonged periods as a trend, you know, gathers more and more momentum. More and more investors pile into that trade. Again, think about that herding behavior. We're all piling into the same trade because we see it working so well. That's I guess my forewarning, the caveat to technical indicators. The math is very, very objective, but you have to understand what that calculation is telling you. You can't automatically react as soon as you see an overbought or an oversold. You need to really understand what the indicator is telling you and be a more patient investor. All right. So technical analysis, right? It all comes down to the trend, identifying participating in, and then identifying when that trend comes to an end. We want to capture the meat of the move. And John Henry talks about pulling your emotions out of the business, right? You want to look at what's actually happening, actually be able to quantify what you're seeing in price, and not be driven by all of these market narratives. If you're like me, I do have a TV. I sometimes read the newspaper, and the shocking headlines that come out all the time. Let's just talk about Twitter for a second, right? Elon Musk buys 9.3% of the company. That's a huge demand increase at a fixed level of supply, drove the price up, gapped up. And then what happened over the next week was a ton of narrative nonsense about whether he was going to take a seat on the board, what Jack and the rest of the board members at Twitter were thinking about. Is Elon going to be a bellwether for Twitter? Is this going to bring us into the new generation? Maybe it's great for price for Twitter. I don't know whether Elon's involvement in Twitter is a good thing or a bad thing. I don't have time to do that analysis or to really have the interest in estimating or thinking what my belief is about his involvement and how that's going to affect price. So instead, I want to quantify what's happening with the price of shares of Twitter, and I want to react responsibly. It's like carrying an umbrella on a gray day. I don't know if it's going to rain, but I want to be protected. And if the sun's going to come out for Twitter and it's going to take off, great. We want to participate in that trend, but we want to stay away from those emotional narratives because it can get in our way. I talked a little bit about this expectancy formula this morning when I was presenting with my partner, Alex, but really what we're talking about in terms of emotions getting in the way of our trading is that for all investors, we are liable to recognize our winning trades too soon, to lock in those profits, and we're liable to hold on to our losers much, much, much too long, right? I've committed these same sins myself. You have a trade, you put that on, it doesn't work, and then you start playing the psychological game. Well, no, this was an investment. I have a very strong conviction this is going to come back in my favor. I want to hold on to it. And this is the behavioral game that a lot of investors play. They don't sell until they get back to break even. That's actually what creates supply and demand. That's what creates levels of support and resistance, which we're going to talk about in another session. Hope to be back here with you on a future summit. But when we're talking about the expectancy formula, just look at this curve right here. These are all of the profitable strategies. Anything to the right and above this line is going to be a profitable trading strategy. Well, what makes a profitable trading strategy? It's the percentage of winners multiplied by your profit ratio. So what really shocked me when I got involved in public markets and worked with some traders and portfolio managers is that they shared the very best analysis, the very best strategic edge that they could come up with might work 60 to 65% of the time. They know they're going to be wrong. And in a recent podcast with JC Peretz, he said he grew up playing baseball in college, and he said, you're going to strike out most of the time. Professional MLB players, a batting average of 300, you're going to the Hall of Fame, which means 70% of the time you're going to swing and miss. But that's okay, as long as when you make contact, when you find that winning trade, you really let the profits run, right? It's a home run. You're getting people on base, RBIs, you name it. And so we could be wrong 80% of the time, but as long as our winning trades are 4 times larger than our losing trades, we're still profitable. So if you can increase the percentage of winners and be a patient enough investor to hold on to those winning trades, then you've got a really profitable system over time. And that's, if there's one thing you can take away from today, it's that you have to be disciplined in your approach, finding the tools that work for you, being objective, but then sticking with those rules. Market's not always going to be kind. There are going to be periods where we're really chopped around, where markets are very uncertain. Maybe that's a time where you place fewer trades or smaller positions on your trades until you find trending markets that are really going to work for your trading system. All right, that's enough lecture on the expectancy formula. I want to talk about the importance of routine. And David Keller, who was the president of the CMT Association when I first got involved over a decade ago, he was also the director of research at Fidelity Investments in Boston, and he was also learning to fly a plane. So I got to hear Dave talk a lot about the parallels between investing and flying a plane. He said, You spend all this time on the tarmac with the flight instructor going through these checklists before you ever get up into the air. Because when you're in the little tin can and you're 15,000 feet up and the flight instructor just kills the engine, he said, it's a gut-wrenching feeling. The nose, the plane nose is down and you panic. You can't help yourself but start thinking about how fast that ground is going to come up and hit your plane. Said it could be something really simple. Maybe your knee just knocked the fuel shutoff valve, right? But if you don't have that checklist and you can't maintain mental focus to check off the simple things that may have caused that plane engine to cut out, you would miss the opportunity to correct. Same thing from a technical side. A technical checklist might include trend lines and moving averages, areas of support and resistance. You might look at volume and other confirmatory indicators. You might look at momentum analysis to look to see whether more participants are in this trade to the upside or to the downside. That technical checklist is critically important. Find the tools that work for you and stick with them. All of the best investors that I know, we all have a personal opinion about what might be happening with geopolitical conflicts, but when it comes to our portfolio, we're just going to look at what's happening in the marketplace, right? We're not going to let our own emotions drive our decision making. Okay. The problem with having a great checklist and with technical indicators, and many of you may have built a chart just like this. I know I have. And if you're working on Metastock, you've got an incredible list of indicators to add to your charts. I just want to encourage all of you to keep things simple, because the more you put on the chart, searching for that silver bullet indicator, the more likely you are to distract yourself, to fall into the trap of analysis paralysis, never be able to pull the trigger on a winning trade or to exit a losing trade because you were too caught up in all of the moving parts on your chart. Keeping it simple is critically important. All right, we got to go back to the OG, the first technical analyst of the United States of America, Mr. Charles H. Dow. Many of you know him as the founder of the Wall Street Journal, the developer of the Dow Jones indices. And those averages discount everything. All what Charles Dow told us was that all of the available information shows up in price. He also understood that price trends move over multiple periods. Now, Charles Dow was a nautical guy. He compared the stock market to the high seas, and he said that the primary trend was like the tides of the ocean, meaning it doesn't change. There's no amount of news flash that's going to move the primary trend. Instead, it's driven by gross domestic product, macroeconomic events, and the underlying fundamentals of the companies that we are investing in, right? If the primary trend of the market is up, we know that we want to trade in the direction of that underlying bias of the market. And that's what all of the institutional folks are trying to figure out first. What regime are we in? Are we in an expanding economy, or are we in a recession? The second time period, the secondary trend, as Charles Dow referred to it, is going to move above and below that primary trend. And here's where we get into the idea of mean reversion. And a lot of technical analysis tools are going to help you stay profitable. Knowing that the upward bias is here, we can take an entry at the lows of the secondary trend, or a lower time period, and capture those until we're well above or accelerated beyond where the primary trend is at. And then we look for that mean reversion. And the minor trend, or that third period, he's compared to the ripples on the surface of the water. This is the intraday motions. These are the reactions to news that's coming out, or to an earnings report, or to Elon's latest tweet in the case of Twitter. That's another area where technical analysis adds tremendous value, because it's all sentiment driven. But that volatility is also very hard to manage, and those trends are very short-lived. So if you're looking at 5-minute charts, this is your time period. But you might also want to expand out to an hourly and a daily chart to get an idea of the general direction, the underlying bias of the market. And a daily chart for long-only mutual fund managers is maybe the shortest period they would ever look at. But for a very short-term intraday trader, that's your primary trend. Okay, markets and all technical tools are going to work the same over any time period, and we want to be aware of what those multiple time periods are telling us. All right, folks, we're coming in here to the home stretch. Thank you for staying with me. In this last section, I want to talk to you a little bit about the CMT program itself. What does that credential mean? And whether or not you are going to go home and spend the next couple of years studying for and earning this credential, taking all 3 of those exams, or if you're just looking to employ a financial advisor, or you're looking at who you might trust in the FinTwit space in terms of their analysis, you might want to look for that CMT charter. All right, let's talk a little bit about what it is not. Investopedia defines quantitative analysis as using complex mathematical and statistical modeling, measurement and research that aligns a numerical value to the variables to replicate reality mathematically. Wow, what a mouthful. Now, in my time at the CMT Association, we have transformed the curriculum tremendously. What is tested in the CMT program includes a lot of quantitative methodologies. But the point I want to make here is that whether you're talking to somebody that believes in quant finance and doesn't believe in technicals, or runs an algorithmic trading shop but doesn't, use technicals, they're lying to you. They're one and the same. An algorithmic trade is simply a step-by-step procedure to solve logical and mathematical problems. And whether or not you actually trade through a black box and you're systematic in your approach, or you're discretionary and you place each of your trades, you can still be rules-based. You can still be disciplined to follow your rules when you're trading, and that's the big piece I want you to know about. For the CMT program, you're going to learn a lot of quantitative methods. We're not trying to teach people how to code. Coding languages change faster than the weather does up here in upstate New York. But what you will study in the CMT program are these core concepts in risk management, both for an individual trade and for a whole portfolio. We are going to talk about quantitative systems. So how do you back test your strategy? How do you quantify the strength of a technical signal? We're going to talk all about portfolio management, things like portfolio construction, asset allocation, position sizing. If you're running your retirement account, do you want a 60-40 equities to bonds? Maybe you need to be thinking about having some commodities. Are all of your equity investments in the United States, or do you have a global coverage? These are the things we want to think about in terms of shaping our portfolio and running that to our best advantage. And then, of course, I've been talking all day about the behavioral scientists, the behavioral psychologists that have helped label some of these things technicians have known about, observed, and profited from for years. We're going to talk a little bit about how you apply those behavioral finance concepts, both as you're analyzing the market environment, but also as a trading psychology lesson in how we can control our own biases and recognize them before they get us in trouble. So this is a global credential, recognized as the preeminent designation for practitioners of technical analysis. As I mentioned, there are 3 levels of the exam, and they're only offered twice a year, once in June and once in December. Candidates have to take them in succession. So you got to pass level 1 before you sit for level 2 and level 3. And you can only take 1 exam per administration. I have talked to so many overachieving millennials who say, well, I want to do 2 or 3, all 3 exams in June. Let me tell you that studying for these exams is a real labor of love, and it takes a lot of time, and you would not be well served to do both in the same period. All right, that's the CMT program. We've got June 2nd through the 12th coming up here. That's the next opportunity you have to sit for the exams. And then December will be our fall cycle. Now, before you even think about cracking a textbook and spending your nights and weekends studying for these exams, you might want to ask, well, what is the value of a credential like CMT? Well, for a number of people, in survey responses and talking to our members and our charter holders, they've obviously seen value in a really refined approach to studying a broad number of topics within technical analysis. We know that it provides differentiated value. Not everyone in the financial services industry has a CMT charter, but we also know that it's a very complementary tool set. As we talked about with that chart of Apple, a lot of fundamental instruction happening in business schools around the world. But if you can also understand what drives price, the sentiment, the psychology, and the supply and demand, you have a real advantage over your peers. But to get specific, our marketing team put together this great infographic in terms of the actual outcomes for people who earn the CMT charter. Within 1 year of them being granted their charter, over 40% were promoted, over 50 had new positions in new firms, and this is the one that really catches my eye. More than half of our new charter holders had reported more responsibility a year after earning their charter. And more responsibility means more assets under management. For anybody who is running a fund or trading strategy and they want to think about bringing in outside investors, or if you're already running a hedge fund and you're thinking about raising more capital, you absolutely have to prove to your clients, to your firm, that you have a responsible risk management practice, you have a consistent, repeatable process for capturing alpha, generating those returns. And the CMT clearly demonstrates that trustworthiness and that identifiable skill set, because candidates who have mastered the body of knowledge in the CMT program go on to make better investment decisions. All right. What do I do with a CMT? Well, you know, if I get a CMT, what job do I get? Well, that's a great question that a lot of university students have asked me. And the truth is, this pie chart should show you there's no one path for a CMT. There are a lot of sell-side brokerage firms, research boutiques that employ CMTs as their chief strategists, their technicians. We've got a lot of folks who are algorithmic trading developers that create those strategies and sell them off to hedge funds. Got a lot of financial advisors or registered investment advisors, as well as long-only mutual funds, hedge funds, long-short equity players, commercial hedgers, you name it. Whether you are working on an intraday period or a multi-year time frame as an asset allocator for a large pension or sovereign wealth fund, CMT charter holders are going to be in those positions, and they're going to be generating alpha for their clients. Couple quick housekeeping as we're coming into the final minutes. We've made a lot of changes to the CMT program. For those of you who've seen me present before, there are a lot of things that are new. We have simplified the membership requirements. You do not need to be a member of the organization in order to register and sit for those exams. You do not need a degree in finance to sit for the exams. In fact, a lot of folks are still in their undergrad when they begin level 1. We have a lot of professors teaching a bit of the CMT curriculum, and those students are trying to master level 1 before they even get to the job market. So you can sit for all 3 levels, and before you earn the charter, you will need to meet a professional experience requirement, but passing the exams is a great way to land your first job on Wall Street or Bay Street or Dalal Street or wherever you are in the world. We have consolidated the curriculum into a single textbook at each level. And then I want to talk a little bit just about remote proctoring. Turns out the pandemic affected everybody in the world, including our nonprofit. And those test centers that we administer the exam, we work with Prometric, and they're physical locations all over the world, every major city you can think of. But they were all shut down in 2020. And we worked very quickly over those 6 months at the start of the pandemic to figure out a way in which we could remotely proctor the exam. So this is something that we're going to stick with even after the pandemic becomes endemic and everything reopens for good. We're going to continue to offer remote proctoring. And what that means is that you can sit for the exam from the comfort of your home or your office. You don't have to take time off of work or travel to a test center if that is your choice. And there's a lot more details about that at cmtassociation.org in terms of the requirements for setting up your home system. They are proctored by a physical person on the other side of your screen. There's a lot of requirements for a completely stripped down area, no notes, no books. They take security very seriously, because whether you're in Wichita, Wabasha, or elsewhere in the world, we want the exam environment to be exactly the same. We talked about that curriculum. I've got some good friends over at John Wiley and Sons, and for those of you who are considering, maybe start by just picking up the book and see if these are the topics that you want to learn. And they wanted to offer a 30% discount for everybody who is interested in the curriculum and their other offerings. You can just enter that code CMT TW30 to take 30% off of your materials. We have talked a lot about that complementary nature. If you are familiar with the letters CFA, the fundamental side of the business, we've got a tremendous growth in terms of dual charter holders. And folks who are CFAs can start at level 2 of the CMT program. That's right, there's an exemption on the exam for level 1. After a careful curriculum mapping, we realized that a lot of the same subject matter was covered within the CFA program. And so we're going to let them start at level 2. Of course, you are always still responsible for all the information covered in level 1. And you don't have to take my word for it. There's a lot of dual charter holders, a lot of big portfolio managers and investment asset allocators that have both designations. And they've talked a lot about that right on our website or our YouTube channel. You can learn a little more about that CFA waiver and hear from the folks who have been in this for multiple market cycles. All right. This is a technical analysis presentation, and what better way to explain what's happening in the CMT Association than with a chart. Looks like a breakout to me. Up and to the right, demand for the CMT program has gone through the roof. We've been expanding about 20% year over year on a 5-year adjusted basis. We've been seeing more and more growth across the globe, throughout the Asia Pacific region and in Latin America, as well as Europe and Eastern Europe as well. So in terms of the global network that you'd be a part of as a charter holder, really can't overstate just how powerful that network is. And getting in early on a trend, we know is the best way to capitalize on those gains. So in conclusion, you can enroll in the program before you even become a member. You schedule your exam, the individual 1, 2, or 3 third level. You schedule that with Prometric test centers or from the comfort of your home, and then successfully pass all 3 levels to become a CMT charter holder. Registration is closing May 15th, so if you are interested, shoot me an email, tyler@cmtassociation.org, and we'll take $100 off your registration. I really appreciate everybody at Metastock. Jeff, Kelly, thank you guys so much for having the CMT Association be a part of these educational summits. It's really the core of the mission of what the CMT does, to share education, to help people with collegial discourse, what's working, what's not working, and to refine that discipline and hopefully share it with the rest of the industry. So that brings me to the end of any prepared remarks. Are there any questions that you'd like me to go over, Jeff?
Not any questions. Jim had a comment about, he wanted to know if you had overachieving millennials. He seemed to think that might be a contradiction in terms.
Overachieving millennials might be a contradiction. Well, I myself just missed the cusp, and hardworking boomers and all of us older generation often don't understand exactly where the millennials are coming from. But from what I've observed, and I travel all the time, talking to university students, to local CFA societies, other investment firms about the value of the CMT, those youngsters, they're often getting 1, 2, 3 financial designations. They're double majoring in college. Anybody who watched their parents go through the great financial crisis is very serious about what they want to do with their career and make sure that they have financial security for themselves and for their families. So that's where I got that overachieving statement. I'm not saying that they want to do the grunt work. They do like to be manager from day one, but they are very well educated.
I also think it's kind of a rite of passage. Every generation calls the next generation lazy. So,
That's right.
It's just part of the thing.
That's
we were
right.
called lazy back in the,
Absolutely. And if you talk to my mom, you'll know that she walked uphill both ways through the snow to get to school every day.
Right. Yeah. Denise says, Tyler, thank you for sharing your expertise. Great presentation. I agree. I was actually talking to Bobby about how I like how you kind of talk about like all of the grades, like Perry Kaufman, and kind of use quotes. And, great job today. Really appreciate it.
Yeah, thank you, Jeff. I hope you guys have a great rest of the weekend. Stay safe, enjoy some family time, and we'll be doing this again really soon, right, Jeff?
Yeah, absolutely. We got one coming. We've got a huge conference up in May, so watch your inboxes. Awesome. It's 36 hours of presentations. So yeah, thanks, Tyler. Really appreciate it.
Thanks again, Jeff. I'll see you soon. Bye-bye.
Bye. All right, cool. Let me go ahead and do this. And let me just kind of go back in here a little bit. Do you want to say thank you to CMT Association for sponsoring the event today. They do a great job. We appreciate it. And very, very, as you can see, very well-reputed organization. So Jim says, who is Kelly? Kelly is actually my boss. He's actually off today. We gave him a day off. Instead of running the YouTube room like he normally does, we have Bobby in the studio running everything and kind of pushing all the buttons to make sure everything's moving smoothly right behind me. Pass as well. So Victor says, yes, I mean her course in her. Okay. Thank you, Victor. I appreciate the feedback too. Jim says, but this time we're correct in terms of the millennials. In any case, I want to say thanks for everybody. I hope you're enjoying it. I remember everybody used to talk about how us people that were born out of the 80s were lazy. So I think it is a rite of passage for sure. In any case, I do want to remind you about the Summit Action Pack, GoNoGo Complete, MQ Trader Pro, the Fulgent Wave Trader, the Training with Oscar Carboni, 2 years of Stocks and Commodities magazine, a 3-month subscription to learnmetastock.com, and workbook and videos about Metastock. Normally, all that would be $4,530. Here at the event, $2,245. You can visit us at metastock.com/summit deal. You can call us at 800-882-3040, or you can visit us online at metastock.com/saleschat. Do want to thank CMT Association for their sponsorship of today's event. I also want to say thanks to Stocks and Commodities. It's been a minute, but we do appreciate Stocks and Commodities for helping us put on these events. They do such an outstanding job of helping us getting people to the events and helping us market them. And they've been supporting the Trader Summit since we started doing it a decade ago. I think it's almost a decade. I think in January it'll be 10 years. So if you're not too familiar with Stocks and Commodities magazine, they have a 17,000 article trading archive that's part of a paid membership. They have 1.3 million subscribers. They've been publishing magazines since 1982. You'll get a free copy. If you want to get a free copy of the magazine, just go to metastock.com/traders-summit. And from there, you can just say, give me a free magazine, and they will give you a free magazine. So also, if you spend more than $300, you'll get a 6 months subscription. I'm sorry, if you spend more than $300, you'll get a 2-year subscription, compliments of them. So again, they've done such a fantastic job in terms of supporting the event and getting us all ready and just making sure helping us out with it. So we appreciate it. Our next presenter, I'll go back here, is Steve Primo. Steve Primo has been a guest at Metastock's Summits almost for 10 years, I think. He's been a very, very consistent speaker. He always likes to come in. He does a good job. One of the things I'll say about Steve in terms of his presentation style is it's very direct. I like the way he explains stuff. When he explains something, I understand what he's talking about. And that's always something that I think is positive. So Steve does a really good job in terms of, he's very thorough, a great technician, and we want to welcome him here. So Steve, thank you for coming today.
Well, thank you for having me, Jeff.
All right. I can hear you. You sound good. I'm going to go ahead and let's see. I just turned the presentation over to you. Welcome to the summit.
Okay, thank you so much. And thanks everyone for attending today. This has been a great summit, and I have a great class for you today. As Jeff said, I've been speaking roughly about a decade at these online summits for Metastock. And usually what I'll do is I'll give a strategy or an actual method, but I'm going to change things up a little bit here. I really just want to talk about things that you should actually apply, that you can apply to any strategy, any technique, any market, any time frame. It really makes no difference. So these things, these 4 questions that you must ask yourself before each trade, I truly feel will improve your trading regardless of market or time frame, or what style you actually like to trade. For example, let's take a look at this chart here. I believe it's Apple. It's an older chart of Apple. Now, most people looking at this chart would say, okay, well, we've had a nice breakout here. We had a really nice run to the upside. So obviously we've been in an uptrend. But then here's what happens. You start to listen to outside sources. What my mentors told me was really useless noise, but most people take their cues from someone or something else. So let's say you go to a chat room or you hear some guy on TV and they say, well, sure, this has had a really nice, good move to the upside, but now it's overbought. Okay, all the indicators are overbought, or it's gone up too quickly, too high, and it seems like there's a reversal right here. So you say to yourself, well, boy, I don't want to miss this. Maybe it's going to come all the way down, and you had a little bounce here. So you decide to sell, okay? You think you're going to make a killing. It's going to go all the way back to the lows. Well, this is the way most traders make their decisions, not really based on any structure, but usually based on what someone or something else is telling them. Now, if you ask yourself these 4 questions, which I'll teach you today, you would have known right off the bat that you would never be a seller here. You would not even think about selling. Now, let's say you decided to actually buy here instead of selling, okay? Well, you would have already, asking yourself the next question, you would have already known exactly where to exit, where to place your stop. And then once you watch the trade unfold, you see that you potentially could have made it nearly 16 points in less than a couple of weeks before the stock started to head back lower. Remember, you're going to know exactly what these 4 questions are by the end of this presentation, and you can apply them to any market, any time frame, in any direction. It makes absolutely no difference, but I truly feel will improve your odds for consistency in trading any market. So welcome once again. My name is Stephen Primo. I'm the president and founder of Specialist Trading. We are first and foremost an educational company. Our only goal is simply to educate traders around the world, and I'm happy to say that I have students in over 115 countries around the world and in every state in the United States. I started my trading career roughly 45 years ago. I started on the floor of the Pacific Stock Exchange. I was on the floor for 16 years, and 9 of those years I was a specialist. That's where we get the name Specialist Trading. Now, I know a lot of you aren't familiar with what a specialist is. A specialist, if you ever Google those pictures of the trading floors back in the 20s and 30s and see the guys yelling and screaming and making these weird hand signals, and there's paper all over the floor, those were floor traders. And those gentlemen that were behind those large wooden podiums, those were specialists because they specialized in making markets in stock. So if you wanted to purchase or sell a particular equity, in the old days, what you would do is you'd call your stockbroker on the phone. Your stockbroker would take the order, then he in turn would call the floor broker, the broker that represented that firm on the floor of the exchange. That broker would take the order from the stockbroker and then walk up to the specialist and say, I want to either buy, let's say, 100 shares of IBM or sell 100 shares of US Air. I made markets in both of those stocks while I was on the trading floor. So that's what we did. We specialized in making markets. And I did this once again for 9 years on the floor. I traded through the crash of 1987. I was on the floor, and also through the bull market that followed afterwards. So I've seen and traded just about every market environment you can think of. Straight up, straight down markets, sideways markets, non-directional markets. And on top of that, I've traded just about every system, strategy, or technique you can think of as well. Most of the time, students will come up to me and say, well, Steve, this is a brand new method that, it's just hitting the streets. And usually it's just been around for a while. It's just been rebranded or renamed. So in my 45 years of experience, I know what works in terms of consistency, and I know what doesn't work. So that's what we focus on at Specialist Trading, educating traders around the world in things that actually have high levels of consistency so that you can take charge of your own trading destiny. You see, at Specialist Trading, we don't have chat rooms, we don't have trading rooms, we don't furnish signals. We're strictly an educational company with our goal to teach you how to trade. So that's our goal, and hopefully you'll see a bit of that in today's educational presentation. Now, before I begin, we're required to share this with you, so please take a moment to view our disclaimer. I'm going to share with you a lot of performance results by applying these 4 questions, but please remember that we can in no way guarantee that any of the results I'm about to share with you will be repeated in the future. Also, please remember that since we are an educational company first and foremost, all examples are strictly for educational purposes only. Now, a lot of traders say, well, how can I get more education on a daily basis? Well, I invite each and every one of you to follow us on Twitter. There's our handle right there. Every day I post anywhere from 4 or 5 different snapshots of signals that our strategies have generated, or little techniques that have just been highlighted in the markets, in the currency pairs, futures, stocks, even cryptos. So there's lots of great free information on a daily basis. Please feel free to follow us on Twitter. Now, since we are first and foremost an educational company, once again, we're a little bit different from other presenters in that, if you come here thinking I'm going to tell you what the market's going to do, if we're going to continue going lower, or if we're going higher, or if we're, I have the perfect stock for you to buy or the perfect market to sell. Remember, once again, we don't believe in that. That's not our philosophy. Our philosophy is simply to furnish you with all that information so that you can make your own trading decisions. As I said, I've been trading for 45 years now, and the only traders that are still around from the days when I was on the floor are the ones that make their own trading decisions. The other ones have all gone to the wayside. They've all given it all back, and they're not trading anymore. They're in a totally different endeavor. They're maybe retired or doing something entirely else, but they're not trading. There's just a handful of traders that continue to trade from my days on the floor some 45 years ago. And we all have one thing in common. We keep everything very simple, and on top of that, we basically make our own trading decisions. We don't rely on someone to tell us what to buy or someone's telling us what to sell. Basically, just follow the rules and we're disciplined. And that's what kept us in the market for this long of a time. So that is my goal as an educator, not to force feed you signals and tell you what the market's going to do. But my goal as an educator is to teach you how to trade with the specialist edge. This is the same edge that has sustained me for 45 years now, and hopefully it will be able to do the same for you. Okay, so let's jump right into it. I think we'll take questions at the very end. I see some people are already starting to ask questions. Let's ask the questions at the very end. I promise I'll get to them, but I have a lot of slides to share with you, and I really want you to understand these concepts, okay? I'd like to start out by a theme today. This is the theme of today's presentation. It's basically what my mentors taught me some 4 decades ago. So here's what they said when I was struggling tremendously 45 years ago, and I was most likely doing the same thing that most traders do. You know, I was following the same, conventional wisdom, the same things that are supposed to work. And I wasn't having any luck or progress at all for the first year or two while I was on the floor. So my mentors taught me the things that I teach my own students. And I remember them saying to me, trading is really simple. It's the trader who makes it more difficult than it has to be. I mean, think of it. If your trading is really overcomplicated, if it's really getting in the way, most likely it's because you've made it that way. You see, it doesn't take a lot of character to add on a lot of indicators and different requirements and different rules. Anyone can do that. And you can be trading 2 weeks and make it the most complicated method of all. But it takes a lot of character and a lot of discipline to really strip away those things, the things that we're taught are supposed to work, where in actuality, they really don't have that high level of consistency. So that's what it's really about, stripping away things and making your trading simple as opposed to the opposite. See, it's the easiest thing in the world to overcomplicate your trading, but it's the most difficult thing in the world to simplify it. The good news is, what I'm going to share with you today is extremely simple. In fact, you won't believe how simple it is. Most of you have heard some of these things, but you just don't know the process as to how to apply it. So that's what we're going to be talking about today. Okay, so let's start out. In order to be consistent, you must always ask yourself these 4 questions. All right. Now, remember, we didn't say in order to hit home runs or in order to retire in 5 months. No, because we don't, believe in that. We just want you to be a consistent trader so that you can be trading 10, 20, 30 years down the road. Okay. That's really success, the longevity. So regardless of what method, regardless of what system, regardless of what market or time frame, you must ask yourself these 4 questions prior to actually entering into the trade. Okay, question number 1. Am I on the right side of the market? Sounds simple, right? Most traders think they are right off the bat. They say, well, Steve, it's going up, so I'm on the right side if I'm buying, right? Or if it's going down, they say, Steve, I've got to sell, okay? But unfortunately, we're all taught the, in my opinion, incorrect way to determine if we're on the right side of the market or not. Let me show you what I mean. Let's go back to that original chart we were looking at, okay, in Apple. Obviously, we're in an uptrend, a short-term uptrend, okay? And remember, we got to the top here, and you said, well, we're overbought. So obviously, if we're overbought, that guy on TV can't be wrong, right? So I want to be a seller. And look what happened. It went down the next day. So I obviously want to sell this because we're overbought and it gapped down. Sure, it closed higher, but I'm getting a second chance to get in at a nice price. Well, how do we determine if we're on the right side or not? Here is one of the simplest but most powerful ways I know in which to determine the overall trend, and that's just simply to apply the 50-period moving average, okay? But in order to use this correctly, you have to ask yourself this question before you begin, and that is, where is price in relation to the 50-period simple moving average, okay? I'm going to say that again. In fact, you may want to write that down and put it on a post-it on your computer screen because it is so important. It's the very first thing you must answer to. And where is price in relation to the 50-period simple moving average? Now, obviously, price is above, right? So if price is above, the market, not me, not some guy in a chat room or not some convoluted indicator, the market is telling you it wants to go higher. The overall trend is up. Therefore, we will never sell if the market wants to go higher. We're only going to be buyers. So right off the bat, we don't care if some indicator or some guy on TV is telling us we're oversold. We're not going to sell. We're only going to look at this from a buyer's perspective. But just because we apply the 50-period moving average does not mean that we'll simply buy at the market. We have to add a little structure. Sure, we can look at a bar and say, well, I think I want to be a buyer right here, okay? But we have to add a little structure. So let's say we're going to buy it just once it trades above that bar. This is what's called our confirmation method, okay? So we'll buy at 164.21. We can put a buy stop there, or we can just simply buy at the market once it trades there. Okay, so now we know we're on the right side. We've added a little structure, and now we go to question number 2, which is, I'm sure most of you would say, oh, I know what it is. Where do I get out, right? Where do I get out with a profit? No, that's incorrect. It's actually, where do I place my initial stop? Because the first thing you have to realize is you may be wrong. This may not be the right place to get in. It may turn into a losing trade. So you have to ask yourself, where am I going to get out if I'm wrong? If I'm wrong to be long in this trade? Now, on our courses and in our different methods and studies, we have upwards of 7 different plans for applying a stop placement. You can choose whichever one makes you feel better. We have stop placements for traders that like to take a lot of risk. We also have other ones that like to take minimal risk. We have just a number of different stop plans to apply. Let's just use a very basic generic one here without getting too complicated on you. Let's just go back to the most recent low, and that would be right here, the most recent pivot low. And that just means that you have this kind of pivot low where you looks like a V or so right here. You have a low followed by a lower low and then a higher low. That creates this kind of a V approach. So we'll place our stop just below here. This means if we trade just below there, we're going to get out. It's wrong to be in the trade, okay? So we know that we're a buyer. We answered question 1. We answered question 2. Where am I going to place my stop? Now, this brings us to question number 3. What is my profit target? Now we can discuss a profit target. What if we're right? Okay, what if we don't get stopped out? Now someone would say, well, why did I have to wait to ask that? Because our profit target is determined and based off of our risk. Our risk is where we want to get out if we're wrong, which means our stop placement. So we had to know our risk beforehand before we know what our profit target is. So let's go back to the chart. If we enter right here, and if we got stopped out with a loss, where, or which I should say, what would be the amount of risk? That would be 7.86 points, okay? So we would be risking 7.86 points. What you want to do is at the minimum, make twice that amount, okay? That's what's called risk reward ratio. You want to, risk 1 to 2. So we want to make at least twice our risk amount. So before we even enter into this trade, we know we're risking 7.86. We double that amount, and that comes out to 15.72. And we know that at the very top where that is, that's where our exit is, at 179.93. So before we even enter, we know where we're going to enter, 64.21. We have our stop placement below the most recent low, and we know where we're going to exit. And we can sit there and decide if we want to take the trade or not. To see how you're finally putting structure and making your own trading decisions. None of this is based off of the earnings. None of this is based off of some economic report that came out. None of this is based off of some guy on TV after the market closed telling you what he likes or doesn't like. It's all based on you taking charge of your trading destiny. This is how you become a consistent trader. Now let's go to the 4th and final question, which is, how do I protect my profit? I've often said to my students, one of the most terrible feelings to have is to be in a trade, and while you're still in the trade, seeing that you have a profit, sometimes a very nice profit, and then something happening where it ruins it all, and that nice profit dwindles away, and now you have a loss. It's a terrible feeling. I think most traders feel that way as well. They would rather know that they got into a trade, and the minute they got in, it turned into a loss, as opposed to getting into a trade and having a nice substantial profit and then watching it turn into a loss. It's a terrible feeling. So how can we protect our profit? Well, here's a very simple way, which applies to question number 4. Okay, so we know we would enter here. Let's watch the trade unfold. What we have is our 50% rule. What this means is when price gets to half the distance of where we want to exit, what we want to do is move our stop to unchanged. That way, if price is starting to go in our direction, rather than sit there and lick our chops and say, hey, this is going to be a great trade, I can't wait to see the profit I'm going to get, and then have it turn around into a loss, we want to protect ourselves. So as we see the trade unfold, we're in the trade now, it's going higher, and then a couple of days later, it trades there. In fact, it closed above. So at this point, we no longer keep our stop here. We move it up to where we entered. Therefore, if something came out, if there's some terrible news, if there's some worldly news, economic news, and it fell out of bed, we at least would not lose any money. Remember, the most The worst feeling in the world is having a profit turn into a loss. Okay, so we've moved our stop up. We've entered into the trade. We have our exit order already in place. Now, the only thing left to do is to watch the trade unfold. You see, I've often told my students, if you are trading correctly, if you're doing it the right way, it's extremely boring. If you're trading correctly, it's like fishing. You basically are sitting there in the boat. You put your cast out, and you're just kind of waiting for a bite. That's it. You're not doing a bunch of things. You're not on the phone, having 2 phones in 2 hands. You don't have 10 screens in front of you. You're not watching 10 different markets. It's very boring. You're just sitting there and waiting. Most of the time, if you're trading correctly, you're waiting. So that's what you're doing. You're watching the trade unfold. And as we see this unfold, ultimately, we hit the exit point. In fact, you probably would have made a little bit more than 15.72 because we gapped open, and you probably would have gotten the opening price closer to 17 points. Now look what happened once you exited. So you see how this all worked out without the aid of a ton of different indicators, without the aid of any news or earnings, without the aid of having to subscribe to a signal service. You're doing this on your own. You can apply it to any market, any time frame, in any direction. Let's look at another example so you fully understand this process, okay? Here's a chart in eBay, okay? Now, most traders looking at this would say, well, gosh, not giving me a lot of information here. Nothing much is happening. In fact, this is a non-trending market, Steve. So you say, we have to be on the right side of the market. Well, the market is telling me it doesn't know what it wants to do, and there's really no direction at all. You see, this is the way most traders make their decision. They say, this is a whipsaw market. I buy, it goes down. I sell, it goes up. So I don't want to touch this at all. There's no direction. There's no trend. All right. Question number 1, once again, am I on the right side of the market? How do we find out if we're on the right side of the market? We use what I feel is one of the most powerful tools and the most simplest tools is the 50-period moving average. And then we ask ourselves, where is price in relation to the 50-period moving average? Obviously, it's below. So if price is below the market, not some guy on the internet, not some guy on a webinar, the market is telling you it is in an overall downtrend. It wants to go lower. So are we going to buck the overall trend? No, the odds will be in your favor over time if you are in sync with the overall trend. Now, sure, there may be some really great buys at the very bottom that you say, well, gosh, I could have bought there, but he said not to buy if it's below the 50. Or some great shorting examples if price is above the 50. You say, God, I could have sold at the top, but he said not to do that because we're above the 50. You should never sell. You're going to see those. That's true. But remember, trading is a numbers game. If you're looking for those examples, you're looking to hit home runs, and that's what a gambler does. And we're not, trying to be gamblers because gamblers usually don't have much success over the long haul. They usually have a great 6 months or a great year, and then you learn more about them and they're not trading anymore because they lost everything. That's not what I want to instill in all of my students around the world. I want you to be trading once again 20, 30, 40 years down the road. The way you do that is by following this consistent rule here. So we're not going to be a buyer at all. We're going to look to sell, okay? So now let's say you think this is some type of base here. Let's say you decide to sell if we trade below there, okay, at 64.07. Maybe you'll buy the puts. Maybe you'll do a spread with a bias to the downside, or maybe you'll actually short the stock, regardless. But we know we're not going to be a buyer because the odds are not in our favor for it to go higher, okay? This leads us to question number 2. Where do I place my initial stop? Remember, we need to know, firstly, where we're going to get out if we're wrong. We don't worry about profits yet. We're more concerned about where am I getting out if the trade did not work. And as I said earlier, we have in our courses 7 different stop placement plans. Let's just pick the simplest, and that would be the most recent high, which would be right here, okay? You had a high followed by a higher high and a lower high. So we'll just place our stop somewhere just above this high right here, okay? So we know that if price touches here, we get in and then it goes right back up, most likely it's wrong to be in this trade, okay? Which leads us to question 3, where now we can say, what is my profit target? Remember, the only reason we wait to ask what the profit target is because our profit is determined or based upon how much risk we're going to take on. It's not the other way around. So many students come to me and say, like, I say, well, where did you originally place your stop? And they say, well, I don't really have a stop. I kind of think about it once I'm in the trade, and then I see what the market's doing, and then I decide. And in our opinion, that's a recipe for disaster, because how many times have you done that and it's gone against you, and what's the first thing traders start to say? They go, well, I'll just hold off. It'll come back up tomorrow, and I won't put a stop in. I'll hold back in. Maybe I'll buy some more, okay? And then pretty soon it goes lower and lower, and now you've turned into a long-term investor. Now you're in for the long haul. Why? Because you didn't place a stop. So we want to determine our exit, our profit target, by first determining what our risk is. So if we were to go short here at 64.07 and cover roughly somewhere above, our risk would be 3.58, okay? And if that meets your standard, if you have enough money in your capital in your trading account, and you can say, hey, that's fine. I can buy maybe a couple hundred shares, maybe a couple thousand. It all depends, or I should say sell. But it's up to you. But that is your risk, 3.58. So what we want to do is at least double that. Now, you can triple it, you can quadruple it, but we want to at least make twice that amount. That will ensure that over time you're a consistent trader. So what we want to do is simply subtract double this amount, which would be 716, and this gives us our exit point, where we're going to cover, where we're going to exit the puts, where we're going to get out of our spread, whatever we're doing. If we're short, which is where we cover the stock at 56.91. So we know now that we'll sell here, we'll place our stop here if we're wrong, and we'll get out right here. And all of this is being taken care of before we even enter the trade. See how you are in charge of your own trading decisions now. No one has to tell you what to do. Remember, the only traders I know that are still trading are the ones that make their own trading decisions. No one is around that bought this $10,000 system that was supposed to work wonders and never had a losing trade, or this fantastic indicator that never, was wrong. They're not around anymore, because those things are not consistent. They may have fantastic months, fantastic years, but ultimately it's been my experience is that they give that all back, and then you've lost all your money. So you have to be in charge. You should never ask anyone what they think of the market, or what should I do, or what should I buy or sell. You have to have enough information to make those decisions yourself. The good news is that's what our company does. We provide you with that information and work with you so that you can be in charge. Okay, now we go to the final question, question number 4, which is, how do I protect my profits? Once again, the worst feeling in the world is to be in a trade and it's going your way and you have a really nice profit, and then the next thing you know, some news came out or something happened, and now it's a losing trade. So this is what we want to protect against. How do we do that? By applying the 50% rule, okay? It's not really a rule, it's a suggestion, but we really, to our beginning students, we always require that they first apply this. So what we want to do is, if we see price come anywhere close to this half point between our entry and exit, what we want to do is move our stop to unchanged. So let's watch the trade unfold, okay? We're waiting for it to trade here. So far it hasn't. And we would have gotten short right here on the next day, all right? So we place our stop here. We place our exit, our profit exit right here. And now what do? We simply wait. Now, it's not going our way, but are we stopped out yet? No. So we're still in the trade. And as we keep watching it day after day, it's going our way. And now we've gotten very close to the 50% level. This isn't like something that is etched in stone, where you don't have to say to yourself, well, Steve said not to move my stop to unchanged until it absolutely hits the halfway mark. No, I mean, if it gets near or close, remember, you're in charge. This is not a signal service. You can decide for yourself. By the fact that you're watching it and tracking it, you have a better feel for it than anyone else. So if you feel it gets down here and you want to move your stop to unchanged, that's fine. But just for all intents and purposes, let's say we wait till it touches there. Now you move your stop to the entry price. Now, if something happens and the market explodes to the upside, most likely you'll just break even and you won't have anything to show that you have a loss, okay? Now, once again, the only thing left to do is simply to watch the trade unfold. This is just, like I said, it's very simple, but very boring at times, because you're not doing anything. There's nothing to do. Let the market take its course. Don't try to make the market work for you. Just sit back and watch the market do whatever it wants to do. Our job as traders is not to determine if the market's topping out or determine if the market is bottoming out and predict that. Traders should never be predictors. Our job is simply to listen to the market, find out what it wants to do, and then jump on board, go in that direction. That's all we want to do. We're not trying to decide what the market's going to do. We're just jumping on board and jumping on its coattails. So it told us it wants to go lower. We just add a little structure, and in a few days, it got right down to our level, and we made a little over 7 points, okay? And as you can see, that's where it started to go right back up again. You most likely would have been stopped out if you didn't place your exit target there at 56.91. Okay, let's review, because I want to talk about how you can incorporate these 4 questions into a strategy. The 4 questions you must always ask, regardless of what method or technique you use. Am I on the right side of the market? I know a lot of you say, well, yeah, Steve, if the market's going up, I'm on the right side that it's going up. Or if it's going down, I'm on the right side to short it if it's going down. But that's not always the case, okay? I can tell you of numerous times you've had these nice rallies whilst price has been below the 50-period moving average. And a lot of traders have gotten caught getting long, thinking it had bottomed out. Whereas once you learned this simple rule, you would have known that you were not on the right side of the market. You should have been selling. Those were selling opportunities as opposed to buying opportunities. The second question is, where do I place my initial stop? Once again, you can use any stop placement you'd like. If you like, you have your own personal stop placement plan. If you use an indicator that you like, or use some of the basic ones that we use in our courses. But the most generic one is the most recent high, the most recent low. So you can use that, okay? The reason why we need to know where our stop is because it's going to determine our profit target. So when we say, what is my profit target? That's based off our initial risk. If we're risking 5 points, our profit target is going to be 10. If we're risking 2 points, our profit target is going to be 4. Now, this is just a very standard generic. You want to make twice what you're risking, but you can kick it up to 3 times what you're risking or even 4 times what you're risking, okay? And then lastly, how do I protect my profits? You don't want to get into that group where you have a nice profit and then you watch it whittle away into nothing, into a loss now. So if you get halfway the distance to your exit point, move your stop to unchanged. That's how you'll protect yourself. The worst feeling in the world to know you had a profit and then know that you gave it away. Remember, as my mentors told me some 45 years ago, trading is really simple, as I'm sure you saw here today. It's the trader who makes it more difficult than it has to be. Don't overcomplicate your trading. I believe the speaker before me said the exact same thing, and I'm sure speakers before him said that too. Because we've been trading for a while. We know that there's a trap in thinking that the more things you add onto your trading plan, the more successful it will be. The more indicators, the more techniques, the more methods, it'll be more successful. But in my 45 years, I've actually learned that it's the opposite. The simpler things are actually the more consistent. So keep things as simple as possible. And this may require you stripping away things that you've been told are supposed to work, but most likely they don't. Most likely there's not a high level of consistency. So just be careful and try to stick to these 4 rules. Now, I know a lot of students say, Steve, this is great, but my strategy is terrible. It doesn't work regardless of what I do. I don't even rely on my strategy anymore because it's just not that good of a method. I paid a lot of money. I paid $5,000 for this thing. It's never worked. I just don't believe in it. So I don't have a strategy to apply this to. So firstly, I want you to get a homework assignment. Now, I know a lot of you are saying, wait a minute, homework assignment? I didn't know I was going to have to do homework here, but I just want you to go back and look at your last 3 to 5 trades and see if you would have added these 4 separate questions, how they could have improved your trading. I'm really sure, and I'm almost can guarantee you that they would have. Even if you only would have applied 1 or 2, the 50-period moving average and where you're going to exit. Things like that. But just go back and research the last 3 to 5 trades and see if they would have worked. I can almost guarantee you would have increased your odds for consistency. And once again, if you don't have a strategy, or if you're saying to yourself, that's why I'm here because my strategy is terrible, well, I have some good news for you. Would you like to trade a strategy that incorporates all 4 of these questions? Well, I want to introduce you to a strategy that I've been trading, that I continue to apply in my daily trading for over 45 years. And this is the first method that my mentors taught me on the floor of the exchange. When I was struggling, this is the first strategy they taught me, and it incorporates all 4 of these questions. This is our special offer for all the attendees today and for the Online Trader Summit. It's strategy number 4. Okay. Now, pay no attention to that graphic there, because when I first started specialist trading, we mainly focused on stocks. And so when I first started teaching and having courses in strategy number 4, it was for stock traders. It doesn't matter what market you want to trade it on. I mainly use it for the E-mini. I like to trade E-mini futures. But you can apply it to currency pairs, crypto, ETFs. It makes no difference. You can apply it to weekly bars, monthly bars, 5-minute bars. It makes absolutely no difference. So you'll get instant course access, detailed instruction. You'll get all our different entries, exits, and stop placements. I know a lot of you, and especially new students, will say, how come you have so many variables for entry, exits, or stop placement? Well, it's because our philosophy, once again, is to provide you with information and then let you make the decision. You see, we feel that teaching should be more like a buffet table. In other words, let's say you go into a restaurant, it's a buffet restaurant, and you go and you want to have a meal. And let's say you decide to get on the buffet, you get some steak, some meat, some roast beef. And as a side, you get some asparagus and some mashed potatoes. You take a glass of wine as your beverage, and then maybe chocolate cake for your dinner, okay? And you're very satisfied. That's a nice dinner for you, okay? Now, someone walks into the exact same restaurant, and as their entree, they get some fish. And then they take a salad as, that's going to be their course appetizer. That's all they want is a salad, Caesar salad. And then maybe they have iced tea as their beverage and a piece of cheesecake. Now, both of those different patrons are satisfied. They've both been extremely happy with their meal, but they're completely different. Now, trading is no different from these examples, okay? You can still base and have a fine trade based off the same information, but having a completely different entry from someone else, a completely different exit from someone else, and completely different stop placement. It doesn't mean that one is better than the other. Remember, you have to be in charge, and the only way you can become consistent is if you are happy or you feel comfortable with where you're entering. You don't want to be trading a method and say, well, I bought this $10,000 method, and I have to enter the same place, the same exit every time, and the same stop placement. And guess what? There's like 50 trades a day. I can't do that. I can't trade 50 times. In order to keep the numbers, the statistics, I have to enter 50 times a day. I can't do that. Or you might purchase an expensive system that says, well, this is great. The statistics going back to back testing are phenomenal, but it only trades once a month. I mean, I can't do that. I can't just sit around a month and wait for a trade. Well, that's why you have to make your entries, exits, and stop placements make you feel comfortable. That's why we provide you with this information. Now, you'll get the complete course rules. We have conservative as well as aggressive versions for all the people. But let me show you some examples here. Remember, you can apply this to all markets and time frames. Let's look at some recent strategy number 4 signals, okay? Now, here's an example in SGEN, okay? As we can see here, we crossed above the 50-period moving average right here at the end of February. So at this point, it was telling us, the market was telling us, not the earnings or not some guy on TV, the market was telling us the overall trend is up. Now, nothing really happened here. But if we look, we want to find bars that close above the 50-period moving average. And we also apply strategy number 4, and we see that we had 3 of these right here, okay? And look what happened. It took a while to kick in, but eventually you could have potentially made 18 points to the upside coming into April, okay? These were all valid signals that some of our students take. Let's look at this example right here. It's an ORLY, O'Reilly. Okay, price is above the 50-period moving average. So even though we had a sell-off for the last 3 days here, what's the overall trend? The trend is up. Now, someone may look at this and say, hey, Steve, these are pretty bad sell-offs here. I don't want to be buying this. But remember, using this simple rule, the first question, the market is telling you that this is not a selling opportunity. This is a buying opportunity. And right here off this bar, strategy number 4 generated a buy signal. And coming into the second week of April, you could have potentially gained 60 points in 4 days, okay? Here's another example. This is in the euro dollar, okay? Now, here was a very nice rally that took place. Now, a lot of students will say, well, Steve, gosh, I missed the bottom here. Look at this. This had a really nice bounce, and you told me not to buy anything because it's below the 50, right? Because remember, we're trying to instill consistency in you. Therefore, if you had bought somewhere down here, you would have had to be very quick because strategy 4 generated a sell signal right here at the end of March and look at the downward move. Now, you tell me, would you have rather been a buyer and had a quick 2-day move, or taken charge of all this move right here and taking advantage of it for 300 pips, potentially to the downside? Okay, that was in the euro dollar. How about a 30-minute chart of the E-mini futures? This was on a couple of weeks ago in the E-mini futures. Once again, price is above the 50. So even though we're just going sideways here on a 30-minute time frame, the overall trend is up. So we're not going to be a seller. We're not going to think that this is overbought. We're only going to look for buy examples. There were actually 3 strategy number 4 examples here. And had you held on for the next day, 25 points to the upside. Potentially could have made over $1,200 per contract. Now, included with this, our association with the Traders Summit, we're going to throw in 4 extra bonuses included with strategy number 4. These are 4 online Traders Summit bonuses. The first one is you're going to get the add-ons for Metastock. So in other words, this is a $1,000 value. You'll be able to get the up and down arrows automatically placed on the platform. You'll get that included with this great offer. This is usually offered at over $1,000 or close to $1,000, I should say. Bonus number 2, we'll throw in our full Secrets of a Stock Specialist course. This is a 3-hour video seminar, another $1,000 value. Some years ago, I was asked to be the head speaker at a convention in Colorado, and they videoed the 3 hours I was speaking. And this is a course there where I talked about a lot of different techniques and methods, and that's yours as well included. The third bonus is, I think, something you'll really like. It's the PDF version of my book. That's a $100 value. Now, remember, I traded during the crash of 1987. This is a book that kind of takes a trade-by-trade account of what it was like to be on the floor during the crash on Black Monday. So I tell you exactly how I traded, what I did, and the chaos that was going on, ensuing on the floor in October of 1987. Okay, that's a $100 value. You'll get that version as well. And then lastly, you'll get bonus number 4, the Secrets 2.0 course. This is close to a $1,000 value as well. This is where we take it up a notch to more advanced techniques, more advanced methods involved in this course as well. So these are all included in the great promotion I'm going to share with you. Okay, so if we put all this together, if we put strategy number 4 included with all the bonuses, it would cost normally close to $3,100. Okay, and we're not going to charge you anywhere near that. Here's the great offer we have and the great promotion for all the attendees today. We're going to discount it down to $297. That's a nearly $2,800 savings. Less than $300. You're going to get over 4 decades of information that I've accumulated, techniques and tips and methods right there at your fingertips, and you'll be able to be trading a strategy that I actually use on a daily basis. This is a great, great offer, but it's for a limited time only. So for $297, you'll get all of this information, and it'll be right there. In fact, you can get this set up as early as next week. You'll be able to be using this and seeing the signals auto-generated on the platform. Now, if you're still not convinced, even at this great low price, let me share with you some recent examples, okay? This is the QQQs, okay? The ETF that represents the NASDAQ. We all know what the market has been doing lately, okay? We all know what happened this past week, really going strongly to the downside. Using these 4 questions along with strategy 4, let's say you were a student of mine and we had given this presentation a month ago. You could have taken advantage of all this that just happened this past week. Now, most students looking at this would say, well, Steve, you know, that chat room I go to, they said there's major support here. This is where all the institutions are buying. And that's why we bounced here. And so, the institutions are never wrong. So I don't want to go against the big money, the big banks. So I'm going to be a buyer here because it looks like we're making some type of support. It looks like we're making some type of a bounce. And I kind of like the market. I think we're in for a bounce here. Okay. Once again, this is the way I used to trade. So I'm not trying to be arrogant or condescending. What my mentors taught me was to apply that first question. Am I in sync with the market? All right, so how do I find that out? I apply the 50-period moving average. And if I apply that, I see that on the 11th, which was roughly last week, we started to have, actually on the 8th, we started to have consecutive closes below the 50-period moving average. So what is the market telling me? What's the NASDAQ telling me? It's telling me it wants to go lower. The overall trend is down. Until I get consecutive closes above the 50, I shouldn't be a buyer at all. In fact, if I'm long the market, I should most likely raise my stop, at the very least, raise my stops to lock in some profits or to get out with a small loss. Or maybe I want to sell a portion of my position, or maybe I want to more aggressive. I want to start looking for shorts. And that would have been the right thing to do, because on the 20th, which was just last Wednesday, strategy 4 generated a sell signal in the ETF that represents the NASDAQ. And we all know what happened Thursday and Friday. Okay, the markets fell out of bed. Now, remember, no one told us that the market was going lower. We didn't look at any earnings or any economic reports, jobless claims. We don't watch any of those things. And they're not in any of our requirements for our methods. All we look at is price and a few simple indicators. Remember, the theme of today is keep things as simple as possible. Now, you can apply this to ETFs to get an idea of what the sector is doing or what the market's doing, or you can apply it to actual stocks where, once again, here's an example in Netflix. We all saw what Netflix did this week. Terrible news, right? Terrible news about how the company's doing. Once again, we don't require any of our students to follow any news. Why? Well, because 3 weeks in advance of that terrible news, strategy 4 generated a sell signal on the 30th of March. It was telling you to sell the Netflix, I should say. And then we all know what happened this past week. It wasn't as if the CEO of Netflix called me up 3 weeks ago and said, hey, Steve, I know you have a small, nice little company there. Why don't you tell all your students to short our stock, because we're going to have some bad announcements in 3 weeks. No one, told us that. So students are always mesmerized. They say, well, how did you know? It's because we've learned how to listen to the market. When you keep things simple, it's very easy to start being consistent. So Netflix fell 165 points in 3 weeks after a strategy number 4 sell signal was generated. If you're still not convinced, a year from today, you will have wished you became a member of this course, the strategy number 4 course, at especially such a low price of less than $300, $297. Here's how to take advantage of this. Contact my sister site, Pro Trader Strategies. I developed all of my courses with them. They're in charge of all the pricing and all the discounts. They have trading consultants manning the phones right now. They would be more than happy to take your order over the phone, or even answer any question you may have about the strategies, or even just pricing, anything, or any other strategies as well. I would recommend calling them directly at area code 310-598-6677. Now, that link you see at the very bottom of the page here is the link that will take you to the info page, as well as sign up page. If you'd like to sign up online, you can do that. But that's not a live link. You have to copy and paste that onto your browser. I don't know if Jeff's going to put that up there, but you can either copy that down and put it onto your own browser. I would highly recommend, though, contacting Pro Trader Strategies. There's absolutely no obligation. They're not going to try and sell you anything. They're very flexible. They would answer any question you have about pricing or another strategy. I know we may have some overlapping. Maybe some people here already have strategy number 4. So they would be happy to work with you with another strategy as well. But strategy number 4 is the one I use continually. It's a great method, and it's extremely simple. In fact, I've already given you a couple of the rules with those questions that were already in strategy 4. So you already know half the rules of strategy number 4. There's just 2 more requirements, and it's very simple after that, okay? I think I have about 5 or 10 more minutes left. I'll answer the questions. Let me open up the question and answer box. I think I remember how to do this. Let me see here. Someone's saying, which moving average period is better for intraday traders? That's a good question. It's up to you. I personally use the 50-period moving average for everything. The reason is because the 50-period, and when I say what moving average is better applied, we're talking about telling us what the overall trend is, because that's the only reason we really use the 50-period moving average, just to find out what side of the fence we should be on, whether we should have a buyer's bias or a seller's bias. So if we're trading a weekly chart, or if we're trading an intraday chart, or if we're trading a monthly chart, we always tell our students to always have a 50-period moving average line there, because we know a lot of traders will jump back and forth to different time frames. You'll jump back from a 5-minute, then you'll look at the daily bars, then you'll go back to a 10-minute, then maybe look at a weekly. This way, you don't want to continually make things different and say, well, I changed it to a weekly. Now I guess I'll go to the 100 period moving average. Now I'm on a daily, so I'll look at the 50, but now I'm on a 5-minute, so I guess I'll go to a 20. Once again, that is making your trading overcomplicated. So if you just keep the 50 period, it in my opinion, in my 45 years, it is the best at determining the overall time frame. The overall trend for all time frames. So we want to keep things as simple as possible. And in my opinion, that works the best for all for using it in this technique, okay? Let's see here. For day trading, would you still use the 50 simple? Yes, I guess that's another question going along the same lines. Yes, I would. I would continue to use it. Like I said, that's what I do. I day trade because of my schedule and because of, I'm giving webinars or I'm teaching students. I don't have a lot of time to be holding positions and then watching them. So what I usually do is I like to, when I have a free moment, I'll day trade. And so I use it for that purpose as well. I am trading on another platform. Hope this does not offend you. No, it doesn't. Can I get the entry arrows there too? You can also answer me on a different setting. Yeah, I believe they, that would be a better question for Pro Trader Strategies. Once again, we're offering here for Metastock users because it's their Traders Summit, but contact Pro Trader Strategies. I do believe they have that. You can call them at 598-6677, and they can answer that question. And once again, there's no obligation. But I'm pretty sure they will, okay? So that's a good question, and that's okay. If you already have another platform, that's fine. I actually think they may have them for other platforms as well, okay? Let's see, other questions. I know people are always asking me in terms of exiting as well, and I think some of the questions here are about the exit plan. Remember, what I showed you today, this is just one exit plan. I just showed you a couple of the different variables that we teach our students in terms of entries and in terms of exits and stop placements. Remember, you don't always have to exit at the 2 times the risk. There are other plans that still have great risk-reward ratios that are used entirely different from what I shared with you today. So that's the beauty of what we teach. We don't want to give everyone, in other words, we don't trade or teach systems. Systems require everyone to use the exact same entry, the exact same exit, the exact same stop placement. And that's why they're systems, because that's how they come up with their back testing and with their statistical references. But it's been my experience, and it's just, I'm talking from my own personal experience. I have taught and I have traded systems, and every one of them had tremendous back testing research and numbers. Some 80, 90%, win-loss ratios. And guess what? Every one of them eventually blew up. When the market changed, all those statistics went out the window. Therefore, that's why you have to be in charge of your trading destiny. You have to make your own trading decisions. You can't rely on something that's been back tested for 10 years, because I've traded things that are back tested 20 years that blew up in 2008. And things before that that were back tested 10 years that blew up in 2000 in the dot-com crash. So when the market environment changes, you've got to be able to change with it. And most systems won't do that. That's why we offer you these different variables. We want you to be in charge of your trading destiny. How can I use stops when trading options? Well, I believe some option. I'm not an option trader per se, so I can't really give you an option trade. Remember, we only teach students and highlight high probability trading points. How you decide to trade, whether you use stocks, futures, currency pairs, or options, is up to you. We never tell students how they should be trading. But I do believe that some platforms allow you to apply stops. I would check with your platform or with your broker, okay? Do you use a simple moving average, or can you use an EMA, which is an exponential or a weighted moving average? I personally like to use a simple moving average. Now, having said that, remember, once again, I want you to be in charge of your own trading destiny, so please feel free to experiment. Trust me, for the last 4 decades, I've experimented with possibly every moving average technique you can think of, and different time frames and different styles of moving average. And after all that experimentation, I've come to use what my mentors taught me, which was the 50-period moving average. That, to me, is the best. But feel free to experiment. Just when you're experimenting, remember, the main job of this technique is not to have a moving average crossover. It's not to tell you when to buy, when to sell. It's not to tell you if this is a short-term buy or a short-term sell. It's just telling you whether you should have a buyer's bias or a seller's bias. That's it. So work with a EMA or a WMA. That's fine. Just whatever works for you using that concept, okay? Someone's asking, how long does this discount go for? $297. It's a limited time offer. I believe it's probably going to last maybe to sometime midweek next week. I know a lot of people are on the sidelines, and that's perfectly okay. We don't want to convince and tell everyone you've got to do it. But what a lot of people have done before, I assume this is being recorded, what they'll do is they'll watch the video and they'll say, well, God, that's a great idea, but I'm going to, just kind of use my technique and my strategy I purchased for $5,000 because I think it's really good. And then they'll trade for another month and they'll see that they just rack up a series of losses. And then they'll say, gosh, I'm going to contact that guy, Steve Primo, again and see if I can get that $297 deal. And most likely it's already gone back to close to $3,000. So what I'm basically saying, I wouldn't sit on this for more than the middle of next week, because most likely it's going to go back up to the price. I would say by next Thursday or so, you should probably make a decision, okay? And it's up to you. If it's not your cup of tea, I totally understand. I know everyone trades differently, and that's fine. But this is a great offer. If this in any way piques your interest, or in any way says, hey, he taught me something with these 4 questions. That was very nice, and it seems very honorable. I think I'm going to take advantage of this, a really deep discounted price. Then feel free to call up Pro Trader Strategies. Once again, that's 310. Let me get that number again for you here, 310-598-6677. And they would be happy to answer any question about pricing or maybe even another strategy, okay? I think I'm just about at the end of my time. I just want to thank you and everyone with the Online Trader Summit for inviting me to speak again. You're a great audience. I really hope I taught you something today, because once again, we are an educational company, but most especially, I look forward to all of you becoming students of mine at Specialist Trading and the Strategy Number 4 course, okay? Thank you so much. Have a great weekend. And Jeff, I give it right back to you.
All right. One quick comment we had off of Facebook. We're now streaming on YouTube and Facebook and Twitch. We're branching out, Steve. But
Right.
Dokuman says he's been using Strategy 4 for a number of while, and he loves it.
Oh, great. I love to hear that. I just, because remember, this is just something to help you with your trading. You can apply it with other things, and it works on any market or time frame.
Awesome. Well, thank you for coming in and talking to us and sharing it with us. And we'll see you again real soon.
Great. Thanks a lot, Jeff.
Thanks, Steve. Okay. All right. Very good. All right. Hope you're enjoying it. We are almost done. Paul asked the question, is there going to be a recording of this webinar? Yes, actually there will be. And the way that works is we actually are streaming it to YouTube right now. Once we get done, after Oscar's done, about an hour after that, you'll automatically receive a link to the YouTube recording. And I can also post it in the chat, but you just wait for that email. It'll be here within about an hour. Do want to remind you that we have the Summit Traders Action Pack. It's going to include the GoNoGo Complete, which has been a very, very popular add-on so far this year, brand new for this year. The MQ Trender Pro, Fulgent Wave Trader, which is brand new for this event. The training that we did with Oscar Carboni back in November, he talked a lot about kind of technical analysis and technical formations and how to spot them and how to draw them. Did a great job. People love Oscar, as you're going to see why in just a minute here. You get 2 years of Stocks and Commodities magazine, 3 months of LearnMetastock.com, and also we're going to throw in some training and some videos that show you how to use Metastock. So normally all of that would be $4,530 here today at the event, $2,244. Most of it comes with, all but $99 of it comes with a money back guarantee. So it's a great way to try out some of the best add-ons that we've created. Give us a call, 800-882-3040. Visit us online at metastock.com/summitdeal or metastock.com/saleschat if you have questions or want to talk to somebody. We'll be happy to answer any questions you've got. Take advantage of this offer today, 800-882-3040. or metastock.com/saleschat. Give it a go. All right, cool. Before we get on to our final speaker today, going to talk about Stocks and Commodities magazine again. Thank you, Stocks and Commodities, for sponsoring the event, for including 2 years of free Stocks and Commodities for anybody that buys the Summit package. If you're not familiar with Stocks and Commodities, they have a 17,000 article trading archive, 1.3 million subscribers. They've been publishing since 1982. You get a free copy if you'd register today. If you're watching on YouTube or Facebook or Twitch and you want to go register, go to metastock.com/traders. Summit. Give us your name and your phone number and your email address, and you can get a free copy. There's also lots of free gifts that are available just for registering. So also, if you spend more than $300 today, you'll get a 2-year subscription. So a big thank you to Stocks and Commodities Magazine for sponsoring the event today. We appreciate it. So we're going to go ahead and jump into our last guest. We have a great speaker to finish up things today. One of our favorite guests, actually. I think Greg, our marketing guy, calls him a force of nature, but I love the way that he looks at charts. I love the way he does charts. He runs a room called Live with Oscar, which you should check out. And he also does some training in Nevada. So with that being said, Oscar, how are you, my friend? All right. Well, it doesn't seem like we can hear Oscar.
You didn't hear any of that, did you?
Oh, no. But I can hear you now. So I'm going to stop being nervous. We've actually had a fairly good session. We've had a great audience all day. Very, very good questions all day long. So, Oscar, I want them to know they're in for a treat with you. So with that being said, let me go ahead and make you the presenter. Okay, here it comes.
All right. So
Okay.
Good day. Jeff, am I on the air?
You are, and I can see, what I can see is looks like a Word document or a Google document. Is that what you want to share?
I do.
Okay.
I'm going to start that. We'll go from there.
I am going to get out of your way.
Well, let me say this. Jeff, thank you so much for the invitation. I love performing. I love to be able to show my analysis to your fans of Metastock. And the presenters before me have been fantastic. So thank you. A round of applause to all of you for working so hard today. What I'm going to show you today is slightly different than maybe you might be expecting. At the end of this, I've got nothing to sell you. I've got nothing packaged. I do that on purpose because I'm not willing to package up what I use as my Omni system and sell it or mass produce it. It's just never going to happen. I actually teach it to 3 people 4 times a year, live here in Las Vegas. Barring that, I show technical analysis, and I will show you techniques in this video today, in this live session, that you can use next week to figure out where you can make your money. So I'm just basically going to show you the great stuff that I have found that's helped me call the markets correctly, and you'll have some tips, tricks, and techniques that you can use next week that'll cost you nothing to see where the markets may go next. So if you'd like to hang out with me, I've got a free live trading room at livewithoscar.com. It is where I live. I just kind of lived there my whole life, day and night. When the markets are moving, we're as busy as can be and as serious as heart attacks. And when the markets are slow, we hang out with each other and wait for the next move. It's sort of what used to be my trading pit down on the trading floor, where I grew up from 18 till 42 years old and maybe later. And once they sent us home and handed us laptops, I created a trading room, and that's where I live and breathe. You're welcome to join me there. So what's going to happen today? How to trade alongside the professional Wall Street stock hunters is what I'm about to show you, because that's what I am. I grew up on Wall Street, down on the exchange since 18 years old, working the back offices and on the exchange. And let me tell you, that's the epicenter of where everything happens, especially from the 80s through 2007, before we went internet and we went wireless. So Wall Street purposely confuses the public with jargon like algorithms, hedge funds, percentage returns, the float, EBITDA, insider trading, insider buying and selling. You know, it just goes on forever. The list of scary and confusing terms is endless, right? Who knows what to do? Oh, no, they're coming in with an algorithm. It's a bunch of nonsense. I'll tell you how to see right through that today. A fire hose. Number 2, what's another problem that we have? A fire hose of financial information is blasted out at us every day and night. It's too vast and impossible to decipher. There's no way to take that fire hose of information coming at you, disseminate all that information and say, oh, that means I buy the S&P at 4211. You know what I'm saying? That's not possible. The internet also has a third big problem. Someone like me or one of your best advisors, they can actually post something on the internet, right? A trusted friend or an advisor, an instructor. That creates a post that you are going to believe because the instructor believes they posted it. But what if the instructor's information was wrong to begin with? It's on the internet. You run with it. It's very difficult to figure out how to get this right by listening to what's happening on the news or the internet or your friends or anybody else. Is there a method of trading to eliminate this fire hose of news and fundamental information? Yes. Is there a way to spot the next move before it happens? Absolutely. There absolutely is. The solution is called the chart. I will show you how to read that chart. I promise you, you will see that it is really easy to figure out. A good chart read will tell you where the next move is coming from. How to trade is slightly different. Some of us make mistakes trading like I did last month. I came up with great analysis, but my trading was incorrect. That can happen to any of us. But what I will show you is how to come up with absolute correct analysis, easy stuff that you can use for yourselves, and when those triggers take place where you should either go long or go short certain stocks or certain commodities. So get ready to become professional Wall Street stock hunters, because that's what we're going to do next. Now, am I qualified to teach this to you? Absolutely. I'm the best in the world at this. You'll see. Look at this, the SPX Daily Bar. You know, I put out a YouTube video. Go back and look at it. It's dated 2022. At the high of this circle, I came out with a video and said, traders, do not fall in love with the upside any longer. That is a term that I have not used since 2007 into 2008. During 2007 into 2008, as I do every night presently, I do YouTube videos each night to tell you what should happen the next day. And in those videos, I always had do not fall in love with the downside, meaning if the market goes down, you can buy the dips. And that was on my whiteboard through 2007, 2006, and 7. In October of 2007, we reversed that to do not fall in love with the upside through 2008 into 2009. In about March of 2009, I reversed it again. Do not fall in love with the downside. Okay. After we've gone up for so many years, I didn't even bother leaving it on the board. Everyone knows do not fall in love with the downside is my approach, meaning we buy major dips. Well, on this day, January 4th, 2022, I reversed something I haven't reversed since 2009. And I put on my board, do not fall in love with the upside in every one of my nightly videos, which are free and you can see on YouTube. So now that we've got this new mentality, do not fall in love with the upside, Oscar's telling people to start selling rallies. He hasn't said that in 12 years. Well, that is my opinion starting the 4th day of January. So I put out a video, and in that video, I started to show you that the market became addicted to certain algorithms or simple moving averages, if you will. You'll see what I mean in a moment. So I started to show you that something like what's become the darling lately of Wall Street right now, forget the 50, forget the 200, well, the 200's always there. Forget the 50 for now. That's in vogue sometimes. It morphs. So the street, Wall Street, morphs what averages they're using to create algorithms, and you've got to know how to morph with it. Lately, right now, what you can use next week is the 90-bar moving average on a lot of the products on Wall Street, and let me show you. The 90-bar moving average basically showed us we could be a buyer right here, no problem there, right? You could see it clearly. You were able to buy that spot. All right, the market ran up nicely. Let me get a little circle thing here so I can move around with it. So the market runs up nicely, boom, 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 boom. Comes back down. What's it hit? Exactly the 90. I mean, exactly. That is Wall Street programming the 90 into an algorithm. I promise you, this is really easy to spot. So what's it do? Back up again. Comes down to the 90. It stops perfectly. Goes back up. Down to the 90. Just about hits it. Back up. Then it gets under the 90. What happens? Big break. Once again, big break. Back to the 90. Once again, big break. Monstrous break. Gets all the way up. fails at the 90 again miserably after going through, and that starts the debacle. Now, Wednesday evening, I did a YouTube video last week and said, traders, I know the market looks bullish. Wednesday, we were going up. And I said, listen, forget it. The Omni is telling us, do not fall in love with the upside. We've got a problem here. The 90-bar moving average is capping the market. And look at the drop that took place Thursday and Friday. Now, what makes it worse is the 90 and the 200-bar moving average have converged. You see that? That is bad juju, kids. I am telling you, this is no good. So the market did exactly what the analysis told us it would. The market started dropping exactly when the analysis told us it should, starting January 4th. So now we've got something to look at. The 90-bar moving average seems to be a big thing. Let's just look at the markets in general, and we'll see what averages work best right now. Same chart. Just wanted to show you Wall Street's darling lately is the 90-bar moving average. It works like a charm. Lately, it'll morph, sometimes the 50, sometimes the 150, sometimes the 90. You've got to know how to find it, and that's what we're going to do. So you snap that average on here, and you see it works almost every time it comes near it. I mean, look at that buy and this buy. So it works really, really well. And Wall Street is not stupid. They know how to program these out. They know how to program these averages into the algorithms. Now, you must understand that an algorithm is nothing more than going back and reading all the data on this chart and coming up with a formula that tells them what should happen next. Well, you know what? We could do that with our eyes. I kid you not. You don't even need a calculator for this. Look at how well, had you sold that 90-bar moving average, you would have made a small fortune on Thursday and Friday. Even if you're a day trader, you would have caught a nice little piece. Now, granted, as much as I called this coming, my Omni did not let us get filled on Wednesday, Thursday, or Friday. I've sat and watched, calling perfect analysis, doing the videos. Come on, everyone, get short at the 90. And we didn't get filled. Maybe next week I'll get lucky. This week, I've only been calling it well without getting in. But that's trading. Trading sometimes is different from the analysis. I'm going to teach you the analysis so that you know what to do next week. All right, so the 90 is in vogue. Now, traders, this all started here. Let's just do it like this. This all started right here at the Russell 2000. If you are an Oscarism fan, if you are a fan of the Omni, you've seen me put this chart out before any of the other markets cracked. It started here with the Russell. And I started to point out we've got a left shoulder, a head, and a right shoulder. That's our big head and shoulders. And look what it does at the 90-bar moving average right here. Boom, failure. Again, right here. And that starts to break down to the right of the right shoulder and creates what? A big, big bear flag. Flagpole. Flag. So now we've got a monstrous bear flag. And there's a bear flag inside of that bear flag. And look at how well it worked. Now, traders, I had this all drawn up on Wednesday in a video. Wednesday night, you go look at my video for Wednesday night, and you'll see this exact chart with that flag inside of a flag and projecting that we would break to a specific level. And look at the 90-bar moving average. Look at what killed this market. Here, 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 90 bar. Here, 90 bar. That is where we're at right now. It'll morph to something different, but the 90 bar moving average is your key for next week. If you go back up and hit it, sell it. That's one of the things we're using. Listen, the leader proves that this voodoo actually works. I mean, this head and shoulders started. There was none on NASDAQ. There was none on S&P. It started on Russell. I pointed it out. NASDAQ caught one. S&P caught one. The stock market caught one. Head and shoulders. Down we started to go. Everything cracked when it tried to get back above the 90-bar moving average. Now we've got a flag and a flag and a flag. Traders, do not fall in love with the upside. It's one of the things you better take home with you this week. Sell big rallies. The analysis tells us such. Let's move along. So we looked at the S&P. Now, check this out. Remember I told you that these things morph? If you watched my last presentation for Metastock, I showed you the 150-bar moving average was in vogue, not the 90. And look at how well it worked when it was in vogue. A great buy signal here, a great buy signal here. right? Then you break under it. Fantastic sell signal. Then you suddenly can't get above it. The 150 was in vogue. That was the average. Well, we've moved away from that. We've morphed away from that 150. The 90 is the big one now. Remember that. There's a few other things you'll learn here. We are also in a bear flag in the NASDAQ, just like we are in everything else, and you're just starting to break down out of the bear flag now. These techniques, they absolutely positively work. The reason why they don't for some traders is because traders don't know how to read a chart properly. They buy a book from someone that's been around for 3 years and he thinks he's wise enough to write a book. So people go out and read his book and it doesn't work. The analysis I'm showing you is tried and true since the early 80s. I learned from the masters that the only ones that were good at analysis in the 80s, there weren't very many. I studied every book there was to study, and then I started to realize I'm going to have to invent this myself because a lot of what's out there doesn't exist or it's incorrectly written. So now most of the techniques I look at may have started out as something that I found in a book or that I spotted on the chart, but I've turned these techniques into my own, and I've proven them over the years, and I know they absolutely work, and I can do absolute calculations off of each one. And I'll tell you right now, it's way easier to figure out than an algorithm. So here we are. Bear flag is working. You are about to hit one of my big gun averages. The last time we hit it, it saved the market. Look at what happened. Last time we hit this average, it literally saved the market. Let's see if I could drag this little circle with me. It saved us. Up, bounced again twice, and boom. But look what happens. Hits that 150. Bear flag. We're about to test a third time. The danger zone is down here. What will happen is you will find a ton of sell stops below these previous lows because anybody that got long here is going to put their stop below there. That's the way it works. And anyone that was short down there is going to get out down there. So you will find this to be a danger zone if we drop further through the average and end up down here. So watch for stops below there. The market will crack even further once it gets to this area. So it was the 150. It's no longer that. Let's keep looking around. And the reason why I want you to remember that it started with Russell, that was key, is because look at the NASDAQ head and shoulders. This head and shoulders formed well after the Russell was already there and started to break a little. Then NASDAQ finally seen it coming and created its own head and shoulders. Started with the Russell, small cap. Then the high tech figured it out. Huge shoulder on the left, a monstrous head. And you got the right shoulder, creates the first drop. And then we run up to something you'll never read in books anywhere. You'll never find it elsewhere. But it's an Oscarism called the head test. Over the years, I've realized that if a market puts in a big head and shoulders and runs up to do a head test and fails, more downside will ensue. Not only did it fail at the head test, but the 290 bar moving average came together, both of them. Drops into a bear flag, which will absolutely create more downside. Now, these charts were all set up on Wednesday for this webinar. I'm just adding in the days now, Thursday and Friday. I just did a refresh. It was absolutely correct, wasn't it? These techniques are simple to use and they work well. So now we know the 90 bar is in play. Bear flags are in play. Let's go see what else is happening. See what we can figure out for next week. Look at our transportation average. Now, transportation average capitulated. Then the Russell put its head and shoulders top in, so it started. The capitulation probably came from the Dow Jones Transportation Average, but we don't trade that, right? It's an average that we don't trade, more of an indicator. We trade S&P, NASDAQ, Russell, so it started with Russell. However, look at the capitulation day. And traders, I know how this stuff works. I wrote this and put this circle and the words capitulation day top the day that ball was put in. Ask any of my omnets who follow me. Recognizing from there forward, we are probably going to start to look at the downside. And basically just about any video or any analysis you've seen from me since the beginning of Jan has been downside. Now, this happened in December. November, actually, was our capitulation day. I didn't turn bearish till January. This happened first. The rest of the markets continued up. But I had my indication and I knew something was coming, and all we had to do then was wait for the signal. And once the market started to put in the downward signals, the videos from me started coming out, the bearish analysis, and now we start finding what Wall Street's using to make their money. So lately, this has been Wall Street's darling, the 90-bar moving average. Make sure you use it because it is in vogue. If you don't think so, just look at this insane action around it. Gets down, can't hold, breaks, boom, 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 right? Comes all the way back up, can't get above, breaks. But look what happens once it gets above. Bam, you end up in your capitulation day. Drops to it, can't get under it, drops to it, does get under. Then you have this insane movement, right? Great buy, great sell, and great sell for now. Next week, I think we'll continue on towards the downside. So the 90-bar moving average, certainly keep that in mind for what's going to happen next week, kids. Let's see what else is out there. Okay, so just to show you once again, it all started with the Russell. Now, these are not predictions. I don't predict anything ever. That's for crazy people. These are projections that work absolutely, positively well for me 80% of the time, if I call them correctly, which you can do as well, because all you have to do to call these correctly is not think. You know what you're talking about. Do not think because you read news and disseminated that news in your brain that your brain has it right. Know that the chart is right. The chart is the market. The market is always right. So I live by two rules. Rule number one, the market or the chart is always right. Rule number two, the market looks wrong to you today. Please refer to rule number one. The market's always right. You just have to read it correctly. So what's happening here? Of course, the 90-bar moving average is ruling the roost. It is in vogue now. We failed an Oscarism head test as well in the Russ. Put the bear flag in, and down we go. And let's see if we've updated. Yeah, we are updated for Friday. Look at that crack right at the bottom of the flag as if it was meant to be, like it was scripted. These flags work when they're in vogue. Sometimes that's not what's in vogue. When you're going into a bear market, from what I noticed back in 2008-9, you get the head and shoulders and then a series of bear flags, and it's exactly what's happening here. And I was very quick to point it out from the first day, January 4th, when we put the high in. From there, we started to point this out to you. How would I know that? I use the chart. I don't listen to any system. I've got an Omni system, which tells me exactly where to buy and sell, but that's not what you're going to see here because I wouldn't dare show that to the public. I do teach it to 3 people at a time, but that's not going to happen here today. What I will show you is the larger analysis. I will show you the forest from the trees. The Omnis, the trees, gets me in and out. The forest is most important because if you don't know which way the path is going, you don't know how to day trade through it, right? This will show you which way the path is going. You just, of course, your own methods may teach you how to get through your day trades. My Omni method will show you where to get in and out if you'd like to do that. So this voodoo really works. This is not voodoo, kids. I mean, you can count on these. Now, for me, I do a YouTube video the night before. I put that circle here and say, look, we're at the 90-bar moving average. This is now going to crack. And it does. That's complete 100% faith in the analysis because I don't think I'm smart enough to figure out what's going to happen next. In fact, I'm just a stupid guy. I don't know nothing. I ain't know nothing. But I can tell you right now, that chart is the most intelligent thing on this planet. And a good chart read, make the stupidest person on the planet a very good trader. You just got to read the charts. Now remember, algorithms and everything Wall Street's using, it all comes back to the numbers on this chart. It's simple data. You just have to read the data correctly, know what Wall Street's using, and that's easy enough to spot. So let's see what else is out there. Let's go look at this bad boy. Now, this going up does not help at all the markets, right? Stock market goes down when the price of energy starts to get extremely expensive. In fact, the price is $75. Ask any of my Omniacs. They saw it happen before their eyes. When we were at $50, I told everyone, no problem with the S&P till we get above $75 with crude. Cross the magic number, S&P starts to crack. You put the price of $75 crude next to the S&P, and here's what you'll see. Crude goes to 75, S&P puts a stop it. Crude goes to 80, S&P starts to do this, and it hasn't stopped since. One of the driving factors pushing our markets down is crude. Now, crude is the exact opposite of everything I've shown you. It's above these key averages, above the 90, above the 200, it's above the 50, it's above all of it. Everything else I'm showing you is below. Crude going up, it's usually an indication that your market will go down. Just another simple technique for you. You've got a bull market in crude and you're above all the averages. If you are above this magic number, you can expect to be selling rallies in the stock market. So crude puts pressure on stocks when it's moving up, and crude being above all these key averages tells us it's not ready to crack just yet. What else is out there shaping the landscape? This one, T-bonds. Anybody who's been following me knows that from the highs I have been just touting and touting, we are going to 137 in bonds, and when we get there, I will reassess. We have dropped all the way down to 139 and change. It's happened. Now, what makes this important? Traders, this is the most important chart that you will see at all today, no matter who the presenter is. Why? This is the chart of interest rates. This is the 30-year bond chart. This interest rate and bond works exact opposite of one another. If the bond market is going down, interest rates are going up. You see this teeter-totter or seesaw, if you will, like you're out in the park? Well, bonds right now is the big heavy kid on one side and you're the little light kid on the other. Your interest rates. Bonds down, interest rates up. Well, look at the spiral in bonds. This movement forces the stock market to adjust lower. Now, January 4th, in my YouTube video, this is all I discuss. Stock market getting cracked because bonds are dropping, interest rates are going up. Why does that make a stock market crack? Well, corporate bonds. In order for a big company, a public company to survive, it's got to sell forward corporate bonds. They're just like the government bonds, but they're corporate bonds. They're shorter term. And here's what they state. I, Oscar Carboni, and my company we're going to sell you a bond. That bond is going to sell to you at 4% interest, right? You can only get 2% from the government. We'll give you 4%. So people buy that bond. Now, the company has enough money to run for the month, and that gives their stock a value, what they paid for money, right? The interest they paid for the money, and what their stock is doing gives it a value. Well, if next month what they pay for interest goes to 6%, now they got to pay 6% to get people interested because the Fed's raising their rate. It's safer to put money in Fed bonds. That's safe. What makes people want to put in the corporate bonds? You offer more interest. It's risky, but you do it. Now, a corporation has to offer more money or more interest to get the same money to borrow each month. That makes the stock have to adjust. It has to. There is no choice. It has to adjust. This is what I explained on January 4th and videos afterwards. We now have to make a price adjustment because interest rates are going up. Fed just mentioned a day or two ago that they're going to raise rates at least 0.5 point at the next meeting, and the stock market adjusted almost immediately. This is an adjustment. You can see the adjustment taking place in this chart right here. So bond futures in a bear market forces interest rates higher. Interest rates going up forces the stock market to readjust. It doesn't create a bear market always, but it does force the stock market to readjust for the new price they have to pay for money, which is higher interest rates. That's what's going on here. Not a crash like 2008, and don't expect one of those. A slowdown, yes, the government is putting the brakes on. So Biden got in office and he stopped oil and he put a few brakes on, so to speak, on the economy. Then the Fed came out and they started raising rates and not putting out as much money. Everyone's applying the brakes to the vehicle. And if you apply enough brakes to a moving vehicle, it will slow down. These are the brakes you're looking at right now. Bonds going down are the brakes to slow down the stock market. It has to adjust. I'm not guessing. I'm doing this for 41 years. I've seen this cycle countless times. We have to adjust. And that's why I called everyone on January 4th. Now, it's a lot of heroes out there telling everybody how bearish this is. How many of them knew on the last up day of the year, or I should say, of this year, to tell all of their followers and then continue that the market will now start to go down? So a lot of people are jumping on the bandwagon now, but you've got to be able to see it coming. Now, the chart is what showed it to me. I've got no special powers, nor do you. But I can show you what to use. So once again, 90 ball moving average, yes. Knowing interest rates are going down, or excuse me, knowing bonds are going down means interest rates are going up. That means stocks have to adjust. These are simple things that should help at least point you in the right direction of what happens next. But once again, I'm not guessing, and I didn't just read a book. You know what I mean? If you guys want to learn about a book, you come to me. I'm sure I could write a better book than anything you've ever read out there. I've got more time and more study in this. I've been in the epicenter of this longer than anyone I've ever met, and it's not that difficult to do, I promise you. But you've got to have faith in that chart read. That's the tough thing. You've got to have faith in your chart read. So what else is out there? Let's see. We just looked at bonds, right? There is no way to escape this. You can't put your money in things like crypto because crypto decided, or Wall Street, I should tell you, decided to use the 200 ball moving average on their Ethereum algorithms. And if you don't think so, I mean, just look at the perfect buy here, right? Nothing happens again till you get under it. Then you start to crack. You try to come back up. The first thing that happens is it cracks at the average, comes back down, gets to the average again, cracks, and now forms a bear flag. So Wall Street decided that on Ethereum and Bitcoin, 200 ball moving average is important. So let's see if it's been dropping. Oh boy, look at that. We just updated Friday. See how it's falling out of the flag? Friday's bar. So why is Ethereum working well with Wall Street algorithms? Well, because there's an Ethereum futures market and there's a Bitcoin futures market. So that means it gives Wall Street an opportunity to use their algorithms on those markets because they're regulated and they're allowed to trade them. Unlike Bitcoin Cash, Ethereum Cash, or any of the other cryptos that have no futures market at all, no 401k, no fund is allowed to go near them. But you've got futures markets in Ethereum and Bitcoin, and I am telling you, they work just like the stock market does. Right now, this month, the algorithms that Wall Street is using are exactly what they use on the stock market. So I've been able to spot them, and being that I'm long Ethereum and Bitcoin because I've got a 4-year target, Bitcoin will be 85,000 in 4 years. I don't want to talk about the downside of euro, of the crypto, but it's coming. So that's Ethereum. Look at Bitcoin, and I'm going to have to tell you about going down. Bitcoin's going lower. I'm sorry to tell us. All right. Oh, gosh. So Bitcoin, which I own a ton of as well. But I've got a 4-year target, so I don't really care where it goes for now. I'm just having fun with you guys. Bitcoin, no different. Wall Street is using the 200 ball moving average on it. They are beating Bitcoin up whenever it gets to it. And now we've got a bear flag. I'm telling you, this movement looks the same as everything else I just showed you in the cryptos because Wall Street is in Ethereum and Bitcoin. Futures, not in anything else because there are no regulated markets. They are in this, and that's why I trade Bitcoin and Ethereum. That's why I own Bitcoin and Ethereum. I like the regulation. I think the market works really well, chart-wise, when it's regulated. So let's update where Bitcoin go on Friday. Look at that. It dropped out of the flag. Now, you might wonder why I didn't take this green bar and make the flag bigger. It was just a one-day event. Dropped under the flag, went back, settled in the flag. I just discounted it. The flag is all the other bars that connect down here. So look at what happened on Friday. The flag is doing, the bear flag's doing exactly what it was supposed to do. So you can't hide in Ethereum or Bitcoin either. What else is out there? Is there anywhere to go? Let's take a look at some stocks now. So just a reminder, it all started here. Keep your eyes on that Russell. If it ever becomes bullish again, it all started with the Russell. Maybe it'll complete, go back up with the Russell starting. But we're almost at the bottom of this huge bear flag, traders. If we get through the bottom of this massive bear flag, the one right here, you've got a huge projection on the downside. So, wow. Let's see if it bounces off the bottom of the flag as it did here, and as it did here, and here. But if it doesn't, boy, oh boy. Now, you can't keep knocking on a door. Knock, knock, knock without it opening, especially in the trading industry. So that door is going to open. We are going down lower. And I'll show you that technique as we move along, the knock, knock technique, if you will. In fact, Apple, let's start here. Boom, look what happens at the average. Boom. like magic, right? Wall Street knows. Look at what happens when you get to it down here, right? Beautiful hole. This is an algorithm before your eyes. This bar, believe it or not, dropped, came back and closed up here above that line. It was a one-day bar. That means it held the average, right? Beautiful. Once it gets below the average, then the damage starts, right? You get below the average, damage starts. You get back above it, boom, they just come out of the woodwork. So we know that this is Wall Street's honey right now. So let it be. And look at the damage happening there. Then at the same time, you're in a really, really wide, been around for quite some time, channel. Look at this channel that you're in. And it's going to the bottom of the channel now. It basically has been just going from the bottom of the channel to the top, to the bottom, right, top here, to the bottom, almost the top, bottom of the channel, back to the bottom of the channel, top of the channel. Here, tries to rally, can't, we're heading back to the bottom of the channel. That should be what takes place over the next few weeks in Apple. And look at how that average, don't let it get above that average without getting yourself long, but for now, you can stay short below it. And what else are we looking at? Knock, knock, knock. Here's that technique I was telling you about. Check this out. Now, many of my Omniacs have seen me do this on stocks, on commodities, on indices. When the time comes, I pull out what I like to call the knock, knock technique. You cannot knock on a stock door this many times without that door opening. So what does that mean? Well, first of all, what's in vogue here? The 90-ball moving average, right? Beautiful thing. It keeps stopping the market in check. Wall Street knows. From here, it started to crack into a bear flag. Very quick. 1, 2, 3, 4. We were down there in 4 days. That 90 is killer right now. Breaks into a bear flag, which presents or creates another knock on the door. So in Wednesday night's video, go back and look at Wednesday. This very chart is in there, but these days don't exist. So that's the word boom doesn't exist yet. Only this day. And I said, okay, we've knocked on this door 5 times. The door is going to open. Now look at the door. Not only did the bear flag technique work, but so did the knock knock technique. You can't just keep coming down and hitting support without that starting to break through. Why? Because every time you get down here, sell stops are going to be gathered. Sell stops are placed below there and below here and here and here. We've knocked on the door 5 times. On time 6, boom, it breaks through. And now we've got more downside projections on NVIDIA. And it all started with that 90 when it was cracked. What else do I have for you? Amazon. Now, Amazon is traditional, likes the 200, always likes the 200. Use 200 on Amazon, look at the crack there. So when you're trading Amazon and you want to know what Wall Street is about to do, you want to be a Wall Street stock hunter, watch what they do around the 200-ball moving average. It is a telltale giveaway. See this? Boom. Nice rally, right? Off the average. This is an algorithm. I kid you not. Algorithms are not all that difficult. Now, what they have programmed into an algorithm is a lot more than an average, but in the end, it comes out to be an average if you know how to spot it. So look what happens when it cracks here. Big crack comes, right? Boom. So now that we know that they're using the 200 on Amazon, we can keep that in mind when they go near it again. Amazon should at least get down to this line here. Let's make it a little darker so you can see it. This should at least be your projection down here in Amazon, which puts us somewhere near, now let's make sure that we can read that. That puts us somewhere near 2560 area. So we, but of course it started all the way up here, right? Now it's going to be at 2560. It was at 29 when it got its signal. These signals work really well. So you should end up down here at some point, even if you get a rally or day or two in between, down here is where it's going to go. Or at least that's where the analysis is pointing to. And then we've got this. You might all remember this from a week or so ago. Does anybody remember this one? Zoom. Now, Zoom was interesting because I was able to prove to my traders that these techniques or that averages are absolutely algorithms that they're using on Wall Street. I showed this chart and I said the 55 moving average gives the absolute most perfect signals on Zoom, has been working for the last 2 years. And get this, this whole area didn't exist. We were here. So this area, if I could somehow blank this out for a moment, I will. I think it should allow me to. Not on this technique. I was going to fill in that little rectangle so you couldn't see these bars. In any event, what happened here was this. We were on this side underneath the average. And I said, traders, just wait for the signal. When it gets up to that 55, it's going to crack. So it rallied up, up, up. It hits the 55 at 126.44 and drops to 99.30. That's what happened after it hit there. Once again, if you'll look, it's always like this. It's an interesting technique, the 55 on Zoom. Don't ask me why they seem to think that's the proper algorithm, but look at the movement that takes place when you get to it. It's just perfect for Zoom. So the 90-bar moving average is in vogue. The 55-bar average works really well on Zoom. The 200-bar moving average is going to give you a winner in Amazon. These are simple techniques that hopefully you should be able to, now that I've shown you that they're actually in the process and progress of working this week, you can use that stuff moving forward. Is there any other chart or anything else that you would like for me to go over? Because in all honesty, I didn't plan on spending the whole hour here. I wanted to set you up with what I see for next week and just let you go. But I would be more than happy to answer questions if there are any.
There are, as a matter of fact. Let's see. Emmy had a really, can you hear me okay?
Very well, thank you.
Okay, just wanted to make sure. Amit wanted to know if you had any mentors in the 80s and who they were.
So John Murphy was my professor at the New York Institute of Finance. I got blessed. It was before John Murphy knew he was going to be John Murphy even. He was young. So he ended up teaching me. And I worked with Pete Stottlemyre. I worked with the Turtles. I worked with Dominic Orsiello. I mean, the list just goes on forever, to be honest. I teamed up with everyone that I could back in the 80s and 90s to learn these techniques because I knew that would be the future.
Cool. Let's see. John Murphy was awesome too. Or I shouldn't say was.
Dennis, I've worked with so many. I mean, the list is just so vast.
Yeah. Let's see. Ernie asked a really good question. With interest rates going up, what do you feel? How do you feel about gold?
So if interest rates continue to go up, gold becomes in vogue, but we do have something stopping gold from going higher. In fact, let's go look at it together. It's this. Now, you might not recognize this. There's a lot of inflation going on all over the world. You know where it's not going on so much? In the United States, except for at the pump. And here's why. This is our currency we're looking at right now. As inflation rises, we've been the only country on the planet to say, so is our currency. We have been padding the inflation on the way up, not dollar for dollar, but imagine being in any other country right now where your currency is dropping with this inflation. So what does that mean? We feel it at the pump, yes, but while the dollar's rallying, it's keeping the price for Americans cheaper than it is for everyone else. The dollar rallying, by the way, why I brought that up, is what's keeping gold down at the moment. If we get an instance at all where the dollar starts to go the other way, gold will just explode. For now, I'm actually looking for some downside in gold. And why is dollar rallying? Does anybody out there know? I'll tell you why if you don't. I'm going to ask you a question. Does anybody out there know why the dollar is rallying so much in the face of inflation? Jeff, I can't see if they're answering, so you'll have to tell me.
I'm waiting for some answers.
If no one understands why the dollar would be rallying, think this. If you, myself, or someone else that you know was in charge of a sovereign fund, meaning you're in charge of the money of another country, and you see U.S. inflation, or excuse me, U.S. interest rates moving higher, you have to take your money, buy U.S. dollars to then buy U.S. interest rates or U.S. bonds or U.S. whatever you want to buy. So the fact that U.S. markets are moving higher, you've got to take your euros and buy U.S. dollars first before you can then take advantage of the higher interest rates. And the Fed, on top of that, is padding the dollar for us so that we don't feel the inflation as much as the rest of the world. The dollar rallying is helping to keep pace with inflation. It doesn't work at the pump because the pump's the pump. Crude goes so high so fast. But everywhere else, if you were in Europe, if you were in Australia, if you were anywhere else in this world, our currency would be going down, not up. The U.S. currency is going up. We have been blessed. This would be much worse. It would be more like the 70s if this dollar wasn't so steady. So that's what gold can't go up.
That makes a lot of sense. All right, Mike wants to know if you'd please look at Tesla. It has such options that infect the SPX.
Of course we'll look at Tesla. Let's see. I may already have a Tesla chart. We'll just pull a fresh one. And on this one, it's Tesla.o, correct?
That is correct.
Okay. So let's just add a quick template here. And this is Tesla. And if you ask me, that's already looking ugly right off the bat. I'll show you why. Let's just label it. So what I'm seeing right off the bat without even adding any techniques or anything is just using my eyes. I'm seeing this. We've got the market bouncing off this resistance line at the top. Okay. And then if you ask me, this is a bear flag with 1 day blow through, which as I showed you on other flags, it doesn't really bother me having a 1 day breakthrough on a flag. That doesn't scare me. That'll happen from time to time. But this is a bear flag. And if you've got a bear flag after hitting that resistance point up there, forget about news because I don't pay attention to the news ever. I could care less what the news has to say. So I get my news from the chart. And right now I would have to say if I'm going to follow formations, this flag that I'm building for you looks pretty valid. So I would think we could get some downside in Tesla based on this formation here alone. For me, when I'm going to actually trade, I run what I call my Omni analysis, Oscar's market navigational indicator. But that's for short term. That's for what's going to happen in the next 24 hours. For this, I would say you could end up easily down here, coming down and touching the 90-ball moving average. I think that's where this will be next in the next day or two. Looking at the analysis, the Omni would tell me that for sure. What I'm seeing here tells me downside's coming. Then, of course, if you want to continue to just use simple trendline analysis, you can give yourself a little target down here and say some sort of apex is building. This would be the bottom of it. This blue line's the top. That should be my expected target. And that's what I would look for. And then, of course, you'd run into the 200-ball moving average down there. And then you'd find out if Wall Street wanted to buy it again at that spot. So here's what should happen. As we mark a few days, if it takes 3 or 4 days to get there, right? Picture there's 3 or 4 bars. Let's move this one over. So if it was there and then the next bar is here and then the third day is here, what will happen is this will have moved as well. Your average will have gotten out there. And I'll bet the average hits that line at the same spot, which will turn into a buy spot for us. So that you can probably look towards right there. And then we'll see if Wall Street wants to buy it right there. That's my opinion of Tesla.
Perfect. Amit wants to know how you decide when to use the 90 and the 200 moving average.
It's not me. I just snap the average on and see if that's what Wall Street's using. It's up to Wall Street. So the presenter before me said, I use the 50. That's all I use. I always use it. Well, that's good when the 50's working. But what about when it's not and Wall Street's, using a different approach? I just find whatever approach Wall Street's using and I stay with them. It's where I grew up. It's what I was trained. I mean, I know how to figure out what they're doing and I just stay with Wall Street, which is a real edge when you hang out with me in my trading room. I know more about this than the average person who writes books and puts out programs.
All right. Let's see. Gary before that, Case Law out of YouTube says very informative. So good job.
Thank you.
Gary wants us to look at XLK from YouTube.
XLK. we can do that. And that's this one right here. So
Yeah.
XLK would basically remind you of the Russell, in my opinion. And XLK here, well, look, once again, isn't that odd the way Wall Street is just keying off this 90-ball moving average? Just keying off of it, right? Why do you think they're in love with that today? And for me, I could care less why. And this is the XLF, right? Yes, XLK. So I could care less about reinventing a wheel. I don't care why they use it. I don't want to know why they use it. I don't want to sit in a meeting and have them tell me why they use it. I just want to spot it, put it on my car, make my car go really fast with it. So this is the wheel. It's already been invented, these averages, right? It's just whatever one Wall Street is hitting on at the moment. So look what happened here. Okay, so the bigger picture is the 200. Of course, they always mess with that. But look at how much better this one was in just about every instance. So this is what we've morphed to this week. Next week, it could be the 150. It could be the 77. It could be the 112. I don't know, but I'll find out just like that. So XLK is going to go lower. The likelihood of taking out the stops below here is extremely high. Why? Because look at how many times you've already knocked on this tool, right? So you've been knocking that knock technique, knock one, knock two, knock three, fourth knock. Usually doesn't take more than 4 or 5. You'll go right through. So more downside is expected in the XLK from what I can see. And then, of course, just using simple analysis, I mean, this thing is pointing down, not up, right? Look. If we go like this, well, you're basically in a big channel pointing down, which tells you the bigger picture is lower, right? The forest is lower, and the trees are pointing out. The trees have just bounced off the 90-ball moving average here, and they're pointing out that more downside is coming. And, of course, a simple target would be this one. Why not get to the bottom of what keeps working? That's the way I look at it. All right, boom. So expect that.
Amit wants to know, Oscar, what charting software are you using? And I might add a little bit here. Those charts look beautiful. What charts could you possibly be using?
I use Metastock 100% completely since I was born. No. So I literally stumbled upon Metastock in 1982-ish, and it was so crude you couldn't really get charts to come up well. Yet, you know, you had to flop 8 disks. You had to swap 8 disks in order to get the program to come up. And then I found Metastock, went out to visit them, started programming with and for them. And what I have found is I have worked with TradeStation. If you can mention any of them, I've worked with them in the last, 40 years. I was a beta tester from the 1980s through 2006 because I was a nerd programmer way before there were computers, before there was a Commodore 64. I was a chart analyst, big nerd about that too, and a real-time trader in a pit. So I was a combination that wasn't easy to find, and everybody came to me out there. First Alert, Robert Slade, you name it. Oscar, here's a program. What would you do with it? So I kid you not, a lot of the techniques that you find in your programs, a lot of those that have made their way into Metastock, I helped invent in the 80s and 90s to help make these programs better. Here's what I found. No matter what I've tried to use my Omni on, and I have worked with every program under the sun, and I'm a programmer myself, it only seems to work well on Metastock. So I'm stuck with you guys forever, and I don't mind at all. So Metastock's my favorite.
You're welcome forever.
I cannot make this technique work on any other program I've tried my whole life. Not that I wanted to ever morph away from Metastock, but just to see if it would work elsewhere. So I have my own software called the Omniac, and I can't make my Omni work on the Omniac. I have to use Metastock. Congratulations to you guys.
Thank you. We're happy to have you. Robin says, Oscar rocks, exclamation point, exclamation point, exclamation point.
Well, thank you.
Yeah, thank you. Gabby wants to look at Disney, DIS.
You know, my wife told me, make sure you do Disney in this presentation, and I forgot. So thank you for asking.
I'm interested. I haven't looked at Disney in a few weeks at least, so I wonder what it looks like.
I bet you the CEO probably wishes he could say that too. He got in trouble for not opening his mouth. Then he got in trouble for opening his mouth. I guess there's nothing he can do to stay out of trouble.
All right, DIS is correct. Just change it to starts with instead of contains.
That's
No,
not gonna, so let's go here.
start it up. Oh, go ahead.
That usually, I can find almost anything when I do that.
That'll work.
And of course that did it. Ooh, nasty. So let's just take a look at this very quickly. Oh boy. I would not want to be long that stock. All right, so if we just throw a channel on this and follow the simple channel, I mean, take a look at this channel right here. If we just do this alone, it'll basically show us what's going on. So I would actually cut through. I would do it from here like that. And let's see, let's go right to the top. Boom. So I would use this as my channel, and we'll make it nice and deep. And I would say if you don't get to the bottom of that channel before you get to the top, something's wrong with technical analysis. So let's see what the bottom of that channel comes out of. We want to do this, right extension on here, and then we'll calculate and see where you should get to on a minimum. We'll leave that blue, make it a little thicker, boom. All right, so I would think minimum you're going down here, and that puts us, let's say it takes 4 days. That puts us, it says 107.41. Let's be sure about that. Down here, I would think you're going to be in the 107.40s before you can blink. An overall assessment is that you're going to end up taking out the stops below here, which is going to happen very shortly. So yeah. Now, for you analysts out there, if you want to know when something switches from a bull market to a bear market, if you take out the previous major low, like this one, in fact, we'll just do this. If you take out your previous major low, you switch from kind of bull to bear. And look what's happening right now. If this goes much further, you're about to do that. See it there, right? So I don't like Disney at all. Even if they get rid of the CEO, I think they're still going to be on their way down for some time. And then, of course, throw the fundamentals in there. They just lost their status as of this weekend, their tax status and their immunity status, if you will, in Florida. What's that going to mean to the stock? So you've got fundamentals on top of this.
I remember the last time we looked at Disney together, and Dan Tipton or Dano just got back. Maybe we need to send him down there to help him out.
Oh boy, he's going to have to do something because this looks terrible.
Yeah. Okay, let's see. Ernie has an interesting one. He's like, "What about natural gas with Ukraine and what's going on? Do you have a natural gas chart?"
Of course.
All right.
NGM2 should bring us natural. That didn't do it. We'll do it up here. Boy, oh boy, it's been through the roof. It's come down a little bit lately, but it's been through the roof. NGM2, that should bring us natural gas. All right, help me out here, Jeff. Why aren't we getting natural gas futures?
Try NG lowercase c1.
Okay, we'll do the.
That'll do continuous.
Continuous. Oh, so I have to do that here, not in open.
Yeah, in the power console. I'm not sure what the month codes are, so but that'll be a good way to cheat. NG uppercase NG lowercase c1.
I got you. NG small c1.
There we go. Phew.
All right, so let's just throw this technique on here. Webinar. All right, so what you've seen happen here, obviously, since Ukraine, it's not since the Ukraine, though. That's the thing about this. This started here because we decided to stop selling natural gas to Europe and give Russia the pipeline. So if you really think about when this started, it started in the beginning of last year. And ever since we gave the pipeline up, this started to happen, then the war. But if you look, we had quite the ascend because we decided that we wouldn't supply Russia with natural gas, someone else would. So you add the fundamental of the war, Russia in a war, Russia supplying natural gas, and this is what you're going to get, right? So now you're in a pullback. We're still in a war, which means you should probably at some point end up higher. So how would we decipher or determine the pullback? Once again, if you want to be simple about it, simple, of course, we're not going to get involved in doing a crazy Omni technique, but if you just want to use simple trend line analysis, you would draw 2 trend lines here to figure out where your next support is. One here, and all I did was connect this low to this low, and then I would do the same thing here, which we've probably broken. All right, so you've got that. Oh, look at that. You are bouncing off the support right now. And the interesting thing about trend line is this. All I did was draw from this low to this low, right? I went from this low to the low down here, and look what happens when I extend right to the exact low of Friday. So trend lines are extremely important. They are involved in algorithms too. It's just another price on a chart. We see it as a trend line. Algorithm sees it as data. Doesn't make a difference. So you're hitting support, right? What happens if you take out that support? Well, your next one is here. So if you can get below what looks like around 600, let's call it, give it 50 points of movement, you can probably set back a little bit. And then looking at where you've had trouble in the past, of course, we would do something like this and say, all right, we had trouble at this height last time. Well, maybe there's some support there as well. And it all comes to this trend line and what? The 90-ball moving average. Oddly enough, coming in at the trend line. So I think that's where you may be getting to. You may get some support. You may get some pullback into support now. So I would, more or not, I'd be on the short side of natural gas is what I'm saying. If we get through that trend line, then I'd start looking for downside.
I think we have time for one more. Let's go with RTX.
Let's get rid of this.
Peter from GoToWebinar would like you to look at RTX.
Okay, this is nat gas, right? Just so that it's labeled. And you want RTS.
RTX is an X-ray.
RT X-ray.
That's right.
There it is. Oh, Raytheon. I've been looking at Raytheon for a while. So, of course, look at this. This, of course, has to do with fertilizer, right? You don't even have to know what the stock does to know it's probably got something to do with fertilizer companies. I would assume so, because this is what we've been getting from all the fertilizer companies. On the run. So, once again, simple technique would tell you, and let's just do this. Let's see what the averages that Wall Street's been using lately say. So I create templates on what I think Wall Street's using lately. Oh, and there we are. So we are coming back to that infamous average. Let's get rid of this one. We're coming back to the infamous 90. So what do you do lately at the 90-ball moving average? You can answer this question for me instead. What would you do when you hit this average? If you were going to trade this, you go long, right? Until this technique stops working, you buy it every time. So I would say if Raytheon gets down to that spot, get long, put a stop a little bit below it. And how much below? You could do something simple like say, okay, how much further the last time we went below? We only went that far below it, right? So maybe I'll risk only that much. And you could do something that simple to help you figure out how much risk to put on this trade. It didn't drop through too far last time. Then this time it didn't drop through at all. Right? It barely did. So I would say, unless it gets through a certain amount, you can buy it and have confidence in it. RTX, it's labeled. Buy that dip when it gets there.
Okay, and then one more comment.
Sure.
Chris says, Mr. Oscar, you have opened my eyes to a completely new analysis perspective to the use of moving averages. So
I'm glad I was able to help. Again,
do you know what I encouraged him to do?
What's that?
I'd encourage him to go and check you out at livewithoscar.com.
If you go here, you know, the beauty of this is there are no credit cards required. There's no information. You create a username and a password and you're in. I try not to mess with anybody. It's my hangout, so you're welcome to come hang out with me day and night. I'm always there. If I'm not on camera, I'm watching and typing, but a lot of times my camera and microphone will be on as well. So please join me if you like the techniques that you've seen. Now, I will tell you this, and Jeff, you've been to my Omni camp, so you know this is true. What I just showed you is my 101 pre-kindergarten analysis. I could do this laying in bed, laying on the cot with the milk and cookies in kindergarten. The analysis I just showed you I can do. It's simple, right? I can take you to a much more complicated place, but there's almost no need when it comes to technical analysis. The Omni is slightly more complicated because it's exact pinpoint where to buy, where to sell, where to place stops. And the Omni I teach at my Omni boot camps. But that's about the only place you'll ever find me teaching that. And once again, that's for 3 people only, and it's 4 times a year. In fact, the next one is the 19th of May. I still have an open seat. I haven't qualified one person. So if one of you would like to come join me, make sure that you come to livewithoscar.com. You could also make it simple and just go here. And I'll do it in caps. It's Omni Boot Camp. You can fill out an application there. I do not approve everybody who wants to come out to camp. It just depends on what we discuss on the phone, but maybe I'll approve you if you call me. So Omni Camp, by the way, it's 4 days. It's 5 nights, 4 days here in Las Vegas. So it starts on a Friday morning and works all the way till Monday. So if you come to camp, you'll be staying with us for 4 days, 5 nights. I'll buy you a computer. We'll do all that great stuff for you guys, so that when you go home, you've got a brand new laptop pre-programmed by me. There's continued education once you leave Omni Camp, and I'll teach you the Omni techniques that I use every day to call the markets if you come out to camp. So if you don't mind, make sure you come join me. Either come to livewithoscar.com, or if you want to learn these techniques in person, go to Omni Boot Camp for the Omni Camp. So, traders, almost everything I do is free of charge. I'm not here to pick people's pockets. Come hang around me and see if I can help you understand markets better.
Awesome. Thank you, Oscar. You certainly did a good job today.
Well, thank you, thank you, thank you. Let me leave you with the chart where all of this began so that you don't forget. And that was the Russell. It all began here. Traders, thank you. Thank you for putting up with my craziness for the last hour, and I appreciate it. I hope I taught you a few techniques that you can use next week.
Did great. Thank you, Oscar. We love having you. Thanks for coming.
Cheers. Thank you.
All right. Hold on just a second. All right. Thanks, Oscar. We'll see you again soon. All right. And we'll wrap up here today. Quick question. How many of you, we still have quite a number of you, how many people have been here all day? If you've been in here all day, let me know. I'm going to go ahead and share my screen and make myself the presenter, and we'll just wrap up real quick. So let's see, let's do this. Okay. If you enjoyed Oscar, one of the parts of that training that's, or one of the parts of the bundle package that we're offering today is Oscar Carboni's training package that we set up and did with him this year. Last year, actually back in November. He talks about how the proper way to draw trend lines, flags, patterns. Did a really, really good job, and that is included as part of the Summit Action Pack. In addition, you'll get all of the great add-ons that we've talked about: GoNoGo Complete, MQ Trender, the brand new Wave Trader, the Oscar Carboni training, 2 years of stocks and commodities, 3-month subscription to learnmetastock.com. Normally, all of that would be $4,530. Here today at the event is $2,245. So you can take advantage of that by giving us a call at 800-882-3040. You can chat online with us at metastock.com/sales-chat. And you can also visit us on the, I'm almost done. Just have to get through this last part, metastock.com/summit deal. These are some great products. Again, if you decide to sign up for this whole pack and don't like any of it, your real risk is only going to be $99 for the Learn Metastock subscription. So everything else is totally refundable on a money-back guarantee. So give us a call, 800-882-3040, metastock.com/sales-chat or metastock.com/summit deal. I want to say thank you for all of the presenters that came today. I thought it was a great session. I hope you enjoyed it. I hope you learned something. Give it a go. 800-882-3040, metastock.com/sales-chat. After I get done with the presentation today, you're going to get a little bit of a survey. It's going to ask if you like it. It's going to ask you for some suggestions, and it's going to ask you 3 questions. Fill it out. See if you like it. So there you go. Thanks for coming today. I hope you enjoyed it. I appreciate your being here. Make sure to like and subscribe, and we'll see you at the next one.
Metastock is an award-winning software and data package that has been helping traders for over 35 years. Simply put, Metastock is a tool for traders like you to analyze the markets. Metastock helps you take the guesswork out of trading by offering a methodical, systematic approach to some key questions all traders come up against. Questions like, how do I decide which securities to trade when there are literally thousands to choose from? Which strategy should I use? And how do I test that strategy before spending my first trading dollar? When should I enter and exit a trade? How can I effectively manage the securities I'm interested in? And of course, how do I know what prices will go next? At the core of Metastock are the power tools. The power tools give professional-grade analysis tools for private traders like you and me. You can scan the market with the Metastock Explorer to filter and sort securities that show buy and sell signals based on your criteria. The Metastock System Tester lets you test most strategies through a process called backtesting, which allows you to see how your strategy would have performed over time. You can easily manage and monitor the securities you are interested in with Quote Center. Quote Center lets you sort on a variety of criteria to view the data that's important to you. Then just double-click on a security if you want to see its chart. With the Metastock Forecaster, you can even take advantage of patented technology to view probable future prices. If you're an options trader, you're going to love Metastock's Option Scope. Option Scope puts all the critical info at your fingertips, displaying sortable, customizable, color-coded options data, including the Greeks. And Metastock has solutions for traders of all levels and interests. If you're just getting into trading, you will appreciate the education offered by our many built-in systems. In addition to pointing out buy and sell signals, Metastock explains how they work in an easy-to-follow commentary window. Metastock has built-in systems based on popular strategies like MACD, Bollinger Bands, turtle trading, candlesticks, and many more. Metastock even has the very popular and exclusive Rahul Mohindar Oscillator system, or simply known as the Armo. And as you become a more experienced trader, Metastock grows with you. Advanced analysts will enjoy the comprehensive list of trading systems and indicators, and the ability to build their own systems. And if you're a day trader, you can't do better than Zenith, the real-time news, data, and analysis package offered by Refinitiv, a world leader in market data. Add on the world-class support, and it's not hard to see why Metastock has won the Stocks and Commodities Reader's Choice Award for 26 consecutive years. To find out more about Metastock and how it can help your trading, visit metastock.com or contact a product professional via phone, email, or chat.